Namaste. This is CA Dhananjay Bhave. I welcome you all to this CA Inter Financial Management Marathon Revision video. If you are somebody writing CA Inter exam in 2026, then this video is for you. In this detailed video, I have covered all the important topics in detail for your upcoming examination. Two, 3 points before you start watching chapter by chapter videos. First, point number one, keep a notebook and pen next to you. I'll be asking you to make a note of certain common mistakes that students do while solving couple of questions. I want you to avoid all those mistakes. Second, I may also ask you to make note of some important things. There are certain questions I want you to practice. I may dictate those question numbers, page numbers, and reference. I want you to make a note of that as well. Next, I am using PDF of my regular batch along with formula book, which also I give in my regular batch. Those who are not from Yashas Academy, those who have never attended my class, you don't have to worry. The soft copy of my regular batch notes and formula book, the PDF of both are attached. Go to the description section, you will get the link. You can download it free of cost and keep that ready with you when you're watching this video. Point number three, if you have already completed one round of FM studies or if you have already taken one or two attempts in the past and start with this revision video, it will surely help you. But if you are somebody who has never done anything in FM, directly watching this marathon revision video, it may not help you because this is a revision video. I'm expecting that a student has attended the regular class or that student has done one round of studies at least, or the student has taken one or two attempts. That student should know the basic concepts of the topics. Then when you watch this marathon revision video, it is going to help you out. I hope this is very clear. Do not start your studies directly with this marathon revision video. You should have done at least one round of study from your side. Okay. I hope this video is going to help you. I wish you all the very, very best. Thank you so much. All right. Investment decision or capital budgeting. The basic concept of compounding and discounting, I want you to go through once. The formula, this can be a 1 mark MCQ. Compounding and discounting is what we have studied in the initial part of this chapter. So future value is equal to present investment P into 1 plus R to the power N. Correct? R is the rate of interest per period. N is the number of times the compounding is expected to happen. Correct? If nothing is given in the question, compounding is always annual compounding once in a year. If they print semi-annually, quarterly, then only you have to change the rate and the number of years of compounding, number of periods of compounding also. And then when you shift it this side, 1 plus R to the power N, this is called present value. And this is what we do in NPV. We do future value, multiply that with discounting factor. And then we expanded this, we wrote it like this, future value into 1 divided by 1 plus R to the power N. This is the same thing, just do it as into 1, won't make any difference. And this 1 divided by 1 plus R to the power N, assuming rate is 10%, this will be 1 divided by 1.1, correct? To the power, I want to know the value at the end of year 1. So if I want to know the value at the end of year 2, this will change. This will be to the power 2, 3, 4, and so on. Suppose I am earning 8,000 rupee after 1 year. And if the rate of discounting is 10%, and this is what we have done. And in simple, this will become 1 divided by 1.1 to the power 1. If I don't write also, it's okay. And then I do 8,000 into 1 divided by 1.1. I get the present value. And this 1 divided by 1.1, if you remember, when you do in calc, it comes to 0.909. And then when I do 8,000 into 0.909, I get the present value. I think 7272 or 73 something. Now, what is the meaning of this? If I'm expecting 8,000 rupee to be cash inflow after 1 year, its today's value or present value or the real power of that money will be only 7272. In future, money loses value. 1 rupee will not be equal to 1 rupee. What is the meaning of this 0.909? If you receive 1 rupee after 1 year, its real power will be only 90 paise. That is why it is called discounting factor. You are discounting it. What is the meaning of discounting anything? You are bringing it down. Why are you bringing it down? Because money loses its value. And why money loses its value? Because of the purchasing power, which is due to inflation. If you remember in the class, we had discussed this in detail. What you can buy today, you won't be able to buy same thing after 1 year with that 100 rupee note, correct? Because items would have become costly. Vegetable, grocery, rent, electricity, any example you take, you won't be able to buy same thing after 1 year with same 100 rupee currency note. Either we can say vegetable has become costlier, or we can say rupee has become weaker. One is appreciating, the other one is depreciating. If the commodity is costly, that means your money has less power, correct? Having 5 rupee coin today, having same 5 rupee after 25 years. 25 years later, that 5 rupee may not buy anything in the market, correct? Maybe it is worth 0 rupee. It is like having 5 paise today, which had value 50 years ago. It has no value today. Book value is there, but the real value has gone down almost to zero because of the purchasing power. How do we measure the value of anything? What it can generate, right? Value of jewelry, what I can earn, what I can generate. I have a commercial complex. How do you do the valuation of that commercial complex? How much I can earn from that commercial complex? But if I have 1 paise coin today, 5 paise coin today, how much I can buy from that? Its purchasing power is almost equal to zero. So if you keep doing it, you remember the factors 0.909. Then when you take second year, comes down to 0.826. Who else can 750 or 751, 682 or 683, and then you get 620 or 621 and so on. That means if you get 1 rupee today, it is equal to 1 rupee. But if you get 1 rupee after 1 year, its real power will be only 90 paise. Has to be less. How much it will fall depends on the rate of discounting. If they give, you take the discounting rate from the question. If they don't give, you remember in class, take 10% and solve. Okay, if you want to make a note somewhere, write down. If discount rate is not printed in the question, then we take 10% as the discount rate and give a note. Any assumption you make, by default, you have to give a note. Sometimes tax rate they don't print, you take 30%, give a note. Yeah. If discount rate is not given, consider 10% and give a note. This is year 1, year 2, year 3, 4 and 5. Can you quickly tell me what is the meaning of 0.620? If you receive 1 rupee at the end of 5th year, its real power will be only 62 paise. Right? Future value is 1 rupee, but its real power or present value of future cash inflow is only 62 paise. Right? So our first method is NPV method, and this is what we do. NPV method starts with an investment year 0. One such silly mistake, there can't be a sillier mistake than this. I don't know whether sillier is a correct word, but there can't be a sillier mistake than this. Year 0, when you do cash outflow, don't do this as 0.909. Many students in class also have done this mistake. What is the meaning? Year 0 means today. Today 1 rupee is what? 1 rupee only. Today 1 rupee cannot become 90 paise. Year 0, 1 rupee is always 1 rupee. This 0.909 will start in future. Future's value is less. Today 1 rupee is always and always 1 rupee only. Yeah. What do we do in net present value? Name itself is net present value. That means there is some cash outflow, some cash inflow. We take the net effect of that. We do these things. Year 0. Always understand this. Year 0 means today, or I can say year 0 is beginning of year 1. Beginning of year 1. If I say end of year 1, it should be counted as 1. Tell me what is the meaning of beginning of year 4, end of year 3. Beginning of year 6 is end of year 5. To confuse you, they will give these adjustments. Company is planning to purchase an additional equipment. We have a lot of questions like this in the regular class. Company is planning to buy an additional equipment at the start of third year. Now, start of third year should not be written in year 3. Start of third year is end of second year. 31st March night is equal to 1st April morning. Keep that in mind. So third year beginning should be understood as second year end. Depreciation you can count for third year also because you're buying it at the beginning of third year. Right? You have to be very careful. Make a note while solving questions. If there is anything about beginning of the year, go very slow. Make a note. In your own style, you can make a note. If there is anything mentioned as beginning of the year, anything mentioned as beginning of the year, then be very careful. If you want to write this also, beginning of year 3 means end of year 2. Beginning of year 3 means end of year 2. Okay. See on screen. Normally, what happens in NPV questions, net present value, you have a cash outflow followed by series of cash inflows. Right? This is what happens in every investment. You first invest and then you earn return from that investment. Suppose you're starting a project, you have to spend 10 lakh rupee in year 0. This is your cash flow. Remember, NPV table is not based on profit or loss, it is based on cash flow, cash profit. Okay. And then you take the discounting factor, rate will be given in the question, if not 10%, and when you multiply, you get discounted cash flow. And every year you're expected to earn something like this: 2 lakh, 3.5 lakh, 8 lakh, 21 lakh, 40 lakh. Sometimes you will have the scrap value also. You might have purchased the asset now, you may be able to sell it at some amount at the end. If nothing is given in the question, there is no scrap value. Common mistake many students do: for depreciation calculation, they will take the scrap value. But when they do NPV table, they forget to add the last year's scrap income. Okay, when you're buying an asset, if you're counting it as cash outflow, when you're selling an asset, it has to be cash inflow. If you're taking minus here, you should not forget to take plus 2 here. In some questions, they say to sell at 2 lakh rupee after 5 years, you have to spend 30,000 for dismantling the asset because you would have installed it to a wall. You have to remove it. That may cost you, say, 30,000. Then you have to minus that here. Then only 1.7 lakh should be counted as your scrap value. What if they say 2 lakh is a scrap value? Dismantling itself will cost you 2 lakh rupee. Then it is as good as counting zero scrap value. Okay, read this carefully in the question. Scrap value not given, leave it. Given without any adjustment, copy as it is. Given with adjustment, then you have to minus that adjustment, because when you buy the asset, you install. Then when you have to sell it, you will have to remove that installation, and that can't be done manually. You may need to get one technician, he may charge you some amount. That has to be taken as cash outflow. Okay. Next, I wrote cash flow, but this has to be cash flow after tax. One of the important concept, and this is what you do in lot of questions. You have to first work out cash flow after tax. Okay. What do you mean by cash flow after tax? Say year 1, 2, 3, 3 years project. You first start with profit before depreciation and tax. You remember these kind of questions. Either you start with PBDT, or sometimes you may have to start with sales. From sales, you take out material cost, labor cost, rent, and other expenses, and then you will reach PBDT. Or sometimes question itself will start with PBDT. Tell me if you remember, what is the first thing to be taken out from this? Depreciation. Tell me, depreciation, why should I minus? So that I can calculate tax properly. Correct? So from PBT, I'll pay tax. Again, nothing is given. You can take 30% and work out. This will give you PAT. This profit has come after deducting depreciation. And my heading is computation of cash flow. Depreciation is a non-cash item. Therefore, what to do now to nullify the effect? I have to add back depreciation. Now for PAT, when you add back depreciation, what you get is cash flow after taxes. Answer two questions. First, why did I deduct depreciation here? To calculate correct taxes. Then why did I add back same number here? Because it's a non-cash item. Understand? When you take in year 0 itself entire 10 lakh as cash outflow, again you should not count 1 lakh, 1 lakh, 1 lakh depreciation for all the years. Then it will be duplication of same 10 lakh. Correct? You have already taken year 0 full 10 lakh. Again, don't take depreciation as a cost. But if I don't take depreciation here, unnecessarily I'll pay more taxes. Therefore, first I deduct depreciation to pay taxes. Then I'll get to know profit after tax. Then I know this is not my cash profit. To get the cash profit, I add back depreciation. Correct? Now I have a statement. Tell me whether I'm right or wrong. If question says company is in special economic zone and they pay 0% tax or they enjoy tax free subsidy from government, then should I do this table? What happens here? You will have PBDT. Observe what is happening. Depreciation, assume 20. This will be 80. On this, you will not pay anything. And then for this, you will add back same 20. You will reach here. Instead, this was already available here. Correct? That means tell me what is the one sentence summary that you can understand from this 0% tax. When there is no tax, tell me what I can write. When there is no tax, PBDT itself is equal to CFAT. If in your exam question has this no tax adjustment, then you give one note. Since there is no tax, profit before depreciation and tax itself is considered as cash flow after tax. Then you don't have to even worry about SLM method, WDV method. Anyway, you're not counting depreciation for calculation. Correct? Now, you said from PBDT, I will take out depreciation. Now, for depreciation, they should give you the method, correct? Or at least they should give you the hint: original cost, life, percentage, only one asset in the block. You know, this is there in income tax also. Depending upon what information they have given in the question, you go by that. 99% of the questions, they will print the method name itself. Some questions, maybe one or two you have, where they won't mention the method name, SLM or WDV. But they'll tell you original cost 10 lakh, useful life 5 years, scrap value. With that, you can make out that they're talking about right line method. Or sometimes they say original cost 10 lakh, depreciation should be 20%. That means you know they're talking about WDV method. Either they mention or they'll give you hint. Okay. Once you deduct this, you get PBT. What if PBT itself is negative? Suppose this is year 1, year 2, year 3, year 4. If PBT itself is negative, there are 2, 3 possibilities. Let me explain all of that. You can make a running note if you want now, or else later. You can pause the video and make a note of it. First of all, if question says loss cannot be carried forward, tell me from your income tax knowledge, what is the meaning of this sentence? Loss cannot be carried forward. Next year, when you have profit, you can't use year 1 loss. Let me write some numbers. Suppose this is minus 20. Next year, if you have 30 profit, if question says loss cannot be carried forward, you have to pay full tax here. Assume, sorry, I'll do one thing. I'll change it to PBT minus tax at 30% PAT. Tell me now, what all I should do if question has this sentence, loss cannot be carried forward. Year 1, should I pay any taxes? No, I am in loss, so nothing to pay. This will be minus 20. Year 2, what to do? 30% should be on 30. You can't use this minus 20 because question says loss cannot be carried forward. This will be 9 and you continue as it is. Next year anyway, no problem. You just have to continue as a fresh year. Okay. See what I'm writing. Second possibility. If they say loss can be carried forward, then tell me, this year you won't pay anything? No change here. Tell me what happens now in year 2. From 30, you can first minus this 20. Now taxable profit is only 10. On 10, you have to pay 3 rupee tax, 30%. Then this will be 27 and you continue. Okay. Sometimes they say loss can be carried forward only for 2 years. And then imagine this is minus 20, this is positive 8, this is positive 10. Now tell me, what is the treatment? Nothing here. Okay. Here, can I set off the losses? Yes, because they said you can do it for 2 more years. That means here also I'll not pay because entire 8 will get offset here itself. So this will continue. Can I use it here also? Because out of 20, only 8 is used. I still have 12 unused. I can use here also. I will not pay any taxes. What if I have 4 here? Can I use now? No, because the question says only 2 years. That means now I have to pay 30% on full 4. Say that will come to 1.2 and then 2.8 onwards. You continue. Is it okay? In question, read this carefully. They have all three varieties of questions in study material also, in my class material also. And those who are watching on recordings on YouTube, if you have not attended my class, anybody's class you have watched also, you'll have all three variety questions. One question of each variety I want you to go through. One where loss can't be carried forward, one it can be carried forward without limit, that means 3, 4, 5 years, no problem. Third, where they say you can carry forward only for 2 years, 3 years, or sometimes they say can be carried forward only for one subsequent year. That means year one loss, year two you can use, year three you have to forget. Okay, go through one question which has negative PBT, all three possibilities. If you want, make a note of this. First possibility, loss can't be carried forward. Second, can be carried forward. Sir, how many years can I carry forward this? You tell me. In Income Tax Act, they say what? 8 years. That means if question is silent, then you follow Income Tax Act, you can use it for 8 years. And you don't have any questions in Inter where they ask more than 8 years project. So not to worry. Third possibility, they can mention that you can carry forward only for 2 years or 3 years. Go through one question of all three variety. Okay. So let me start from here. First, you get PBDT. Okay, if PBDT is not given in the question, how do I reach here? Then they will at least give you sales. From this, you have to take out all expenses, material, labor, and overheads, or sometimes they say other expenses. Yeah, this will give you PBDT. I have a question. If they say overhead including depreciation, then will I still call it as PBDT? Think and answer. If in question they say material, labor, overhead including depreciation, so I'll write some numbers: 100, 20, 30. This is 7. The 7 is overhead including depreciation. Will I call it as PBDT? No, it is directly PBT now because this is already included. Because out of 7, maybe 3 rupee or 2 rupee is depreciation. Okay. I have a question. Sometimes they say cash expenses. Now tell me here, if you minus cash expenses, say again, same, I am taking the number. Can I call it as PBDT or PBT now? PBDT, because this is only cash expense. That means depreciation is not included in this. Depreciation is a non-cash item. So in question, make a note if you want. Observe if the question has expenses including depreciation or excluding depreciation. Many students get confused here. When they say cash operating expenses, obviously depreciation is not included. I repeat, if they say cash expenses, obviously depreciation is not included in this. Read this carefully in the question. Can I? Sometimes they do this. Sales 80 lakh, variable cost 20%. Then tell me what to do when you do year 1, 2, 3, 4 CFAT. Take sales and then variable cost 20%, or you can directly draw one line here and say contribution. If variable cost is 20%, then tell me contribution should be 80% of sales. You can directly start from this. Okay, either you do sales minus variable cost, or sorry, this is confusing to me. Then you do one thing. First you write sales, then you write minus variable cost, then you do PBDT and other things. Okay, depends on the question. Sometimes they say 60% profit ratio, that means 40% cost. 80% cost ratio, that means 20% profit. You have to be careful while read. Yeah. So starting with sales minus material, labor, overhead, this will give you PBDT. After this, I already told you what to do for depreciation. Then you get PBT. Then you take out the tax. Tax, if nothing is given, you can take 30%. Loss case, we have already written what to do. Then you get PAT. And then we add back depreciation and we reach CF8. Tell me, what do you do with the CF80 later? Use this in NPV table. That will be statement of NPV, which starts with year 0, 1, 2, 3, say 5 years project. Then CF80, year 0 will be initial cash outflow. Let's assume 10 lakh rupee. And year 1, 2, 3, 4, 5, that number will come from this CF80 box. Okay. If there is some scrap income, then you'll have to add it here. Last year only. I have a question. What if they say in between 8 years project, they say at the beginning of 4th year, we bought one more machine. Now tell me where all this will impact. 8 years project, year 0, we will buy one machine. Beginning of 4th year, we buy one more machine. Tell me which are the working notes I should be careful now. Correct. When you do depreciation, tell me how will you work out. When are you buying this machine? 4th year beginning. That means can I take year 1, 2, 3 only or 4th also? 1, 2, 3. This will be based on original machine, its scrap value, full 8 years. Correct? And then year 4 onwards, 4, 5, 6, 7, 8. This original machine's depreciation plus this new machine minus its scrap value divided by how many years now? 4 or 5? It will be 5 because you are buying at the beginning of 4th. That means you can count 4th also. Correct? You should not count 3rd, you have to count 4th. 4, 5, 6, 7, 8. Then this has to be 5 years. Later, when you do NPV table, year 0, there is a cash outflow. Then 1, 2, 3, 4, big table up to 8 years. Tell me, where will you take this one more machine purchase price? Which line? Year 3 or year 4? Where should I take it? Year 3. Why year 3? Beginning of year 4 should be understood as end of year 3. Cash will go in 3rd year last day, but depreciation will start from 4th year. Correct? I'm making a small change. You tell me where all it will hit. If they say you're buying this machine at the end of 4th year, now tell me what changes I'll have to do. Depreciation for 4th year also is only based on first machine. Correct? And this will start from 5th year. Now the life of this new machine will be only 4 years. And here, this I will have to take as cash outflow in 4th year only, not 3rd year, 4th year, because you're buying it at the end of 4th year. Okay, be very, very careful. Beginning of the year, end of the year. Year 0, you won't do mistake. Year 8 I'm taking for this example, scrap value won't do the mistake. In between, they'll buy a machine. That's where you go wrong most of the times. Beginning of the year, end of the year, be careful. Okay. Now, in NPV method, suppose you have year 0 cash outflow and 5 years project, and if all 5 years you are going to earn same cash inflow, then tell me we don't have to do a big table like this. When this number is same, it is a kind of annuity cash flow now. What is annuity? When you earn same money for limited period. Now limited period here is 5 years. This is not perpetuity. Then perpetuity should go till infinite years. No machine has infinite life. 5, 10, 15, 20. So you will have an upper number. Correct? So this has to be 20 rupee for 5 years. And this is multiplied with DF. Do you remember DF is also called as PVIF, present value interest factor or index factor? Yeah. But here, since this 20 is same, I'm counting 10%. Instead of doing 0.909826 and this 5 times, tell me there was a shortcut for this. Do you remember? You can write year 0 and then year 1 to 5. Why I'm writing 1 to 5? Because cash flows are same. Then this will be CF80. This will be 20. 5 times 20. And then this will be PVAF now. Why PVAF? Because this is annuity factor. When to use annuity? When cash flows are same and time period is limited. Limited here is 5. It can be 5, 8, 10, 15, but I should know the name. I should know the number. It can't be unlimited. No furniture, no computer, no machinery will be with you for infinite years. So you'll have the number, correct? Tell me, this is anyway, okay. Year 0, say minus 40. Year 0 is always 1. Now, year 1 to 5, what to fill here? I can't fill 0.909826. I have to do the summation of all this. Summation of discounting factors, that comes to say 3.789 or 790. This is called as annuity factor. This when you multiply, you get DCF 80 minus 40, 20 into 3.79, whatever, 70, 5 point something. The net number is NPV, positive. Positive NPV project should be accepted. Negative you reject. Zero, book says accept or reject, therefore we'll go with that itself. But normally zero won't happen in your exam. Don't worry. Okay. Even if it is zero, because of your rounding off, it will be either positive or negative. It won't be exact zero anyway. Yeah. Another common question or doubt that keeps coming up. Sir, how many digits rounding off I should consider? I don't know why. This and that, how many days in a year I should count? 365 or 360, and discounting factor, how many digits I can round off. This has come at least 25 messages already in Telegram group. So I'm thinking I'll make a separate reel for this only. Discounting factor, you take 3 digits, 0.909. Okay. All other numbers, you take 2 digits, 85 rupee, 0.25, 0.35. But when you are working out sums in lakhs, you don't have to worry about 25 paise, 35 paise, because your answer is coming in lakhs and crores. If your question itself is 81 rupee, 31 rupee, then I understand. When you're doing 81 lakh, 31 lakh, 21,310 rupee, 0.7 paise won't make a difference. Okay. So if question is in lakhs and crores, ignore the prices. If question itself is in rupee, 25 rupee, 35 rupee, 41 rupee, then you can count up to maximum 2 digits for rupee. Okay. Discounting factor 3 digits, other numbers 2 digits. Okay. Is it clear? Reel cut here. We'll continue the video now. So don't worry about this too much. In exam, have you seen a question paper or RTP? They will print even DF in the question itself. 0.909. When they print, you have to take that only, not what is there in your calci. You can't even now take 2 digits when they print 3 digits. And sometimes in the question, they mention consider nearest rupee. You don't have to worry about those spices. The last column, DCF 80, that at least you can round off without a worry. Okay. You don't want to round off other things, it's okay. Year 0, this CF 80, and then DF, I told you 3 digits. And then this DCF 80 number, if you are getting 18,379.57.31, this one, maximum, what is the impact of this? 1 or 2 rupee difference in the final answer. Here you can round off, no problem. Okay, don't round off here. Some students have a bad habit. Here only they make it 0.91. Then you'll have a much bigger difference in the final answer. Don't do. Keep 3 digits here. Okay. Then there are some questions in NPV related to machine replacement. Make a note, at least one question on replacement decision you should practice. What variety I'm talking about? You already have a machine and you're planning to sell that machine and buy new machine. I hope you remember there were many questions like this. We bought one machine 3 years ago. It has still another 8 years life, but we are now thinking of buying a new machine and sell that old machine. Okay, such questions. Any replacement decision question, you have to be very careful in year 0. Okay, let me write one example here. Focus on screen and answer my question. You have purchased one machine 3 years ago. That time you had paid 5 lakh rupee. You are planning to buy a new machine today, and this new machine will cost you 9 lakh rupee. If you buy this new machine, the old machine you can sell for 1 lakh rupee. Numbers are easy. Old machine, 3 years old, you purchased, it still has 7 years life. New machine you are buying today, even this has 7 years life. Correct? This was 3 plus 7, total 10 years, but out of 10, 10 3 is over. You have to only think about future cash flows. This is anyway new machine. From today, it is 7 more years. That means both are 7 versus 7. Now tell me what all should I do in year 0? I will wait. I want you to answer. Year 0, what numbers are to be taken? I have to first purchase new machine. When I buy new machine, there is cash outflow. So I have to take it as minus 9 lakh. What else I have to do? Why plus 1 lakh I have to do? Because I'll be selling the old machine. Should I not take plus 5 lakh? When did I pay this? This is not going to come back to me today. This was an old event. Correct? Then why do they even print this in the question when this is an irrelevant number for depreciation calculation? Answer. How to find out depreciation of old machine? For that, original cost is 5 lakh minus not 1 lakh. 1 lakh is if I sell it today. But total life of that machine was 3 plus 7, 10 years. That will be given in the question. 10th year later, this can be sold for say 0 rupee. Able to follow? Tell me divide by. Should I take 10 or 7? I'm asking depreciation of old machine. I have to take 10 only because even in last 3 years, I would have charged some depreciation. Correct? But this new machine you're buying for 9 lakh. Maybe this has scrap value of 2 lakh. This I'll divide by 10 or 7 now. 7 only. Many will do mistakes here. You answer. Why did I take 10 here? 3 over 7 more to go. Total life is 10 years. Depreciation will start from the first year itself. 3 years of depreciation we have already debited in books. Correct? Here, why am I dividing by 7? Because I'm buying it today. And from today, this will be used for 7 more years. Students do mistake here. And you do mistake here, you know. PBDT after the D itself is wrong. PBT, T, adding back also wrong number. Everything will go wrong. Be very careful with useful life. Make a note. In any machine replacement question, be careful with the depreciation working note. Normal mistake that students do is in taking wrong life denominator. Can we? What if they say this in question? The asset has already been fully depreciated in books. What does that mean? You bought it 3 years ago. As on today, you have already counted full amount as depreciation. That means from tomorrow there is no more depreciation if you continue with existing machine. Maybe depreciation rate is 33.33% SLM. What happens when you do 33.33% SLM first year, second year 66.66, third year 99.99 almost. In 3 years you would have written off from the books. You have to be careful. In some questions they mention this asset has been fully written off in books. That means asset has zero WD. Understanding? But if they don't mention, then you have to calculate this way: 5 lakh minus scrap value by 10 years. That means we would have debited 50,000 rupee every year. And 5 lakh we bought it first year 0.5, next year 0.5, 3 years over. So you would have already taken out 1.5 lakh depreciation. In books, it is sitting at 3.5 lakh. Read this line carefully in the question. Okay. Another important thing: any replacement decision, when you work out, it is not simply computation of CFAT. If you continue with existing machine, how much CFAT you will earn. If you shift to new machine, how much CFAT you will earn. The difference is called incremental CFAT. Very, very important. What is the meaning of this? If I continue with existing machine, my PBDT. If I shift to new machine, my PBDT, say 80 lakh here, 90 lakh here, minus depreciation, PBT, minus tax, etc. Finally, you reached CFAT. Now see what I'm writing on screen. If CFAT here is 8 lakh and here it is 9 lakh, which means if I continue with existing machine, I will continue to earn 8 lakh, 8 lakh, 8 lakh for future. If I shift to new machine, I'll be earning 9 lakh every year. That means by shifting to new machine, I will earn 1 lakh extra. Extra is called incremental CF80. Then when you have to decide, your table will have year 0, save 5 years life. Year 0, you have to pay 3 lakh rupee. I'm just writing example numbers. Now tell me what all is included here. New machine purchase price minus old machine scrap value, resale value. And then you will be earning 1 lakh extra. But this 1 lakh is per annum for 5 years. That means this should be PVAF now. 1 to 5 years, correct? And then if this number is positive, I want your answer now. If this number is positive, what does that mean? Replacement is a good decision. What do you mean by replacement is a good decision? Sell the existing machine, buy the new machine. If this is negative, then continue with existing machine. You have to write conclusion. Yeah, one more thing. Many students are good in solving these problems. They'll reach till NPV positive 5 lakh. They won't write any conclusion. You have to write what is the meaning of positive NPV. It is a good decision to buy new machine. Negative NPV, it is better to continue with existing machine. What if NPV is 0? Makes no difference. Either you continue with old machine or shift to new machine. You will neither earn extra nor you will lose money. That 0 NPV won't happen. I've already told. Okay. Make sure you write conclusion. Don't stop with NPV positive, NPV negative number. What they want from you is answer. Should we buy or not? They don't want positive 3 lakh or minus 3 lakh. Conclusion should be written without fail. Yes. After this, the second method in the chapter is PI method. You shouldn't count this as a separate method because there is nothing extra that you have to learn in PI method. Tell me, all cash inflow after applying discounting will be numerator, all outflows will be denominator. How to do NPV? NPV also same thing. Cash outflow negative, cash inflow positive. You get positive or negative answer. Here you get more than 1, less than 1, or equal to 1. Let me do one quick examples. Here 0, 1, 2, 3. Cash flow, take it as after tax. Minus 100, 45, use calci, 65, 85. Let's apply 10% DF. Tell me what are the factors. This will be 1.90. Can somebody do the last column parallelly in calci? This will be 0.826, 0.750. You have the numbers? This is anyone? Okay, next. Okay, 7, 5. Anyone has this? 58 point positive. This is your NPV method. If they ask PI for the same question, tell me what is the difference between the two. NPV is a absolute value, A minus B. Correct? PI is a relative number. All inflows will be numerator and the outflow is your denominator. How much is this? 158.34 divided by 100. This will be 1.5834. Now tell me what is the meaning of 1.583. Don't tell me this is PI. I know. Tell me the meaning. What is 1.5834? If I invest 1 rupee, right? So come down to 1 rupee in PI. If you invest 1 rupee today, you will get 1.5834 back. In that 1.5834, 1 rupee was your rupee only. That 58 paisa is extra money. That extra money in absolute value is called NPV. In relative value, it is called PI. Proportionate number is PI. Correct? It is like A minus B, A divided by B. One is plus minus, one is numerator and denominator. Okay? You answer. If NPV is positive, that means inflow is more than outflow. That means PI has to be greater than 1. Do you agree? When big number you divide by a smaller number, answer has to be greater than 1. If NPV is negative, then I think PI will be less than 1 because NPV negative, meaning this is 81 rupee by 100, correct? Then NPV will be negative. So this has to be less than 1. Answer NPV is 0. How much will be my PI? Equal to 1. When will NPV be 0? When inflow is equal to outflow. That means same number will be there in both numerator and denominator. Same number by same number has to be 1, not 0. Many students think pi will be 0. This is very dangerous for 1 mark MCQ. They can ask you this question: which of the following statement is true, and give this itself. When NPV is equal to 0, PI is not equal to 0. PI is equal to 1. Same number by same number. Answer is not 0. But same number minus same number, answer is 0. Correct? Avoid silly mistake. This is one good case. And they're asking nowadays for 1 mark these kind of things. Which of the following statement is true? You have to think. And any question like this, which of the following statement is true? Don't read the question and whatever answer comes to your mind first, don't tick that. Think 2, 3 times and then only tick. Or go by my logic. The first answer that you get is wrong answer. Convince yourself 2, 3 times. If you're still getting the same answer, then only tick. Because we go fast, because there is no calci work, you think, okay, theory type, read and tick. They know this game very well. Okay, be very careful. The first answer is not the correct answer. 3, 4 times, if you're still getting same answer, then only tick. Luckily, no negative marking. Before they bring in negative marking, pass the exam. Okay. Yes. And those who are watching this on YouTube, this sentence is applicable till they bring in negative marking only. If you're watching very late, please check whether there is negative marking to your attempt. As of now, there is no negative marking. So they'll play, be very, very careful. Yes. After this, there is a simple method called payback period method. In this, there is one thing called simple payback period and another one is discounted payback period. I want you to work out one sum on discounted payback period, simple payback period. Even if you don't work out, you will solve. It won't be tough. Okay. Tell me what is the difference between these two? Correct. Here we consider discounted cash flow. Here we go by book value of cash flow. I'm writing some numbers. 10. Year 0, we have to invest 140 lakh. Negative. Project life is 3 years. Year 1, 2, and 3. First year you will earn 60. Next year you will earn 75. Next year you will earn 90. How to find out simple payback period? What is the meaning of simple payback period? Or what is the meaning of payback period, first of all? Correct. The time or number of years you need to get back your original investment. You don't want to know more money or less money. You want to know when will I get back my original money of 140. Correct? Tell me how to do. First year, I would have earned only 60. Next year, 60 plus 75. That will be 135. I have still not recovered my money. One more year I have to do. Do you remember this column is called cumulative cash flow? We do the answer this way. Year 1, 2, 3. We bring in cash flow and then we do this cumulative cash flow. Yes, sir. This was 60, this was 75, and this is 90. This will be 60. 60 plus this 135, 225. But I don't want 225, I want only 140. Correct? How to do? Minimum 2 years it will take plus some more time. Here, one confusion some students have. Understand my full sentence, then you copy if you want to. If this is MCQ question, see the options. If option is in years and months, 2 years, 8 months, 3 years, 4 months, then when you do cross multiplication here, do it in months. Okay. If option has answer in years, 2.8 years, 2.9 years, then here you do cross multiplication in years. What if they give option in days, 2 years to 40 days? Then you do cross multiplication here also in days only. Okay. Example. If all options A, B, C, D are in years and months, then 12 months you will earn 90. Correct? But you have already come till 135. You need only 5 more. So cross multiply. Now, since options are in years and months, hope you're understanding. I took 12 months. Can you do 12 into 5 by this? 0.66. That means it is 2 years. plus 0.66 months. I'm doing it because options were in year and months. Okay. And now see, I'm changing something. What if options are in years? Something like 2.87 years, 2.13 years. Then this can't be 12 months now. You have to change this to 1 because 1 year. Now tell me how much is this coming to? 5 into 1 by this 0.05. Now you can add both. This will be 2.05 years because all options are in years. What if they give in days now? Change it to 365. Correct? How you should cross multiply depends on options. What's the number? 5 into this by this 20.2. That's okay. That means your answer is 2 years plus 20 days because in question it is in 2 years plus days. So which way to cross multiply depends on options. Sir, what if this is in descriptive section? Then up to you. Either years and years or years and months. Anything is okay. To keep it easy, go by years only, then 1 year, 2 point some years, then you don't have to worry much. They ask in MCQ pattern, then you should be very careful. Can I continue? Many will do this mistake. Years and months, years and you know what some students do? They don't read the options. They will do first in years. And then in mind they want to convert years to months. They do into 12, into 3 quarters, into 4 months. Don't get into this. I know how good you are in this. You know how good you are in this. If question is in days, you solve in days. If question is in weeks, you solve in weeks. Don't solve in your style and then try to convert. This is applicable to all other topics also. Question is in weeks, you solve in weeks only. If it is in weeks, then what to do? 52 weeks and then solve. Answer itself will come in weeks. Okay. Next, if the same question is not simple payback period, discounted payback period, tell me what is the extra thing I have to do in my answer. I can't count 60, 75, 90 as our numbers. I have to first multiply this with discounting factors, and this will be discounted cash flow. Correct? And then you do cumulative discounted cash. Say this will be say 10%. Then this 60 into this will come down to 54. Correct? Like this second year factor, this will come down 60. Okay, and this will be 0.750. 67. Correct? Mm. And then cumulative, this is 54 plus 61, 115 plus 67, 182.9. Now also I need original 140, and that will happen after 2 years, before 3 years. Now 2 years plus, I am keeping it in years. 1 year, many students after coming till here, they again take 90. If you wanted to take 90, then why did you work out 67? Another silly mistake. When your question is discounted payback period, you have to count 67. But how much you want? You have come till 115 and you want to go to 140. 24.1 extra you want. Then how many years? So 24.1 into this by this. Sorry. 0.35. 2 years plus this. Everything is in years now. 2.35 years. In MCQ, you may not get exact answer. Take the nearest one. Because of rounding off, you will have difference. You will not get the exact answer. Please be careful and don't waste time on getting that exact decimal in exam. And they won't give you very close 4 answers. That also you don't worry. They're not that bad. Okay, it will be far away, but you may not get, say, something like IRR. In class also, we never got exact same answer. Go by the nearest IRR available in the option. Yeah. So after this method is that itself internal rate of return. Tell me if they ask a theory question, one line. What is the meaning of internal rate of return? This is the rate at which NPV is 0. And when will NPV be equal to 0? When cash outflow is equal to cash inflows, discounted cash inflows, correct? Now we normally do it in trial and error approach because we don't know at what rate NPV is going to be 0. We may take 10, 15, 20, 30. Okay. One more thing, let me clarify now itself. In exam, they will give you trials also. They'll give you last end of the question, they'll give you the tables 10, 15, 20, 25. That means those are the four trials you can try. If they don't give, you always first start with 10%. Then you know if it is very near to 0, then maybe 15% trial is enough. If it is far away, maybe you can take 30% also. Up to you. According to me, they will not give you the choice to take any random trial. They will mention, they'll give a small table. That's a hint 10, 15, 20, 25. That means these four only you should try. Okay. If they give a table 10, 15, 20, 25% and DF, then you should not count some other random number. Then you don't count 17, 23, 27, etc. First of all, DF is printed in the question. Why do you want to complicate things? And why did they print? That's a hint, correct? And some students have this bad habit. First they take 10 and then directly they take 45, 55, etc. Don't keep such a big gap between two trials. If you have taken 10, next trial you can take is 25 or 30. Then from 30 you can jump to 45 or 50. From 10, don't jump to 50 directly. And you have seen in the class also, longer the gap, approximate is the answer. Lesser the gap, better will be the answer. Okay. Sir, what if this is MCQ? Then what to do? Maximum 4 trials only. Out of 4 options, one has to match. In MCQ, they have given 4 numbers. Take the first number. See whether it is near to 0. If it is already almost near to 0, you don't have to even check second, third, and fourth. Take first one only. Correct? If it is descriptive, minimum 2 trials you will have to do. Beyond third trial, you should not go. If you remember in class, we did 10, sometimes 30 also did not work. Then we went to 40 or 45. But you should not waste too much time on doing 4, 5, 6 trials. Then something is wrong in the answer. Maybe you have missed one zero in the question itself. It will not take too much time. In class, it took time because we were learning. Now, not more than 2 trials. If it is MCQ, those 4 options only, any one you try first, then you will know whether it is very close to or far away. Accordingly, you can select the second one. Okay. Tell me, what is the style in which we work out? Year 0, say 4 years, and then we copy the cash flows. This will be there in the question, and then we try. And I told you, you can take up first 10% and then get the DCF number. Suppose this is positive 21. What should be my next trial? More than 10 or less than 10? Should I try more than 10 or less than 10? Why more than 10? Because you have to bring the value down. If you have to bring the value down, your depreciation rate on cash, discounting is more like depreciation on cash. Money is losing value. So you have to take a higher number. Now this is where the trial and error comes into picture. He may take 20, she may take 21, she may take 18 also. That's why I'm saying they'll give you in the question, follow the question. That's why read full question first. Till the end, there may be that table. And nowadays, last 3-4 attempts at least, every time they are printing the trials also. Consider below table and they give 10, 12, 14, 16, 18. Means one among these on. If you don't have time, first and last one you try. Has to happen in between. Correct? Now if you try 20 and if you get negative 8. Sorry, negative 8. Tell me what is the meaning now? Answer is somewhere between 10 and 20. Correct? Now these are just example numbers that I have taken. Many students, after doing this, they do one mistake. IRR is equal to. Is it more than 10? Are you sure? Yes. That means it has to be 10 plus. I don't know why some students want to start with 20 plus. You have not tried anything about 20. Why are you taking 20 plus? If you do 20 plus, it will be more than 20 now. And you don't even know what is there more than 20. It has to be lower rate plus. From 10, you went to 20. That means you increase the rate by 10 points. All okay. Because of which positive 21 came down to negative 8. That means fall was 29. Many will do mistake here also. Don't do 21 minus 8. It is 21 minus of minus 8. It is from positive to 0, 0 to negative, correct? So it's total distance traveled. 21 to 0, 0 to lower side 8 also. But you want this 21 to come to 0. That means you want a fall of 21. This is the way. Okay. Point 7.2 plus 10. This will be 17 point. Okay. I have a question. What if 20% itself is negative 0.37? Then don't even do this extra calculation. This is so near to 0. You can say 20% itself is my IRR. Don't waste time. That too, if it is MCQ, if you have 20%, tick that. And they won't give 20.1, 19.9. Don't worry about this. In MCQ, they will not play that way because they know rounding of difference will. Okay. What if this is also another positive number, say positive 6? Suppose this is MCQ. These are the four options. Okay. 20%, 24%, 18%, 14%. And at 20 also you're getting positive. That means the only number higher than 20 has to be the answer. Now don't try 30 again and do circus. Okay, sorry for the circus word. Some of you don't like it, but you know what I'm saying. At 20, if it is positive, slightly more 21, 22, 23 will start coming down. Ultimately, it is the only option available. Game is when they give 28%. Then you have to now try. Directly try 24 only. Then also not happening, tick 28. Why do you want to try 30 now? If you try 30 again, this extra work you have to do. Correct? If IRR comes in MCQ pattern, you are lucky. Take it from. Then you don't have to do 3 trials, 4 trials. You try whatever is there in the option A, option B only. You know exact number you're trying. Yeah. After IRR calculation, make a note. Solve at least one question having reverse working. At least one question with reverse working. What do I mean by this? They would have given PI. They would have given IRR. They would have given positive NPV in the question itself. And they want you to find out year zero cash outflow. There are a lot of questions like this. Normal questions I know you will work out. Outflow is given, find out NPV. Now NPV is given, find out outflow. That reverse working you practice. We had one question in class material also. There is one question in ICA study material also. Okay. Reverse working one question and one question on, I think you've already made a note, replacement decision. Right? We made a note of this. Minimum you have to do. And IRR, you need little more practice. PI, you don't need much of practice. Payback is easy. NPV and IRR, you practice more problems. Practice more questions on NPV and IRR. I've explained NPV, what all complications can come. Depreciation adjustment, loss adjustment, CFAT, scrap value, additional machine purchased in between, all of that. In NPV method questions, there is one more adjustment people have confusion. Working capital. Now, working capital is the money that you need for day-to-day business, but that's another investment that will have a cash outflow. Suppose you are taking a building on rent. Rent is every month expense. But before you shift your factory to that place, you have to pay deposit to building owner. Now that money gets blocked. And when will you get that money? When you close that factory or close that project. So in question, if they say there is working capital investment of 20 lakh rupee, you have to count it as year zero cash outflow. Year zero cash outflow. And if the project life is 8 years, you have to count this as last year cash inflow. Sometimes they print in the question year 0 you invest, year 8 you will get back. Sometimes they won't say year 8 you will get back, but you should know the day you leave that building, owner will give back the deposit. This need not be said, this should be understood. Whoever is living in a rented house, if you have given deposit, that money has to come back to you when you leave that building. Correct? So keep in mind, if they give working capital adjustment, two things. Year zero, take it as cash outflow. And last year, take it as cash inflow. Year zero, cash outflow. Last year, cash inflow. Why is it last year only and why not in between? Owner will not give you back the deposit in between. He will give you the deposit when you leave the building. And if the project life is 8 years, that means common sense that you will leave the building only after completing 8 years, not fifth or sixth year. Sir, that means this is 20 lakh gone and 20 lakh coming back. No loss, no gain. That is wrong. 20 lakh is going out today. Year 0, 1 rupee is equal to 1 rupee. But 20 lakh when it comes back in year 8 factor may be only 0.434. That means 1 rupee is worth only 43 paise when it comes back after 8 years. So in your NPV table, this is how it will appear. Year 0, outflow. Year 8, inflow. But year 0 is multiplied with DF of 1. This is multiplied with that year DF. I just wrote 0.434. It's just a number, may not be correct number. Then when you multiply, what you're paying is 20, but what comes back to is only 6 point something. You are actually losing. That is what you call as time value of money. Correct? So these are the common adjustments in NPV. You need more practice in NPV and next more practice in IRR. IRR is only to improve your speed, otherwise there is no new concept there. PI, payback period, you can go faster. And then there is one more method. They have never asked question on this, but we can't ignore. One day before exam, 2 minutes, go through this ARR method, also called as accounting rate of return or book value rate of return. Right? Here, what do we take? Only the P&L number, PAT from books. So if the project life is 3 years, then we take average PAT divided by either we take initial investment or we take average investment. And this average PAT, how to do also, there are many ways. Either you take PAT of all the years and divide by number of years, or every year you take that year PAT by that year investment into 100, one more PAT by investment into 100, then you get 5 answers. Take the average of those 5 answers. There are 3 ways of doing this ARR. It is there in your book. Those who have ICA study material, in ICA material also you have the same question that I have done in the class material. ARR question normally won't come because that doesn't consider discounting. Then you don't need this chapter itself. It is more like accounts subject question. But it is there in the study material. Don't ignore. One day before exam, 2-3 minutes. During your regular revision, if you skip this, it's okay. One day before at least go through. Okay. Here you don't go by cash flow. Here you go by net profit after tax, PAT. Clear? If you remember, there were 3 ways of calculating ARR. Suppose 5 years project, then take PAT of first year divided by investment opening balance that year into 100. You get say 5% first year, 6% second year. Every year you will have PAT. Every year it will have opening balance. Now opening balance of second year will be first year minus depreciation. Like second year opening minus depreciation and so on. Like this you will have say 5 years project, then you will have 5 percentages like this. And then do the average of these 5. Addition and then divide by 5. This is one style of doing ARR. Second style of doing ARR is you take PAT of all 5 years. PAT of first year, PAT second year, PAT third year, and then divide by 5 in the numerator itself. So this numerator now becomes average PAT divided by initial investment. When you started the project, maybe you would have invested 10 lakh rupee into 100, you get one answer. Third way, ARR, same like second. Take 5 years PAT of first year, PAT of second year, third year, divide by 5. You get average PAT divided by initial investment 10 lakh, year 0 starting. Year 5 says scrap value 1 lakh rupee divided by 2. Why divide by 2? Because they want average investment. How to do average of anything? Starting and ending, divide by 2. It's like opening balance when you started the project. year 0, and closing balance when you ended the project. Midpoint is this number into 100. Now, which one to use in exam? That they will mention. If it is descriptive 5 marks question, do all three and come. They have never asked a question on ARR, but don't take chance. 2 minutes at least one day before exam, go through. Yes, the last concept in this chapter is capital rationing. Now, when to use capital rationing? When you have, okay, I think there is one more concept I'll discuss after capital rationing. Unequal life discussion, I'll do it after that. Okay, when to do capital rationing? When you have multiple projects, all are good projects, but you don't have money to do all the projects. Something like this. You have only 1,20,000 rupees with you, but there are 5 projects A, B, C, D, E. All these investments, all these projects have positive NPV, say 10,000, 12,000, 8,000, 9.5 thousand, 8.1 thousand. All are good projects. But the problem is you have only 1,20,000. This requires 30,000 investment. This requires 80,000. This requires 45,000. One more, one more. If you want to do all 5, you can't because you don't have money. And how do I select which one to do? This process is called capital rationing. There can be two varieties of questions. One, where they say part project is possible. That means you do A, B, and if you don't have money to do full C, do at least part of C. Don't worry about exact numbers, I'm just discussing. Say if you decide to do A and B, 30 plus 80, you would have spent 1,10,000. You still have 10,000. But this requires 45, this requires 35, this requires say 38,000. Now you can't do any of this fully, but question says part project is possible, then part of C you can do. Now, how did I decide A first, B next, C later, D, etc.? For that, you have to do one more calculation. Either you can do NPV for rupee 1 or you can calculate PI and then you should give rank. Correct? Now, tell me how to do these all thousands. How to do NPV for rupee 1? 10,000 NPV divided by 30,000. Don't do into 100. What's the number? That means if I invest 1 rupee, I'll get 33 paise NPV. Correct? How much is 12,000 by 80,000? 1 by, assume this is 8,000. 8,000 by 45 point. Like this, you work out all the numbers. Listen now. Then, whichever is highest, you rank it first. Then the next best, and so on. Then start doing from the first rank. You still have money, take up second. You still have money, take up third, and so on. You will not have money to do all 5. If so much money was there, then it won't come as a question itself. You have a shortage of money. Therefore, first do full project. Then whatever small money you have, in that you can do part of next rank. Okay. This is one variety. Another variety, in question they mention that the part of the project is not possible. Now, what do you mean by part of project is not possible? Either you do full project C or don't touch project C. Now, what is the meaning when they say don't touch project C? Either do A and B only, or do A and C, or B and C. You can't do A, B, and part of C. Understanding? Then you have to do trial error. Now, what trial error I'm talking about? Select rank 1, rank 2, rank 3. Then do rank 1, 2, and 4. Then maybe 2, 2, and 3. Wherever you get the highest NPV, that you will have to select. Able to follow? In question, check. Is it part project allowed, or is it a question with part project not allowed? One sum of both variety you should revise. Part project is allowed, one sum. Same question, normally you'll have subquestion A and subquestion B. Will your answer be different if part project is not allowed? That one question you revise without fail. Okay. Yeah, one more adjustment that I missed in between is project with unequal life. There are two ways, replacement chain method, that in class itself we understood nobody uses. Remember, one project is 6 years, another is 3 years. We assume that 3 years project we do 2 times. And then we understood that this is not logical because we may not get another project. And even if we get, cash flows may not be same. Then we understood one thing. If there is one project of 3 years, another project of 4 years, and we work out NPV of this, say 1 lakh rupee, and NPV of this comes to 1 lakh 1000 rupee. We can't say this is project A, project B. We can't say project B is better than A. The reason is, no doubt you're earning 1000 rupee extra, but you have to wait for one more year for just 1000 rupee extra. Correct? If both were 3 years, then comparing will make sense. But when life is different, you can't compare 1 lakh with 1 lakh 1000 like this. Therefore, what they said, till this you do in your normal NPV style. This is for 3 years. Therefore, you divide by summation of discounting factor for 3 years. This is for 4 years. So you divide by summation of discounting factor for 4 years. Correct? Let's assume 10%. Use calci. How much is 3 years summation? 909,826,751. 3.2.486, and that 3.169 in calci. 1 lakh rupee by 2.486. 40225 approximately. And this is 871. This is called equivalent annualized criteria. Now, what is the meaning? 1 lakh rupee I will earn in 3 years versus 1 lakh 1000 I'll earn in 4 years. On an annualized basis, I'm earning 40,000 every year. Here I am earning only 31,000 every year. Therefore, I better go with 40,000. Yeah, you should never compare 1 lakh with 1 lakh 1000. Imagine this is not 4 years, this is 21 years. Now you'll understand why you need to convert it to per year. I am going to earn 1000 rupee extra, but I have to wait for 18 more years for just 1000 rupee extra. Therefore, when the life is not same, it should not be simply NPV versus NPV. So we divide by number of years, we'll get to know on an annualized basis how much do I earn. Correct? Here I earn 40,000, here I earn 31,000. Therefore, this is better. Imagine this was not NPV, this is cash outflow. Only outflows you have. Machine. Then it should be reversed. 1 lakh rupee I'll spend over 3 years. Here I'll be spending 1 lakh 1000. I know I'm spending 1000 rupee extra, but I get one full year extra. Correct? Understand the basic difference. Spending 100 rupee in 3 years versus spending 300 rupee in 25 years. There is a difference. Correct? Now when you do, you have to go by the lower one, because now this is not about NPV, this is about cash outflow. Obviously, when I'm earning, I select the one where I'm earning more. When I'm spending, I select the one where I'm spending less. So if question has, there are questions like this: machine 2 years life, 3 years life. Today you have to buy the machine year 0, year 0. Year 1, year 2 running cost, year 1, year 2, year 3 running cost. Now when you do the total, this total cost may be 3 lakh, this may be 3.1 lakh, but this 3 lakh you have to spend in 2 years. This 3.1 lakh you have to spend in 3 years. You can't compare this versus this because life is not same. Therefore, what you do, you divide this by summation of discounting factor for 2 years. This you divide by summation of discounting factor for 3 years. Then you get annualized outflow. Since it is outflow, go by the lower cash outflow. Okay. Maybe you need to practice one sum on this variety. That's all. These are the important concepts for this chapter revision. Yeah. With this, our capital budgeting or investment decision topic is done. Okay. Moving on. Next topic is risk and leverage. Make a note. This should be your first topic one day before exam. Easiest, smallest topic. And they always ask a question from this topic. That too easily doable question. Entire topic has only main three formulas: operating leverage, financial leverage, combined leverage, DOL, DFL, and DCL. Yeah, and all income statements only. Not much of calculation is involved. This topic and dividend decision. These are the two small topics and should be done as chapter number 1 and 2 one day before exam. Okay, and please understand one thing in FM. You have 7 practical topics. They will ask one question from every topic. Okay. But if they ask 8 marks, 10 marks type of bigger question in, say, working capital management or capital budgeting, then they will shift all these topics to MCQ. Risk and leverage, dividend decision, cost of capital, these can become MCQ type of questions also. But surely you will have equal weightage. Yeah. Including theory, we have 9 topics. So 50 marks, question paper will not be for 50 marks. Question paper will be for more than 60 marks. We have one question which can be left as optional question. That means equal division, every topic will have about 7 to 8 marks of weightage. Either they can ask 3 MCQs of 2 marks each or one big question of 6 marks. So don't neglect any topic just because it is smaller. Okay, some topics are smaller, good for you, because there is equal weightage even to that smaller topic. Just because it is smaller, don't go fast. Don't keep it for last. That working capital management should be the last topic one day before exam, because it's a very lengthy topic, you know very well. It has many small segments also. And even from that, they're going to ask only one question, maximum 2 questions. Understanding? So please don't neglect smaller topics. And this is one such small topic. Risk and leverage. You know some of the basic concepts. I don't think we should spend time on this. Sales. Quickly, income statement starts with sales minus the variable cost. You get contribution. From that, you minus fixed cost. You get EBIT. From that, you minus interest, EBT. From that, you take out tax. You get EAT, also called as PAT. Okay. And then you minus the preference dividend. You get equity, sorry, earning available to equity shareholder. Then you minus dividend, balances reserve, or you minus reserve, balances dividend. From ETH, it is two part. From earning available to equity shareholder, some part is reserve, some part is dividend. But this chapter is only till EBT. If they ask EPS, then only you have to go down till ETH calculation. Okay. Now, one thing, sir, should we prepare income statement every time while solving sums? Answer is no. But some of you will find it comfortable to do income statement and then solve DOL, DFL. So you can do income statement as a working note and not as main answer. Okay, I repeat. Is income statement compulsory every time? No. Sometimes they ask you in the question, prepare income statement. Then it is compulsory. Sometimes they ask work out DOL, comma DFL, comma DCL. Then you only need those formulas. You need contribution, EBIT, EBT. But some of you are comfortable after doing income statement, you want to do it. But that be working note one, that will not be the main answer. So if you don't do income statement also, it's okay. Clear? Now, what is PV ratio? Profit volume ratio. How do I calculate? Contribution divided by sales into 100. Is a high number a good number? PV ratio being very high. Is it a good number? Yes, because you get higher contribution for every 1 rupee sale you make. Correct? Understand what I'm writing on screen. Sales 100 rupee, variable cost 80 rupee, then contribution is 20 rupee. For PV ratio, you will do 20 by 100 into 100 is 20%. That means every 100 rupee you sell, you make 20% contribution. It's like contribution margin, also called as contribution margin. What if this is 30%? Then variable cost is 70%. What if this is 90%? Then variable cost is only 10%. Correct? Can I say this? PV ratio is equal to 1 minus variable cost ratio. PV ratio is equal to 1 minus variable cost ratio. Tell me here, variable cost ratio is 80%. Then PV ratio is what now? 1 minus 80%. 1 minus 0.8 is 1 minus 0.8 comes to what? 0.2 means 20%. Able to follow? Simple. PV ratio can also be written as 1 minus variable cost ratio. Can I write this way? Variable cost ratio is equal to 1 minus PV ratio. Yes, if 1 minus 0.8 is 0.2, then 1 minus 0.2 should be 0.8 also. These are more like balancing figures. If that is 100, this is 80, this has to be 20. Or if that is 100, this is 20, that has to be 80. Correct? Now, lot of questions in this topic can be on income statement preparation also. Always start with sales minus variable cost. You get contribution. Contribution is also called as contribution margin. Okay, CM, contribution margin. And then you deduct fixed cost, sales, variable cost, and contribution. All these three will be based on units into rate. But fixed cost will be a fixed number, not based on number of units. That's why it is called fixed cost, right? See what I'm writing on screen. If sales go up, understand slowly and then answer. If sales go up by 100%, can I say variable cost also will go up by 100%? Because of which, can I say contribution also will go up by 100%? Is this statement correct? If you're not understanding, put some numbers. Suppose sales was 100, variable cost was 60, contribution was 40. Tell me if sales from 100 becomes 200. Tell me what happens to variable cost. Will 60 become 120 or will 60 remain 60? Assume no inflation, no deflation, no discount, nothing. Okay. Now answer. If 100 becomes 200, will variable 60 become 120? It has to proportionately go up. If one unit selling price is 200, sorry, one unit selling price is 100, that means you're now selling 2 units. Then 1 unit variable cost is 60. Then 2 units variable cost will be 2 into 60. Has to be 120. Then what happens here? This will be 80. Now we observe in Calci, 100 plus 100% is 200. 60 plus 100% is 120. Same way 40 plus 100% is 80. But see after this, can I say fixed cost also will go up by 100%? No. If this was 30, will this become 60? No, this will remain 30 only. Correct? That means if I am saying sales will go up by 100%, in your mind you can understand this as contribution also going up by 100%, variable cost is also going up by 100%. But you can't understand this as EBIT going up by 100%. Am I correct? Because in between there is one number which will not change. Because of this, you have the leveraging effect. That's why you do that DOL, 1% change in sale. There is 3% reaction in EBIT. Shouldn't it be 1% there, 1% here? It won't happen because of fixed cost. Understand, if sales go up by 1%, contribution also will go up by 1% only. But EBIT will not go up by 1% because in between there is one non-moving number called fixed cost. Able to follow? Now imagine this is 30. Let's continue the discussion. What happens to EBIT? This will be 10. 40 minus 30, correct? I hope you're able to follow. What happens here? This will remain 30. Now, because of this, what happens here? This will be 50. Notice 10 went up to 50. Now, 10 going up to 50, that means increase is 40. Now, in Calci, if you do 40 by 10 into 100, you get 400% increase. What happened to sale? Only 100% increase. What happened to EBIT? 400% increase. Now, when I do 400% by 100%, I get 4. This 4 is called DOL, degree of operating leverage. Can you repeat with me? What is the meaning of 4? 1% change in sales. There will be 4% change in EBIT. But tell me 1% change in sale. There was 1% change in variable cost. 1% change in contribution. I'm changing 100 as 1. Easy. But here, this 1% is changing by 4%. Put it for this sum. What happened? 100% jump in sales, 100% jump in variable cost, 100% jump in contribution. But fixed cost did not jump, because of which EBIT jumped by 400%. So, in conclusion, every 100% change in sale, there is 400% change in EBIT. Bring it down from 400 to 4. 100 will become 1. That means 1% change in sale. There is 4% reaction in EBIT. Sales will have action, EBIT will have reaction. Some students understand it incorrectly this way. 1 rupee jump, 4 rupee jump. It is not rupee to rupee, it is percentage to percentage. 1% jump will result in 4% jump. Is it true when it falls by 1%? Yes. Then EBIT will fall by 4%. That means 10% fall. 10% fall in sales will result in 40% fall in EBIT. 10% jump will result in 40% jump. It is percentage, it is proportionate, it is not absolute value. Many have done this mistake. 1 rupee is not 4 rupee. 1% is 4%. Or you understand it as 1 time 4 times. That's also proportionate. It is a relative measurement, not absolute. It is not 1 rupee, 4 rupee. It is 1%, 4%. Yeah. This is called DOL. Can you put DOL in formula now? How did I get 4? 40 rupee divided by, sorry, 10 became 50. That means this went up by 400%. And this went up by 100%. How did I get 4? 400% divided by 100%. 400% divided by 100%. Then tell me what should be the correct formula for DOL? Percentage change in EBIT divided by percentage change in sales. Can you understand this as reaction by action? Action is sales, reaction is EBIT. First item can't be reaction. I don't know why some people have confusion in this also. First item has to do action. Other items will react. Sales go up, variable cost will react, contribution will react. But those three will react in same speed. But fixed cost will not react at all. Because of that reason, EBIT will react more. Able to follow action and reaction. It is reaction by action. 1% change here, 4% reaction. Yeah. For this, I need minimum 2 period data. Last year was 100, this year is 200. Last month was 100, this month is 200. Then only I can do this percentage calculation. What if it is single period data? Then they say use the formula contribution divided by EBIT. That is a formula for single period. Now, how to remember this? Tell me, when sales went up by 1%, variable cost also went up by 1%, contribution also went up by 1%. But your EBIT went up by 4%. Why that extra reaction is happening? Because one item did not react. Which is that item? Fixed cost. That means all this extra reaction is happening due to fixed cost. One number above fixed cost, one number below fixed cost. Easy to remember the formula. First, understand the concept. Extra reaction is because of fixed cost. Therefore, one number above fixed cost, contribution, divided by one number below fixed cost, EBIT. Okay, now you answer. What is the meaning? If in question they say DOL is 3 or 1% change in sales, there will be 3% reaction in EBIT. Always understand this as change. Change can be both upside downside. That means 1% fall, 3% fall. 1% jump, 3% jump. What will happen if sales go up by 10%? EBIT will go up by 30%. Because 1 is to 3 is the reaction. 1 time to 3 time is the reaction. Able to follow? Now you answer. What if sales fall by 100%? EBIT will fall by 300%. What is the meaning of sales falling by 100%? Whatever is the sale will come down to 0. 100% fall of any number will take you to 0. 7 minus 100% is also 0. 75 minus 100% is also 0. Any number minus 100% is 0. There are some questions. If you remember in the class also we worked out what will happen if sales reach 0. What is the meaning of sales reaching 0? Wherever you are, you have to reach 0. How to reach 0 from any number? Fall by 100%. If sales fall by 100%, then EBIT has to fall by 300%. Okay. Sometimes I can ask reverse working. Keep this number in mind and tell me how much of sales should fall for EBIT to become 0? I repeat my question. How much of sales should fall for EBIT to become 0? How to do this? You don't need cross multiplication. You can use calc and give a try. I repeat. How much of sales should fall for EBIT to become 0? Just now I told you something. Repeat with me. For anything to become 0, what should happen? It should fall by 100%. That means if I am saying EBIT should become 0, that means EBIT should fall by 100%. Now, what is the meaning of DOL is equal to 3? 1% change in sale. 3% is the reaction in EBIT. I want EBIT to react by 100%. That means this is the way. Some students will put 100 here and say 300%. You understood my question? How much of sales should fall for EBIT to become 0? Then this should be 100%. Fall, obviously, then this should also fall. It can't happen that this is falling but this is going up. That's not possible. If sales is falling, then variable will fall, contribution will fall, even EBIT will fall. It is in same direction, but the proportionate reaction can be more or less. All fine. Now, this formula is up to D to EBIT. Now, what is there after EBIT? Say this is 30. What comes after this? Interest, say 10. This will be now EBT, say 20. You answer my question. If this goes up by 100%, this will now be 60. Tell me, will interest also go up by 100%? No. If my EBIT is going up, I will not pay double interest to bank. I will still pay same interest. Now, because of this, observe, this will go up to 50. Now use calci. What should happen? This 30 went up to 60. That means the jump was 100%. Jump, so I'm writing plus. Correct. This 20 went up to 50. How to find out percentage increase? T rupee by 20 into 100. What's the jump? 150%. Can you put it in sentence now? 100% increase in EBIT, there is 150% increase in EBT. Now use the same logic that you used for DOL. What should be the formula? 150 by 100, reaction by action. Not action by reaction, I told you. Reaction by action, do in calci. 150 by 100 will come to 1.5. Can you explain in one sentence? What is the meaning of 1.5? 1% change in EBIT. There will be 1.5% reaction in EBT. Sir, why are we not going below EBT? Tax is also proportionate. If your EBT goes up, tax will go up. Below everything is again proportionate. Able to follow? Now you answer. What happens when 30 becomes 0? Will 20 become 0? I want your answer. If 30 becomes 0, what happens to 20? Will it be 0? No. How much will that be? Minus 10. Because this 10 will still be there. Then this will be minus 10. Instead of doing this, what is the shortcut? If 30 becomes 0, fall is 100%. Just now you told me 1% action, 1.5% reaction in calci. That means it will be 20 minus 150%. 20. Why minus? Because it is falling. 20 minus 150% will come to minus 10. Able to understand? You should give a try. If 30 becomes 80, use calci and do whatever calculation you want. If 30 becomes 80, how much will be my EBT? Give me the number. 30 becomes 80. How much will be EBT? I know one way easy. Sir, this is 10 only. So this should be 70. But without doing this, can you give me the answer? 30 becoming 80. How much is the increase? 50. In calci, 50 by 30 into 100 will tell you percentage increase. 166.66%. And if you remember, this leverage was 1.5 times. You did it 2 minutes back. Yes. That means 166.66 into 1.5 times reaction. That comes to, I think, 250%. Correct? Now this is jumping. That means in calci you should do 20 plus 250% jump. How much is 20 plus 250% jump? 70. So you don't have to prepare income statement every time. First you find out the leverage. That was 1.5. We did 30 by 20. Correct? Now tell me what should be the formula for DFL? Reaction by action. What is the reaction? Percentage change in EBT divided by percentage change in EBIT into 100. Now for percentage change, you should have two data, 2 months, 2 years, first half, second half. What if you have single period? Can you tell me what was the logic we used for DOL single period? This extra reaction was because of fixed cost. So we said one number above fixed cost, one number below fixed cost. Now you decide what should be the formula for DFL. This extra reaction is happening because of fixed interest. That means one number above and one number below the interest. That means it is EBIT by EBT. You don't have to mug up if you understand DOL is because of fixed cost, one number above, one number below. DFL is because of interest. What is one common thing between fixed cost and interest? Both will remain same. Everything else in your income statement keeps changing. Only these two will remain same. One is because of rent, fixed cost, another is because of interest. First one creates operating risk, second one creates financial risk. Now, if you combine both, easy to answer. What is this called as now? Degree of combined leverage. Now tell me, you decide, don't cancel. This should be reaction by action for entire income statement, topmost to bottommost. This one was sales up to EBIT, and this one from EBIT up to EBT. Now, when you say topmost to bottommost, that means this should be for every 1% change in sales. What is the reaction in EBT? Topmost to bottommost. But if sales is changing, variable is also changing. If sales and variable are changing, contribution is changing. Therefore, I can replace the word with contribution to EBT. Now we observe formula is contribution divided by EBT. Actually, it is DOL into DFL. And when you do that, EBIT will get cancelled. It is contribution by EBT. What are the numbers between contribution and EBT? You have fixed cost, you have EBIT, you have interest. Now both fixed numbers you have to take out. So take out fixed cost, take out interest. What is left out? Topmost contribution, bottommost EB. Easy. Now tell me if you have to go by bookish way of formula. Combined leverage should be equal to DOL into DFL. What's the formula for DOL? Contribution by EBIT. And this is EBIT by EBT. And then you cancel these two. What is left out is contribution by EBT. Contribution is coming after variable cost and sales, and after EBT comes tax and EAT. And you notice if sales is going up, same percentage variable is also going up, same percentage contribution is also going up. Here in the bottom, if EBT is going up, tax will also be up. Accordingly, EAT will also be up. Anyway, say tax is 30%. If number EBT goes up, then 30% on a higher number, even tax will go up. Correct? Now, answer from top to bottom. First comes sales minus variable contribution. Can I say all three will react in same speed? After that, there is one item which will not react at all, because of which EBIT will react little extra, and that is your DOL. Then comes interest, which will not react, which will remain same, because of which you answer. Now what happens? EBT will react little extra. From top till here is DOL, correct? From EBIT till here is DFL. That means when you combine from top to bottom, this should be DCL. And I'm continuing this for your reference from EBT, tax, and what you have is EAT. Tell me these three also will go up and come down together. And assuming no preference shares, this EAT, if you divide by number of equity shares, this itself will lead to EPS. That means we are trying to connect topmost item sales to bottommost item EPS. First three can be counted as one: sales, variable, and contribution. Bottom three, EBT, tax, and EAT, can be counted as one. First three items which will react, last three items which will react. In between two items which won't react, fixed cost and interest. Because those two items are not reacting, EBIT will react extra for 1% change, 4% reaction. Same way EBT also will react little extra. All okay. Only these three formulas you have in this chapter. Plus, there is one small discussion on return on capital employed. This theory, you have to mark it important. If you don't have book with you, make a note. Business risk and financial risk can be asked as a theory short notes question. Business risk, financial risk can be asked the theory question. And I get this question every time from students. Sir, if they ask difference between two things and question is for 3 marks, how many differences to write? 3 differences to write. 1 mark, 1 difference. 4 marks they are giving, 4 differences. By the way, 4 difference doesn't mean 1 point here, 1 point here, 1 here. Don't count it as 4. It's only 2 points. 4 points of differences. Okay. Any theory question in costing FM accounts, to keep 1 mark, 1 point. 4 marks theory, minimum 4 bullet points you have to write, or 4 differences you have to write. Yeah. And the other, okay, these are the formulas which you can mark as important. I have covered all of this in last 20 minutes. Those who have formula book, this is already there in the formula book. Those who are watching on YouTube, formula book soft copy also will be shared with you. Check the description, you will have regular batch book and formula book, both PDF links you can download. Okay. The only other formula is this return on capital employed. This is there even in ratio analysis. Return on capital employed is basically EBIT divided by total capital. When you say total capital, it is debt plus equity. EBIT is the money that you earn from day to day business. Yeah. ROCE is measured in percentage term. Any rate of return is measured in percentage term. So this is ROCE is equal to EBIT divided by total capital employed into 100. One more thing in this topic, when is it considered to be good when it comes to debt? Is having debt good in simple? Answer is yes, with a condition. Your ROCE percentage should be greater than the rate of interest on debt. If rate of interest is 8%, if you are having 8.1% also, this is considered to be a good idea to take debt. If this is 9% and your return on capital employed is 8.1, that means you have to pay 9 rupee, and using that money you are making only 8.1. You will have a shortage of 0.9% at the end of the year, which you have to bear from your pocket. Then taking loan is a bad idea. What if both are 9%? There is neither an advantage nor a problem because of debt. That is there here. When now ROI is return on investment, return on capital employed. If it is greater, then it is favorable. Taking loan is a good idea. But if it is less, then it is a bad idea. You should avoid debt. If it is equal, it is neutral. What is the meaning of neutral? There is neither an advantage nor a problem because of debt. Is debt available? Take it. But will shareholders make extra money because of the debt? Answer is no. There is neutral effect. No plus, no minus. Okay. Yeah. In this chapter, for you to solve problems, this financial break-even point is separately discussed in capital structure. Not to worry now. What to solve from this? Just make a note. Do 1 or 2 questions on DOL, DCL, DFL calculation, basic level sums. Then do few questions with reverse working. What do I mean by reverse working? They have given DOL, DFL in question and they want you to do income statement. Practice some questions where reverse working is to be done. Okay. And this chapter is suitable for MCQ according to me, more than descriptive, because majority of this is around those 3-4 formulas. So can be asked in MCQ segment also. Okay. And those who are getting confused, only you can make a note. ROI doesn't mean rate of interest. ROI is return on investment, also called as ROCE. ROI is not rate of interest. ROI is return on investment. The other name for return on investment is return on capital employed. Return on capital employed, ROCE. How to measure this? EBIT divided by total capital employed into 100. Total capital includes shareholders' money plus debt. All right. This is about risk and leverage. Okay. Moving on to the next topic, cost of capital, chapter 4. This is a topic with little more formulas involved. Other than ratio analysis, if there is a topic with more formulas, then that is this. Yeah. So capital is all sources, debt, preference, equity, reserves. So in this topic, you will study how to calculate cost of debt, cost of preference, cost of equity, and cost of reserve. Initial discussion is on cost of debt. If you can recall, you have studied cost of debt, two varieties. One, without redemption. What happens in case of without redemption? Forever you have to pay interest, correct? And then second variety is with redemption. What happens here? After 3 years, 5 years, 10 years, the principal has to be repaid. That means interest will be paid only for limited period. Make a note, if you do not know, without redemption debentures, it's also called as perpetual debt. Perpetual means forever. Cost of capital, first pointer you want to make a note. Debt without redemption is also called as perpetual debt. Perpetual means forever. That means the investor will continue to get interest year after year after year. He will never get back principal amount. Second variety is with redemption, where he'll get interest for few years and then the principal will be repaid. Redemption means repayment of principal. Yep. Now, cost of debt without redemption. How to do KD without redemption? You have to continue pay interest, correct? And whenever you pay interest, you save taxes. KD is equal to I into 1 minus T divided by net receipt into 100. Quickly, I want your answer. This interest, normally it's a percentage. Interest rate has another name. Do you remember? Interest rate is also called as coupon rate. Yeah, don't get confused. Coupon rate is not premium rate or discount. It is interest rate. Yeah? Interest is always paid on face value. You may issue a debenture or a bond at par premium or discount. The interest is always on par value. Why do we do 1 minus T, by the way? Because anything we pay here, say 8 rupee, that 8 rupee gets debited to P&L, and 8 rupee you debit to P&L, profit will come down by 8 rupee and tax will come down by 30% of 8 rupee. So it is 8 you pay, 30% of 8 you save, divided by, suppose a bond was issued at par or debenture was issued at par. So this is 8 into 1 minus 0.3 divided by 100 into 100. What if this was issued at 2 rupee premium? Then net receipt will be 100 plus 2. What if it was issued at 1 rupee discount? Then 100 minus 1. In all the cases, 8 rupee interest will remain 8 rupee only, because that was 8% on par value. And don't expect in question that they print 8% on par value. They simply say 8% debenture. That means 8% is always and always on par value. Such a silly thing. Many students do mistake. Debenture may be issued at par premium or discount, but interest is always, or coupon rate is always on the face value. I'm writing few things. Observe. 8% debenture of 200 rupees issued at 5% premium. Tax rate is 30%. Find out cost of debt. When they ask you to find out cost of debt, first you have to pay interest, and 8% is always on the par value. You shouldn't worry about premium or discount. That means 8% on this first comes 16. This you have to pay. And anything you pay, you will debit to P&L, and anything you debit to P&L, you will have the tax saving. Sometimes they write pre-tax KD. What do you mean by pre-tax KD? Only I. If they say post-tax KD, then it is I into 1 minus T. Some students, in question they say post-tax KD, on that these people do 1 minus T again. When question is already post-tax KD, that means they have done 1 minus T. You don't do once again. If they say pre-tax KD, that means it is only I. You have to do 1 minus T. Okay, make a note if you want. Observe in question. whether it is pre-tax KD or post-tax KD. If it is pre-tax KD, you have to do 1 minus T separately. If it is post-tax KD, you have nothing to do. Correct? I repeat, if question has pre-tax KD, then we have to do 1 minus T. Full stop. If question has post-tax KD, then we can take it as it is. Then we can take it as it is. Most of the questions they will print simply interest rate 8%. That means it is I. I is pre-tax. It is not 1 minus T. You have to do 1 minus T. Okay. Divided by, tell me, 200 rupee debenture. We are issuing it at 5% premium. That means we won't collect 200. We will collect 200 plus 5%. That will be 210 into 100. Easy way. What I pay divided by what I get. I means company. We are learning this chapter from company's angle, cost of capital to the company who is taking money from people, investors. I pay 16, I save 30% on 16, but I have received 210. What if the same thing is 5% discount? No change, only this will now become 200 minus 5%. This will be 190. Interest will still be same 16 rupee, tax will not change at all. Okay. Sometimes they say when you issue a debenture, you have to pay 2 rupee charges. You remember it is called flotation cost. You pay these charges sometimes to ROC, sometimes to SEBI, NSC, BSC, government duties, etc. etc. Then this 2 rupee should also be minused here. That means what is coming to you is only 188. 200 rupee minus the discount 5% on 200 minus the 2 rupee charges that you pay. One important area. Sometimes this flotation cost they give it in percentage, say 2%. Now tell me, this 2% should I apply on 200 or should I apply on 190? Which one is correct? You understood the question? I repeat, they say flotation cost that you have to pay to government is 2%. Now should I do 2% on 200 or 2% on 190? It is on 190. But in question itself, if they say 2% on face value, then this will be on 200. You know what is the correct way to understand? 200 is face value, 10 rupee discount. So 190 is your issue price. It is issued at 190. On that, I have to pay 2% to government. Following, I'm writing one thing. Observe, interest 9%, face value 100 rupee, issued at 3% premium. Flotation cost 5%. Tax rate is 35%. Tell me how to do KD. Go ahead. Tell me what to write. Interest 9% should be on what? 100. Without worrying anything, it should be on 100 into. We save 35. And 1 second. I don't know why I should tell you, but I still say this every time. 30%. Don't mug up this. Some questions have 35. Some questions have 40% also. Lot of students. Question has 40%. These guys do at 30%. Question doesn't say you take 30. Lot of questions you remember in class material also you have 35% tax. If they give 35, you don't go by question. Don't change the question data. Okay. Divide by what? Divide by what? How much is net receipt to us? It should be 100, but you won't get 100. First you give, sorry, it is issued at 3% premium. That means first you have to do 100 plus 3. Now tell me this 103 is called as what? Issue price. Correct? And then flotation cost, we have to pay 5% on 103. Happening in Calci, can you do this? 97.85. And numerator? No, after this. 9 into this. 5 point into 100, you get the answer. 5.97 approximately. Okay. These are good 2 marks MCQs. Yeah. Tell me, if they say flotation cost is 5% on face value, what change I have to do in my answer? This 5% will be on 100. Correct? Now in Calci, 100 plus 3 minus 5. This will be 98. Then the answer will also slightly change. 5.8, 5.96. Correct? So this you have to check in the question. They sometimes just give 5% full stop. Then it is on issue price. But if they say on face value, then only you have to take it on 100. And again, don't mug up 100. In question, if they say 300, it is on 300. This face value number. Okay. Is this clear? Without redemption. Now, what happens when it is AD with redemption? Today you will collect net receipt. Say 5 years later, you have to repay also. Yeah, I'm writing some numbers. Observe. Today you are issuing it, and 5 years later, you have to redeem it. Say 100 rupee face value. All of you focus on the screen. You are issuing it at par, redeeming it at par. Any gain or loss to you? You means company. Any gain or loss? No. You are issuing it at par, but you have to redeem it at premium. From company's angle, tell me, is it a gain or a loss? Loss, 5 rupee. And when will this happen? After 5 years. That means this is not 5 rupee every year. This is 5 rupee for a total period of 5 years. If I want annual loss, then 5 by 5 years it will be 1 rupee annual loss. Able to observe? Okay, you answer now. Issued at discount, redeemed at par. Now what happens? Issued at discount, face value 100. So issued at discount, redeemed at par. Now what is happening? Again you are losing 2 rupee. Correct? I'm writing L, loss. But this is 2 rupee for total 5 years period. Now 2 by 5 when I do every year, I have to count zero point 0.4. Why am I converting it to per year? Because interest you pay every year. Tax calculation you do every year. That means loss should also be calculated for every year. That's the reason. Say third possibility. Issued at par, redeemed at discount. Now tell me, from company's angle, you gain because today you are collecting net receipt, issuing the debenture at 100. 5 years later, you repay only 95 rupee. That means you make 5 rupee gain. Now 5 rupee by 5 years will be 1 rupee gain every year. So I'm writing with negative sign because interest is a cost. Gain can be taken with a negative sign. Following another case, issued at discount, redeemed at premium. Now tell me, today you are collecting less. 5 years later, you'll be paying much more. That means totally you are losing 10 rupee, right? But every year you have to count only 2 rupees because you have 5 years period. All okay? Which means when the question is only interest payment without redemption, formula was simply this what I pay divided by what I get. But if it is question with redemption, first of all, I have to pay every year interest, and then I have to take loss or gain on redemption. Tell me, how did we get these numbers? 1 rupee, this number, the difference between these two, correct? Redeemable value minus the net receipt, issue price or net receipt. So this will be RV minus NR. Tell me one second. RV is what will go from my pocket in future. NR is what is coming to my pocket today. So it is more like cash outflow minus cash inflow. The difference can be either gain or loss. But this I can't take it as every year loss. I have to divide by number of years. When I do this, I'll get to know per annum. Why per annum? Interest is per annum, tax is per annum. Therefore, even this should be per annum. How to convert total to per year? Divide by number of years. If they say 5 years, divide by 5. They say 4 years, divide by 4. Denominator used to be only net receipt because we only knew how much is coming to us. But now we know how much is going from our pocket also. So we take the midpoint, RV plus NR by 2 into 100. Okay. Sir, what if it is gain? If it is gain, net receipt is 100, future is 98, then automatically number will be minus 2. You don't have to change the formula. Plus into minus will become minus. Interest 8, 1 minus zero point 0.3. This will be minus whatever 40 paise. Correct? Don't mug up this as plus or minus formula. You keep it as plus, it will automatically become minus. This I have cautioned you in the class. Some students mug up plus and minus, then minus into minus, they make it plus. Correct? Formula you mug up as plus only. If it is minus, while solving, it will automatically be minus. Yeah? Give a try. 100 rupee debenture issued at 2% discount, redeemable at 8% premium after 4 years. Okay. Flotation cost 1 rupee. Tax rate 30%. Interest rate 9%. Okay. Tell me what all I should write. First, I have to count what? You don't have to write. You can do in calc. What all to be taken? I into 1 minus t. Tell me what are the numbers? 9 rupee interest and I save 30% tax on this. One portion is done. Then what to do? RV minus NR. This will be redeemed at 8% premium. 100 rupee debenture at 8% premium will be 108. This will be my future cash outflow. And today I am issuing it at 2% discount. That means I get only 98, but not even 98. There is flotation cost of 1 rupee. That means I get only 97 today. If flotation cost is not there, then you are correct, 98. Yeah. But this will happen after how many years? 4 years. This will be average now 108 plus 97 by 2 into 100. Anybody this portion? 6.3 plus this portion 2.75 whole divided by 102.5, 8.82%. These are the kind of questions they ask in 2-mark MCQ. Yeah. If it was without any redemption, then tell me what all will stay in the answer. I into 1 minus t by NR into 100. Because there is RV, I have to do RV minus NR by N, then RV plus NR by 2. Why am I doing this plus this by 2? So that I get the midpoint of what is coming to me today, NR, and what will go from me, RV. I want the average number. Correct? This is clear. This formula has a name, approximation method. They say calculate KD using approximation method in exam. They won't say formula method. You know it as a formula based method, but its correct name is approximation method. Okay. Now, same KD can be worked out with another method called YTM, yield to maturity, and here we follow IRR technique. Now, what happens in IRR? Year 0 should be negative, and year 1 to say 5 years, what all will happen? Interest into 1 minus t. If question says assume no taxes, then it is simply I. Pre-tax, post-tax will be same when tax is not there. Then what will happen in the last year? It will be redeemable value. Yeah, more like this 98 rupee. I'm just writing some numbers. Every year you pay 11 rupee interest, 1 minus tax, and you will redeem it at par value. Sir, why should year 0 be negative? That's when IRR works out. Year 0 outflow followed by series of cash inflow. So first negative, then every year. Why did I write 1 to 5? Because every year interest is same. Correct? When the number is same, I can club it. This we studied even in capital budgeting. Correct? And fifth year is a redeemable value. Some students have confusion as to what to be taken here, year 0. Okay? Careful. If it is a new issue, if it is existing debenture, two possibility, either debenture is already there. If it is already there, you have to take the ongoing market price. Suppose we have debenture issued 5 years ago, we have the market price. But if it is new issue, there won't be any market price because we haven't even issued. Then you have to go by issue price. At what price I'm issuing for the first time. Okay, easy to understand in exam. For a new issue, how can there be market price? I haven't even issued it, correct? And if it is already existing, why will I go for fresh issue when you already have it? You go by market price. Understanding? Suppose a company is planning to issue debentures. How can they have MPS now? They're still planning to issue. That means they can only give you issue price, the price at which they want to go for fresh issues. But if a company has a debenture from last 5 years and that is traded in the market, then you can get its market price per share or debenture. Okay. All those who are watching on YouTube, this soft copy has all of this, the formula, the table of issue, redemption, gain, loss that I discussed, and the formula here, and also the YTM that I discussed. New issue, current market price in case of existing debenture. Okay. Now, sometimes the debenture, today they issue, but redemption will not happen in one go after 5 years. They say every year we will repay some portion. Understanding what I'm saying? Suppose 1000 rupee debenture. Normally, what should happen? Today, 1000 rupees invested. 5 years later, 1000 rupees repaid. But what if company says we will repay you 200 rupee every year? Now you see what happens. Year zero will be 1000 rupee. Year one, two, three, four, five. Every year, some principal will come back. Think from investor angle, some principal plus every year interest. Suppose interest is 8%. First year, 8% on full 1000. But next year, 8% will be on 1000 minus 200 because some principal is repaid. Correct? This will be only 64 now because it is 1000 minus 200, 800 on that 8%. Suppose 8% is the interest. Then next will be 1000 minus these two. So 600 on that. This will be only 48. Then this will be 32. I hope you are able to follow. If you need calci, use it. 1000 minus 200 on that. Minus one more on this. Now you would have already repaid 800 rupee. On 200 when you pay, interest will be only 16. If they say 30% tax, then interest will have 1 minus t. Remember, principal will never have 1 minus t. On principal, there is no tax. On interest, there is tax. If they say no taxes, then you don't have to worry about this. Now, this will be 280, correct? 264, 248, 232, 216. Now you work out IRR. You know how to do IRR, we have studied. You take discounting factor at 10% and so on. And that is your YTM. By the way, I think I forgot to tell you, YTM, yeah, follows IRR method. That means you put the number and then you have to do trials now. Correct? DF, DCF, and this number has to be 0, but it won't be 0, it may be some positive 20. Then you will try one more. Remember this? Then you may get negative, and then that cross multiplication circus has to be done. When can I write 1 to 5 like this? When every year only interest is paid and the amount is same. But if principal repayment is also happening every year, then principal will be same, but interest will differ. This is applicable even if they say bond or debenture. On both interest is paid, tax treatment is same, correct? And these are now my cash flows. And in IRR logic, I will then take one discounting factor and try to get DCF value and NPV to be 0, but it won't be 0, you know very well. This is 1, this is 0.909 and so on. This may be some positive number, then you need one more trial and so on. Finally, you'll get the answer. But now the answer will not be called IRR, answer will be called K. Getting it? This is cost of debt using YTM method. So three things we discussed. First, cost of debt without redemption. Second, cost of debt with redemption using formula. We call it approximation method. Next one we did is cost of debt using YTM method. Next important thing is calculating cost of debt with convertible debenture option. Tell me what happens in convertible debenture question. Say, suppose 5 years period. What happens after 5 years? Investor will have an option. Either he can take shares of the company or he can take cash. Is it investor's choice or can company tell him you should take shares or you should take cash? Or is it mutual discussion? No, no discussion involved here. The investor will decide. I want shares, then he will say I need shares. No question of negotiation, discussion, etc. etc. If he says I don't want shares, give me cash, then company should give him cash. So everything same. The formula. Every year you have to pay I into 1 minus T. But this RV number, we do not know. We do not know because he has two options. Which two options? Either he may take cash or he may take shares. Cash will be easy to work out. Par premium discount will be mentioned in the question. But shares, we should be careful. They will give you one ratio in the question. This is a convertible debenture with 1 is to 10 option. What do you mean by 1 is to 10 option? One debenture can be converted to 10 equity shares. But remember, one silly mistake students do. This conversion, will it happen now or after 5 years? That means the share price that you take, 10 shares into that share price, should not be price as on today. I think you know this. P0 means price today. You should take fifth year price. But sir, problem is standing today. How will I know what will be the price after 5 years? That you have to predict. Now, how to do that? They'll give you in the question. As of now, share is traded at 31 rupee in the market. It is expected that the share will grow at 5% for next 5 years. Now in Calcium 31, if you do plus 5%, plus 5%, 5 times, you will get to know what will be the price after 5 years. Okay. If you're doing in Calcium, I'll wait. 31 plus 5%. Once again 5%. Once again 5%. Once again. 5 times. Anybody? 39.56. That means this share will be worth 39.56 after 5 years. And I am eligible to get 10 shares. That means 10 shares into 39.56. Shares will be worth 395.6. What if cash is only 100 rupee? Then I'll say I need shares and not the cash. What if cash itself is 400 rupee? Then I'll say I need cash. That means investor will go by whatever is better to him. So can I say redeemable value is higher of cash or shares? Correct? Redeemable value is the higher of the above, higher of the below. First, cash, which will be printed in the question. Second, shares. Now there is one more style. You did in Calci 5% 5 times. The correct way is 31 rupee today will grow at 5% for 5 years. This is more like compounding formula. Correct? How much is this? 5% 5 years? 1.1.05 to the power 5. 1.27 something. And then if you multiply that with 31, you'll get the 39.56. This is a better way to present in exam, but I know you'll still do this only in Calc. Your call. MCQ, anyway they won't check also. Anything is okay. But this is the way, and the mistake students do, they directly do 10 shares into 31 rupee. 31 rupees current market price. You are not converting the debenture to share today. You'll be converting after 5 years. That means you should be taking fifth year number, not current number. Be very careful. If you want, make a note. While solving convertible debenture question, price of the share should be on redemption date, not current date. I'll wait. Make a note. While solving convertible debenture question, while solving while solving convertible debenture questions, share price to be considered is on the redemption date, not current date. Share price to be considered is on the redemption date, not the current date. What does that mean? If P0 is given in the question, that is price as on that day, and redemption will happen after 5 years, that means you should take P5, not P0. Okay, and this 1 is to 10, 1 is to 5, 1 is to 20 will be printed in the question. You will not have to decide the ratios. All right. So tell me, any question which has conversion option, what is the first thing that we have to decide? Any question that has conversion option, what is the first thing we have to decide? Whether investor will take cash or shares. Correct? Higher of the two will be redeemable value. Cash will be straight simple. Only shares you have to do. Number of shares into price today with growth for next 3, 5, 8, 10 years as per the question. Done. So these are the things related to debt. Then coming to preference share. Tell me what is the similarity and difference between preference shares and debenture. First tell me the similarity. For both we have to pay fixed percentage. Correct? Percentage may not be same, but the commitment we have to keep 8% means we have to pay 8%, no flexibility. Okay. What is the difference between these two? Here you will save tax. Correct? Here you will not. Correct? That means when I do the formula KD, I wrote I into 1 minus T by net receipt. Now when I am doing KP, this should not be interest. I'll be paying them dividend. But will I be doing 1 minus T? No, to be divided by net receipt into 100 here, into 100 here. No change there. Okay. Since you will be paying equity dividend also, to avoid the confusion, they write it as PD, preference dividend. All okay. Preference dividend divided by net receipt into 100. Again, here also there can be RV minus NR by N, etc. etc. Even preference share has to be redeemed. One day before exam, you don't have to solve any question on this segment. You only have to go through the change in the formula. Instead of writing I, you should write PD, and 1 minus T you should not write. No use in solving questions on KP separately. Yeah. Last thing is cost of equity. This has many formulas. Okay. Let's revise one by one. First one is constant dividend model. Constant dividend is also called as no growth. Correct? Tell me what should be the formula for cost of equity. You have to pay dividend and this will be NR. But instead of writing NR, only for equity share, our books write P. Yeah. Is it P0 or P1? P0. If you buy share today, then you will earn dividend after 1 year. Therefore, this should be properly understood as D1 by P0. Correct? Can it be D0 by P0? What is wrong? P0 means price as on today. That means I'm planning to buy the share today. If I buy share today, I won't earn dividend today. Correct? Can it be D1 by P1? What is wrong if I write D1 by P1? What is P1? Price after 1 year. If I buy share only after 1 year, how will I get D1? I'll get D2. Guys, understand, I keep bank FD today morning, I won't earn today afternoon. I have to wait for 1 year. That means investment is year 0, return is year 1. That means P0 I invest, D1 I will earn. Can I go to bank and say I'll invest next year, you give me interest that day? That is when your D1 by P1 is correct, which doesn't make sense. They say you invest today, P0 price, market price of equity share as on today, and you wait for 1 year, you will get D1. Correct? What is wrong if I write D0 by P1? You will get dividend today, but you will buy the share after 1 year. Even discussion on this is wrong. Correct? Forget whether answer is right or wrong. Even we should not discuss how will I get dividend today and buy share after 1 year. Understand, only 4 combinations and 3 are wrong in that. You have to buy at P0, you will earn D1. Correct? But book simply writes D by P. Correct? P should be understood as P0. D should be understood as D1. But because it is constant dividend, today's dividend, tomorrow's dividend, 5 years later, D5, D7, D29 will remain same. Therefore, book doesn't mention D1, they simply say D, because D1, D2, D3, D5 is all same D. Okay. Second formula is constant earnings. Constant earning per share. This will be KE is equal to E by P0. Only difference is instead of counting dividend as your income, you should count EPS as your income. Now, out of EPS, some money is kept in reserve and some money is paid as dividend. So, first one considers only the cash income to the investor. Second one is cash income dividend plus the reserve portion. Both are considered. Okay. Third one is most commonly used, that is growth model, which is given by Gordon, and hence this model is called Gordon's growth model. Here he says cost of equity is equal to D1 by P0 plus G separately. Now, I get one common question from many students in this particular formula. Let me clarify. How to get D1? D1 is today's money or future money? Future money. D1 is 1 year later. Right? So in question, I'm discussing the doubt part here. In question itself, if they give D1, you can copy directly. Sometimes they'll give you D0, but I want D1. How to go from D0 to D1? I have to add the growth. That means in question, if they say dividend expected at the end of 1 year, that means question already has D1. I repeat my sentence. If question says dividend expected after 1 year, dividend expected at the end of the year, future dividend, planned dividend, proposed dividend, they're talking about future tense. That means they're referring to D1. There may be 3% growth in the question. On 7, don't apply 3% again, because question already says dividend planned, dividend proposed, future dividend. Correct? But if question uses the word current dividend, present dividend, right now, at present, that means they're talking about D0. But I can't take D0 in the question in the answer. Then how to reach from D0 to D1? In calci, 7 plus 3% on 7. That you should take in the answer. Able to follow? You know what many students do? They take D1, on that they apply G. Tell me, you take D1 and then apply G, you are taking D2 now. But formula is not D2. Formula is D1. Yeah. I repeat, just today morning, before I came to this class, I have this message. Sir, in one question they have taken D1, another question they have added G. What to do? Now, what to do? Read the question proper. If question says present, current, as of now, that means they're talking about B0, then you have to add G in calci. If they say proposed dividend, future dividend, at the end of the year, next year dividend, just you read English properly, you don't need formula for this. Proposed, planned, future, expected, that means they're talking about D1. Okay. If they say at present, as of now, currently, in the past, consistently, that means they're talking about as of now only, they're not talking about future. Clear? Now answer. I have a question to you. See what I'm writing and tell me what should be the calculation. Company is currently paying 3.5 rupee dividend. Price is 41 rupee. Growth is 2%. Tell me how to do. Use calci. Use calci. What should be the numerator? Should I count 3.5 or should I do plus 2%? Why plus 2%? Because the wording is currently. Currently means they're talking about D0. But I want D1 in calci 3.5 plus 2%. 3.57 divided by 41 plus G. G should be not 0.2, 0.02. 0.2 is 20%. Correct? Hope you're understanding. And final answer you do into 100. Anybody? 10.7. Now, by the way, some students have one more doubt. Sir, we have already done plus 2% while getting this. Should I do this 2% once again? You should, because from D0 to D1 there is growth. From D1 also, D2, D3, D4, D5, forever it will grow at 2%. So this 2% has to be added separately even if you have done 2% here. Okay. See on screen, I'm changing one thing. Tell me what should be done. If they say dividend at the end of year 1 is 3.5. Now tell me what change I have to do in my answer. This will be 3.5 by 41 plus 0.02 I have to do. What is the number now? 10.53. I hope you understood when to add G, when not to add V. You have to read question slowly. Did you understand? Anyone having question, doubt on this? No. If they say historically company has been paying, that means they're only talking about past and present, not future. You want D1, not D minus 1. You don't want past dividend, you want future dividend. Because if you buy P0, you won't get last year dividend, you'll get next year. You have to wait for 1 year. Okay, is this clear? Everybody. And do you remember this discussion? Formula was KE is equal to D1 by P0 plus G. Who gave this formula? Gordon. He shifted this G here, KE minus G is equal to D1 by P0, and then he did a cross multiplication, KE minus G into P0 is equal to D1, and then he said P0 is equal to D1 by KE minus G. This is there in dividend decision topic, but there he won't say D1, he says earning into 1 minus reserve. Earning into 1 minus reserve is nothing but D1 only. Correct? E into 1 minus B by KE minus G. And many had this doubt, sir, why are we deducting growth? You're not deducting growth. You had plus G only. You shifted that side. That's why it became minus G. And anything you deduct in the denominator will only help you to get a bigger value. You're not deducting from numerator. You're deducting from denominator. Okay. So it is KE minus G, not KE plus G. Okay. Now, constant dividend, constant TPS, growth model, and the fourth one was realized yield approach. What is this realized yield? Again, IRR method. Remember, this yield was there in YTM also. Yield to maturity. Somebody is planning to buy a share today for 800 rupee, and he'll keep the share for 3 years. Every year he will get 80 rupee, 80 rupee, 80 rupee dividend, and then he'll sell that share for 935 rupee. Now see, this is more like IRR pattern now. Year 0 outflow, followed by year 1, 2, 3 inflow, and instead of scrap value, you have sale value. Correct? And then you have to take a trial discounting factor and then do DCF. Your goal is to reach 0, but you know that will not happen. Maybe plus 40, then do one more trial. You know this song now very well. This will be one more, and then this may be minus 8, and then you do cross multiplication. Suppose you get 22%, that becomes cost of equity. Obviously, there won't be 1 minus t because you are doing dividend. There is no 1 minus t for dividend. If it was interest, there will be 1 minus t. For dividend, there is no 1 minus t. Yeah. Last one, first constant dividend, then constant EPS, then growth, realized yield, and finally you have capital asset pricing model, CAPM. Let me discuss that separately. CAPM model. You remember, cost of equity is equal to an investor will expect minimum risk free rate of return, correct? Plus, market will anyway give him slightly more than risk free rate of return, but he is investing in a specific stock, and that specific stock has a risk relative to market. If market reacts by 1%, your stock may react by 3%, correct? And that relative risk is measured by beta. And when you discuss the CAPM, there was some theory important story on two types of risks: systematic risk and unsystematic risk. Make a note, this is very, very important theory, concept, and they can ask question also. 2 marks or 4 marks. Theory short notes. Yeah. Systematic risk. Name itself says that it is same, common, equal to everybody. Unsystematic is when it is specific to a particular company. Particular stock will react. Overall market may not. Yeah. Listen to me carefully. This is there in your book also. Two varieties of risk here, unsystematic and systematic. Please mark it important and make a note. Read this theory one day before exam. And students will understand the concept in exam. Exact reverse answer they write. For systematic, they write unsystematic answer and vice versa. Easy to remember, when the word is systematic, it should be common to all. If there is a risk that is to every company in the market, then it is systematic risk. Yeah. Bad budget, government collapsing, election result, war situation, it will impact every single stock. Lockdown, these kind of things. RBI policy also, inflation, monsoon, all these are reasons. But unsystematic risk is when something affects only a particular company's stock. Okay. If you are following the news, some bad news about that company, and that company stock is down that day. Entire market is in green, everything else is going good, but only that stock has reacted negatively. That is unsystematic risk. Some problem, auditor wrote one negative comment in the audit report of that particular company, only that share will fall, not everything. I forgot the name of the company. 3 days back, the auditor of the company resigned, saying, I am not getting documents and explanation from the client. I don't want to continue. Therefore, he resigned. That day, stock fell like 8-10%. Now, why will an auditor resign? Is not getting any information. And why directors are not giving information? If they give, maybe there is some fraud that they have done and it will be caught. Now, just this resignation information came to stock market. Now, when he resigns, it's a listed company, so it will be there on the company's website, on ROC, on SEBI, everything. People started doubting something is wrong in the company, and people started selling the shares badly. Nobody wanted to buy that day. Uh, Too many sellers, less buyers. You know what will happen to the stock price, correct? Some scam, some fraud, some auditor's resignation, some case filed against that company. Now, this Vodafone Idea company's case is going on in Supreme Court. Okay, every time there is a hearing, previous day, that day, next day, stock will go up, come down by 5%, 8%, 3%, hoping that it will be in favor of the company. And then the Supreme Court will say, no, no, they give one more future date. And then again, stock will come down. And this keeps happening. Other companies will not get affected that day. This is called unsystematic risk. Can I reduce unsystematic risk? Yes, I should not put all my money in one single company stock. Say electric vehicle, Ola Electric example. If you put all your money in that company share, anything happen to electric vehicle industry, your company is affected badly, correct? But if you put some money there and some money in Hero Moto, okay, then you have to some extent, suppose 1 lakh rupee, one person has put full 1 lakh in Ola, another guy has done 50,000 in Ola and another 50,000 in some other company. Then even if something goes wrong in electric vehicle segment, only half of his money is affected. The other half will still be safe. Okay, this is called diversification. But whether it is Ola Electric or Tata Motors or Zomato or PVR, when there is a war, all shares will collapse. When there is election result, everything will go for a toss. When Trump makes an announcement, most of the stocks will get affected. So if the effect is on all stocks, we call it what? Systematic risk, common to everybody. If it is to a specific stock, then we call it unsystematic risk. Okay. Now, beta is a measurement of that risk, and I think I wrote the formula already. Yes, RF. What is RF, by the way? Risk free rate of return. Can you give me one or two examples of RF? Government of India bonds, bank FD, post office deposit. In exam, if they give T bills, treasury bills, or T bonds, 182 days T bonds, even that should be counted as risk free investment. Post office deposit, if they give, that also you can take. It won't be bank FD always. I think in class, so many times we have discussed bank FD for RF. Make a note if you want. Government bonds, treasury bills, treasury bonds, everything can be counted as example for RF. Okay. What is RM? Market rate of return. How do you measure market rate of return? Overall markets return, which is Nifty or Sensex. Okay, make a note. RM is market rate of return, either Nifty or Sensex. In one RTP, they have given this question. BSC Sensex gave 12% return. Sensex is in BSC, Nifty is in NSE. Basically, Nifty has top 50 companies, Sensex has top 30 companies. Same 30 are in both, but in Nifty there are 20 more. Understanding? So if they say Nifty gave 12%, you can take that as RM. If they say BSC, Bombay Stock Exchange Sensex, that can also be taken as RM. Okay. RF is either bank or post office or government bonds. Beta will be given in the question. Answer this. What is the meaning of beta 1? Beta equal to 1. What does that mean? Risk of investing in that stock is same as risk of investing in overall market. Yeah? Beta greater than 1. That means this stock is riskier than overall market. Yeah. And beta less than 1, this stock is less risky compared to overall market. Okay, beta won't be 0. That means it is risk free. Inside stock market, there is no risk free stock. Every stock has some element of risk. Can be more, can be less, but it can't be 0. Okay. Now, these are the 5 formulas of calculating cost of equity. Here we had 4: constant dividend, constant EPS, growth, realized yield, and CAPM. And CAPM formula is RF plus beta into RM minus RF. They may ask CAPM explanation itself. And if you remember, there was a graph also for this CAPM. Easy, not much of a difficulty. RF is always a straight line, correct? This is a measurement of risk, beta. And as beta goes up, expected rate will also keep increasing. If beta is 0, then expectation is equal to RF. But inside stock market, beta can't be 0. Beta will be more. If beta is more, then expected rate will also be higher. Okay. Now the last thing is cost of reserve, which we call as KR. KD done, KP done, KE done. Last one is KR. Tell me, who owns reserves and surplus? Debenture, shareholders. Who is the owner of this? Shareholders only. That means KR should be equal to KE then. If money belongs to same people, KR should be equal to KE. But there is a small difference. Here also, you take same D0 or D1 plus D, etc., etc. But what was P0? Market price. And if there is flotation cost, we would minus. First of all, understand for reserves, there can't be market price. You can buy and sell a debenture or a bond or a share. You can't buy and sell a reserve. I can't say I'll keep the share, I'll sell reserves to him. Correct? If I have to sell, I have to sell share to him or bond to him, debenture to him. So there can't be market price. One. Second, normally we do minus flotation cost because we want net receipt. When I'm not issuing it to anybody, where is the question of flotation cost? First of all, this flotation cost I have to pay through my demat account when I buy, sell, or issue. That is your ROC charge, SEBI, duty, taxes, etc., etc. Reserve, who is issuing it to whom? Your own money from this pocket. Instead of giving it as dividend, you're keeping in the pocket only. For that, you don't have to pay any flotation cost. Understand? There is no issue price. And since there is no issue happening, there can't be flotation cost. Flotation cost comes when you issue. Since you're not issuing, there is no flotation cost. Therefore, what is the difference between formula KR and KE? In K, I'm writing a detailed one. D0 divided by net receipt. What is net receipt? Issue price minus flotation cost. The price at which I can issue this share to public. That can happen for KE. But when I write KR, it should be same formula. Yes, it is same formula. But the problem is there can't be issue price because I can't issue reserve and there can't be flotation cost. Therefore, study material says take the market price on that day. Now, this market price may change also. This depends on the day on which you are working out the sum. Correct? It can't be 31st March always. Balance sheet is on 31st, but market price. Now, if I log in and check after 10 minutes, the price can change also. Correct? So, this is market price. So, it should be D0 by MPS. So, simple two things. There is no issue price because I'm not issuing reserve to anybody. Since I'm not issuing anything to anybody, there can't be flotation cost also. Otherwise, all five formulas will work out here also. If there is plus G, D1 plus G, here also D1 plus G. Those things will all be same. Only denominator I have to revise. Okay. Now, what all we have studied? All four KD, KP, KE and KR. One day before exam, in this chapter, first go through the formulas for all. KR and KE is very easy, only small change to be done. KD, if you understand, KP is easy. Correct? Suppose this is 8%, 9%, 11%, 11.2%. Tell me now. If I have 80 lakh rupee debt, 20 lakh rupee preference, 180 lakh of equity, and okay, I'll change 170 and 30. Now, how to do the average cost? And when I do average cost, what do I get is KO, overall cost of capital. My company is not funded only by one source, it is funded by four sources. In Calci, if I do 8% plus 9 plus 11 plus 11.2, and then simply divide all of that by 4. Why 4? Because there are four sources. What's the number I'm getting? 9.8. Correct? What did I do in this? Sir, we added all 4 and simply divided by 4. That means you did simple average. Correct? And why simple average is wrong? The amounts are not same. Correct? We are giving equal weightage when the amount is not equal. Therefore, we should not be doing simple average. We should be doing weighted average. Now, how to do weighted average? 80 divided by total. Remember, you studied it in table form. How to do total? Total of all 4 comes to 300. That means you should be doing 80 by 300 into 0.8, 0.08. Yes, 0.08 means 8%. What's the problem? Are you understanding what I'm saying? 80 by 300. 300 is the total. 80 by 300 into 0.08. What's the number? Plus in Calci. 20 by 300 into 0.09. 0. 20 by 300 into 0.09. 0. Okay, we'll redo. I understood what is the confusion. All of you, start fresh. 80 by 300 into 8 you do. 8. 2.13. Okay, plus 220 by 300 into 9. Point. Can you continue this way? One more. 170 by 300 into 11. 6 point. Okay. 30 by 300 into 11.1 point. 1.2 or 1.12? 1.12. Can you add all four? 10.08 is your KO. And since we have done weighted average, this is also called as weighted average cost of capital. Can you put this in formula style? What did we do? 80 by 300 into 8. Correct? What was 80? Amount of debt. What was 300? Total. Correct? That means what we calculated is weight of debt in calci. 80 by 300. 0. What is 0.26? Weightage of debt. That means, can I write it like this? Weight of debt. Then we multiplied with cost of debt, correct? Plus, you tell me what should I write? Weight of preference into cost of preference. Same way, weight of equity into cost of equity plus weight of reserve into cost of reserve. This is one style. Some books and even in class we have done it this way. Instead of doing this, we prepare a table. Remember, first we write debt statement of WACs. We write debt, we write preference, we write equity, and then we take reserve. And then we fill these numbers. Don't worry about exact numbers 30, 70, 180, 20. And then we do the total, and then we assign weight, and then we multiply with cost, and then we do weight into cost. And this total is your WACC or KO, either tabular style, or if you're comfortable, weight of debt into cost of debt. This way is also okay. Anything you are comfortable. In this, if you remember, the last segment of this chapter was this WACC can be worked out in two ways, either WACC book value or WACC market value. Tell me what is the difference between these two. WACC book value. Simple. Name itself is book value. That means you simply copy from balance sheet. Will you count reserves also in this answer? Yes, because reserves will have book value. Anything that is there in balance sheet has book value. Anything that is in books is with book value, as simple as that. But when you do WACC market value, you should not count reserves because reserves will not have market value. You can't buy and sell. Okay, one. Second, for equity, there can be both BV and MV, book value and market value. For debenture, there can be both book value, market value. Preference share, there can be book value, market value. What about bank loan? Can there be both book value, market value for bank loan? No. Why no market value for loan? We can't buy and sell. But can it be transferred from one bank to another bank? Say I took loan from HDFC. Now I want to shift it to ICICI. Is it possible? Yes. That means loan can be transferred, but that is not called a sale of loan. That is called transfer of loan. So what we do, we take book value itself as market value for bank loan. Don't say zero market value. We take book value itself as market value for bank loan. So I quickly repeat: equity share, debentures, bonds, preference share. You can have both book value, market value separately. Reserve will have book value, reserve will not have market value. Following, bank loan book value itself is to be taken as market value because bank loan cannot be bought and sold, but that doesn't mean it can't be even transferred. It can be transferred. You can take loan in one bank and then shift it to the other bank, but that shifting is called transferring the loan. It is not called sale of loan or purchase of loan. It is not ICICI bank buying the loan from HDFC. It is simply transfer. Transfer will happen at par value or book value. Then clear. Important thing, reserve. Again, I am repeating, reserve will have book value because it is in balance sheet. Reserve will not have market value. You cannot buy and sell the reserves. Yeah. One last thing, then we'll complete this topic. Suppose company already has some debt, equity, and preference share, and they're now planning to go for one more debt. Suppose existing debt is 8% interest. They're planning to go for one more debt, but that is coming at 9%. Now, what they do, they ask you two questions. Compute WACC based on existing capital structure. Existing capital structure means only these three. Sub-question B will be calculate revised or new WACC. Now what happens when you do new WACC? First three will remain same. But there will be one more line item in your answer. It will not be debt equity preference. It will be debt in bracket old. And then there is preference, equity, and then debt one more in bracket new. Understanding? Total will change. Imagine this was 80 lakh, 10 lakh, 10 lakh. And now you are going for one more 5 lakh of debt. Earlier total was 100, but now the total will be 105. Earlier weight was 80 by 100. Now it will be 80 by 105. Understanding? So you have to do two separate tables. WACC existing, WACC new. This new WACC is also called as marginal cost of capital. What is the meaning of marginal? Extra, additional. Why is it called extra or additional? Because you already have one answer. We are adding one extra fund called 9% new debt. In some answers in ICS study material, you will see old KD, new KD. Old KD is the existing debenture. New KD is the one that you are planning to go now. Okay. In some questions, they will print sub question A calculate WACC, sub question B calculate marginal cost of capital. What is that marginal cost of capital? New WACC. What is the meaning of new WACC? Old one plus one more item. But it is not just one more item. The moment you add that item, total will change. And the moment total changes, weights will change. Just now I showed you. It will be 80 by 100. In future, it will be 80 by 105. This was 10 by 100. This will be 10 by 105. All the weights will change. Accordingly, final answer will also change. Understood? So wherever they say marginal cost of capital, they're only referring to additional capital to be added to the existing capital. Done. Yeah. With this, we are done with cost of capital chapter. I have discussed CAPM. I discussed WACC, payable, book value, market value. Done. Yes, I think with this, we have completed the full topic. Okay, the next topic is capital structure. Now, name says this topic is about deciding the composition of your total capital. A company can be funded by equity, debt, reserves, preference, etc. How much should come from debt? How much should come from equity? What should be the ratio between equity and debt and preference and all of that? And this topic has some assumptions at the very beginning. One, they assume no taxes. So PBT itself is PAT. And they assume there are only two sources of fund, debt, equity. There is no preference share capital. Third, dividend payout ratio is 100%. That means there are no reserves. Whatever we earn, we pay as dividend. Therefore, if you now consider all of this, no tax, no preference dividend, and 100% payout ratio. That means from EBIT you minus interest, you get EBT. EBT itself is EAT because there is no tax, and EAT itself is earning available to equity shareholders because there is no preference share capital also. And that entire earning available to equity shareholder is dividend payment because there is no reserve also. Okay. Now, the original and the basic formula in this is EBIT by KO. Value of the firm is equal to EBIT by KO. Just see continuation of the discussion from 1 second. Sorry. Value of the firm is equal to EBIT by KO. This is a formula they say. Now, to understand this, just do a cross multiplication. Value of the firm into KO should be EBIT. And if I want KO, it should be EBIT by value of the firm. Correct? In cost of capital chapter, when we studied cost of equity, it was dividend by price of the share, correct? P0. Now observe the similarity. When it was cost of equity, we took equity dividend. Now we are talking about cost of overall capital. When you're talking about overall capital, you should take what company earns and not what shareholder is earning. Correct? What shareholder is earning is dividend, but what company is earning is EBIT. And when you take KO, you're talking about whole business, not just equity. This was equity shares market value. This should be the entire company's market value. Now, firm doesn't mean partnership firm here. Firm means a business, a company. So understand this as value of business. Okay, value of firm or value of business. Now you see the formula. Cost of overall capital is equal to EBIT by value of the firm. What firm or business earns is EBIT. What equity shareholder will earn is dividend. This is something easy for you to follow also. I'm writing again. Cost of equity is what equity shareholder is earning divided by price of the equity share in the market. Right? If you want to do overall cost, then it should not be dividend. Overall business will be earning EBIT. And for overall business, you should not take only equity shares value. You have to take the value of the entire business. Instead of writing value of business, they write value of firm. Okay. Now see this. What is the formula in the book? Value of firm is equal to EBIT divided by KO. Correct? Now you try how to calculate value of equity. Use the same logic. Entire firm earns EBIT, and I want now value of equity. What equity shareholders earn is earning available to equity shareholders. If there is no reserve, then this can be written as D divided by, for whole firm if it is KO, for equity it should be KE. Easy to follow. This way, how to do value of debt? Follow the same logic. Business will earn EBIT. Equity shareholders will earn dividend. Debenture holders will earn interest. And for whole business, it was KO. For equity, it was KE. For debt, it should be KD. Able to follow. One last thing then. If I want to do value of preference shares, tell me what should be written. Preference dividend divided by KP. Correct? In this chapter, they don't focus much on preference shares because I already told you minutes back. They believe there are only two sources, either debt or equity, either outsider or insider. There is no preference share capital concept itself. Okay, now go ahead. Repeat. Value of firm should be equal to what? What firm earns divided by the applicable rate to the firm. Applicable rate to the firm. Firm means whole business. For whole business, it is KO. And how to calculate KO, we studied in previous chapter, cost of capital. KO means WACC. Tell me how to do WACC. Weight of debt into cost of debt plus weight of equity into cost of equity and so on. Correct? That means during revision, if you have not done cost of capital chapter, don't open capital structure topic. This I told you in the regular class also. First, cost of capital, you should know how to learn how to work out KO. Then only you can work out EBIT by KO and call it as value of firm. Okay. Now, everybody wants to improve the value of their business. No businessman will say, I want to reduce my valuation. Everybody wants to improve the worth or value. Now, how to improve value of the firm? If you just see from formula angle, suppose this was 10 lakh rupee EBIT and cost overall capital was 10%. 10 lakh by point 0.1, value of the firm is 100 lakh rupee. Now I want this to go up, then either I should try and improve EBIT or I should try and decrease KO, or I should try and do both. If I do both, it will be very good. Correct? Let's focus on what happens if I improve numerator. Observe the numbers that I am changing. 10 lakh by point 0.1, value was 100 lakh. Suppose I improve my EBIT and make it 12 lakh by point 0.1. In calci, 12 lakh by point 0.1, valuation will go up to 120. Same way if this goes to 13 lakh, 13 lakh by zero point 0.1, valuation will go to 130. That means one way of improving my business value is to improve EBIT. Correct? Second way, to decrease KO, either you improve numerator or you decrease the denominator. Now see what will happen if I try to decrease the denominator. I'll keep this 10 lakh, but this point 1 means 10%. I'll make it 0.09 in calci. 10 lakh divided by 0.01, value comes to 111.1. Correct? I do one more, make it 8%. Then this will be 125 lakhs. Observing, if this comes down further to 6%, then this will be much more now. 166.6 lakh. That means two ways in which you can improve the value of your business. Either improve EBIT or decrease KO. There are four approaches in this chapter. First two approaches believe that you should try and decrease KO. And next two approaches believe that you should try and improve EBIT. Able to follow? That means now our focus is shifted to this discussion, how to bring down KO. First of all, tell me how to calculate KO before learning how to bring it down. How to find out KO? We have to assign the weights. Say we have only debt and equity. It will be weight of debt into cost of debt plus weight of equity into cost of equity. Two ways. One, formula style, or some of you are comfortable in doing in table style. You put debt, you put equity, say 80 lakh, 20 lakh total. Tell me how to assign weight now. 80 by 100, 20 by 100. Can I say always and always total of the weights should be equal to 1? If this is 80%, this has to be 20%. And remember, this chapter assumes no preference shares. I've already told you. No reserves and surplus because 100% dividend payout ratio. It has to be debt and equity only. Okay. Then we need cost. Sir, are you saying we need KD, correct? And then we need KE. How to do? It was in the previous topic, cost of capital. Suppose that number is 9% and this is 12%. Or I'll do one thing, I'll keep it 10% and 12%. Now tell me, you will do weight into cost in calci, 0.8 into 10, 8, and 0.2 into 12, 2.4, and my WACC is 10.4%. Now what was our objective as per this formula? We want to bring it down. Now to bring it down, two approaches in this. Please understand, numerator, denominator. I'm not discussing numerator now, EBIT. My focus is on denominator. How to bring down denominator? First way is, they say, look, debt is cheaper. Do you agree? 10% is less than 12%. If you want to bring this down, you should increase the value of debt and decrease the value of equity. Do you agree? I repeat, I want this 10.4 to come down to 10.3, 10.2, 10.1, etc. What they say is, then do one thing. Cheaper one is debt. Keep more of debt. Keep less of equity. How will it work? See on screen. No writing now. Please listen. I make it 90 and 10. Total is 100. Take more loan, less equity. Now tell me, weights will change slightly. Able to follow? Now use calc. 0.9 into 10 will be 9. 0.1 into 12, 1.2. This came down from 10.4 to 10.2. Able to understand? Can you tell me what happened in my calculation? That the effect is this has come down. I only increased the amount of debt and decreased the amount of equity. What do you think? I don't need workings, just theory. What if I further make it 95 and 5? Do you think it will further go down from 10.2 to 10.1? Don't worry about exact number. Will it further go down is my question. Do you think this will further go down? Why so? This will now become 0.95. This will become 0.05. I am further increasing the weightage of a cheaper cost. Correct? in calci now. 0.95 into 10, and this is 0.05 into 12, 0.06. If you add both, you get 10.1. Correct? Now you know without calci, if 95 becomes 98 and this becomes 2, then this will further go down. Are you understanding? So tell me one line theory solution. What did you understand theory conclusion from this? If you want to bring down KO, you have to keep more debt and less equity. Able to follow? If you want to bring down KO, you have to keep more debt and less equity. Why more debt is good? Because debt is cheaper and equity is costly. Sir, can this be reversed? No. You will never pay 12% interest to debenture holders and pay only 6% dividend to equity shareholder. Then why will anybody be an equity shareholder in your company? First of all, they're an equity shareholder. They have taken risk. For the risk, they want more. They won't accept less than what debenture holder is getting. Therefore, KD will always be cheaper. KE will always be costly. Or think this way: there is a short person and there is a tall guy, and you have calculated the average height. Now, if you want to bring down the average height, you have to add one more short guy only. Then the average will come down. Are you following? You're making a note of this. I'll wait because it is very simple to understand. You don't even need numbers and table. Copied. Can I? Ah, tell me now. Two people, A and B. This guy height is 5 feet, 6 feet. Okay. I'm not looking at anyone. Sorry by mistake if I see you in this discussion. Okay. How much is the average height of these two people? 5.5 feet. Correct. Now, if I want to bring down the average height, should I add a taller person or a shorter person? If I add one more shorter person, now do you think average will be further less? You don't even need calci for this. Think 5 plus 6 by 2. Now 5 plus 6 plus 5 by 3. Correct? One more shorter guy. I know D is not shorter, but that's okay. Imagine this is also 5. Now 5, 6, 5, 5 divided by 4. This will be lesser than the average of the 3. Correct? Huh. What happens when this is the average and you add a taller guy? Okay, let me not confuse. 6 only. What happens to average now? Average will increase. Correct? Okay, I understood what's going on. Calci, please. 5 plus 6 by 2. What is the answer? Okay. Now I added one short guy. Now, no, no. Don't add to 5.5. Start fresh. 5 plus 6 plus 5 divided by 3. Did you notice something? When you add a shorter guy to the average, average will come down. Add one more shorter guy. Now do 5, 6, 5, 5 divided by 4. 5 point. Did you notice? That means if you want to bring down the average, you have to add the shorter guy more to the group. Correct? Now the shorter guy is cost of debt and taller guy is cost of equity. Now if you want to bring down KO, you have to add more of debt only. Able to follow? Now tell me, when my debt and equity is 50-50 and KO is 9%, no need of calcium. If I increase debt and decrease equity, you don't need any number. You know debt is cheaper. This is cheaper. This is costly. What will happen to 9%? Will it be less than 9 now? This may be 8.8 because you increase the level of cheaper source, shorter guy, taller guy. Correct? What if you make it 70-30? This will further go down and so on. So you keep making it. Sir, what if you make this 100 and 0? Then what happens? Can I say cost of debt itself is cost of overall capital? In this, we remove B and keep adding 5 feet people only. Why to work out average now? All are 5 feet only. What is the use of doing average? It will be 5 on 5 plus 5 plus 5 plus 5 divided by number will be 5 on. Correct? Now convert this to a graph. Suppose this is KD, has to be lower number, and this is KE, higher number. Correct? This is percentage, say 8%, 12%. Now this is how much of debt you have, which we call as leverage. Now tell me, if I'm writing like this, can you explain what is this now? This is 0. When you have 0 leverage, that means you're fully funded by equity. When you're fully funded by equity, KE itself is KO. Did you notice? You keep adding debt because debt is cheaper, the average keeps coming down. It is like you had that first guy who is 6 feet. Then you kept adding 5 feet, 5 feet, 5 feet, 5 feet people. After 6 people like this, 7 people like this, 8 people like this, the average would have come down. But I'm making two assumptions here. Anytime I say taller guy, he should be 6 feet only. Anytime I say short guy, it should be 5 feet only. 4.9 is shorter than 5, but we won't count it. We'll count it as 5 only. And 5.1 is also shorter than 6, but we assume that the 5 will remain same. Okay, now I'll draw it once again. You explain to me what is there on the x-axis. Leverage basically means level of debt. Zero leverage means zero level of debt, meaning no debt. More I go this side, that means I'm adding more and more and more debt. Correct? And then I need a straight line. Lower straight line is KD because this is cheaper source, and higher one is cost of equity because this is costlier. I just wrote the numbers. KD 8%, KE 12%. When you are at 0, that means if you want, this means level of debt. What is the meaning of level of debt is 0? No debt. No debt means you are fully funded by equity. When you are fully funded by equity, KE itself is K. Oh, imagine only one person 6 feet. What is the average now? What is the meaning of average of a single guy? It will be that number only 6 feet. Correct? But then you added one shorter guy. Average will come down 6 plus 5 by 2. Plus you added one more shorter guy, 6 plus 5 by 3. You keep adding the short people, what will happen? Over a period of time, your average itself will come down to 8.1, 8.2, and so on. I just extend this. You try and answer what should be the meaning of this now. If we reach here, this level of debt should be 1. What is the meaning? 100% funded by debt. When you're 100% funded by debt, KD itself is KO. Here you are 100% funded by equity, KE itself is KO. Did you understand? But here we make two assumptions. One, shareholders' expectation will be 12% only. Debt holders will give you loan at 8% only. And what is the single line conclusion of this theory? You want to bring down KO, you have to increase debt. Okay, this is called net income approach. Second one is traditional approach. Now, I'm writing the same graph again. Help me. What was x-axis? Level of debt, also called as leverage. And here you had all the percentages. Answer. In the previous graph, both were straight lines. This was KD and this was KE. We took this way, 8 and 12. Correct? Now focus on KD. What is the meaning of this 8 line remaining straight line? Whenever we take loan, we will get it at 8% only. Now the problem is in real world, when you take first loan, it may come at 8%. Second loan, third loan may also come at 8%. But when you go to banker for the fourth time, saying I already have 3 loans, I want fourth loan, definitely the rate of interest will not be same. Tell me, will bank manager charge a higher rate of interest now? Why so? He will charge more because bank manager thinks giving you loan is risky now. Why? You already have 3 loans. Tomorrow, if there is some problem, first those 3 people will file a case against you. And you would have given all the securities there and those EMIs you have been paying. And think you sitting in bank manager's seat. Why will you give loan to somebody who already has 7 loans and he has come to you for 8th loan? You will surely doubt. something is wrong and this money is not going to come back to me. Either you will say no to his loan application, or you will say yes with higher rate of interest. Now, if you say yes with higher rate of interest, tell me now this KD won't remain a straight line. This will slowly start going up. And did you notice it did not go up from the beginning? That means first loan, second loan may come at same 8%. Banker may not reject your loan application, but after 3, 4, 5 loans over a period of time, too much of debt is a problem. Little bit of debt is not a problem. Second, we kept KE as a straight line. What does that mean? Equity shareholders rate of return will be 12%. Now think, from company's point of view, it is cost of equity. From shareholders' point of view, it is their rate of return. Understand, I am the company, you are an investor. For me, it is cost of equity. For you, it is return on investment. You gave money to me, I have to give you dividend. For me, it is cost. For you, it is return on investment. When you get to know is that the company is taking loan after loan after loan, as an equity shareholder, even you will start feeling the risk. Imagine being a shareholder in two companies, A Limited, B Limited. A Limited has no debt. B Limited has 7 loans. Next year AGM you go. This B Limited says, I am planning to take one more loan. Now, as an equity shareholder, you find it very risky that I'm a shareholder in a company with 7 loans and they are thinking of eighth loan. Tomorrow, if business is not going really well and we have to close our business, first we have to repay all 7 loans, and now company is thinking of one more loan. Being an equity shareholder, will I get anything when company is closed? This is a question. But when you are when you are a shareholder in the other company where there is no debt at all, if they say I'll take one loan, you may not have a problem because they never had taken a loan. Now this is a first loan. First loan, second loan is not a problem. Fifth, 10th, 12th loan is when there is a problem. Correct? Therefore, what this theory says is up to some level, even equity shareholders' expectation may not rise drastically. But after a point when they get to know that you're taking too much of debt, their expected rate of return will also increase. They were okay with 12%, maybe 12.1, 13, 13.5, 14, 14 and a half, and so on, because they think so much of debt, the risk involved is very, very high. Now, you notice initially, if you focus only on the first part of the graph, the cost will slightly come down. KO will slightly come down because debt is always cheaper. But once the reverse trend starts, then even the cost of overall capital starts going up. That means, is it good to take loan? Yes, only up to a point where KO was decreasing. And this, if you focus, it looks like the first graph itself. Because of debt, KO is coming down. But this line, black line, is not going to remain same forever. Correct? Because that started going up, and even KE started going up. After this point, average will go up. Imagine that 5 feet, 6 feet, 6 becomes 6.1, 5 becomes 5.1. Then when both are going up, average will also start going up only. We believed 5 will remain 5, the height of two people, and 6 will remain 6. But 5, then it becomes 5.1, 5.2, 5.3. 6 will become 6, 6, and then 6.1, 6.2, 6.3. After a point, that reverse trend will start. And that's what they're saying here. Up to a point, taking debt is good. And this point is called optimum debt point. Till this you want to take. That means first loan is good, second loan is good. Taking 3, 4, 5, 10 excessive loan is a problem. Yeah. Can you quickly explain both the graphs to me? Leverages. Tell me, what was this? Straight line. This was also a straight line. That means we believe we will get any number of loans at same rate of interest, and shareholders will not increase their expectation. Because of this, the average keeps coming down. But here what happens, up to a level, debt will come at same rate, but after that, this will start going up. Shareholders also initially may not increase, but over a period of time, even their expectation will go up. Because of this, initially, yes, the average will come down. Correct? But later, the reverse trend will start. So these people believe unlimited debt is good. These people believe debt is good only up to a limited point. Beyond that, you should not take debt. This point is called optimum point, a point where KO is least. Why should KO be least? You remember the original discussion. If KO comes down, value goes up here, correct? If KO comes down, value goes up. Yeah, these are the two approaches. First one is called net income approach. Second one is called traditional approach. Can I write like this? Both these approaches are aiming at one thing: bring down KO. And if KO comes down, value goes up. These are called relevancy theories. Why relevancy theories? By deciding how much debt and equity you take, you can decrease KO. And by decreasing KO, you can increase value. One is connected or related to the other. That's why they're called relevancy models. Okay. Next is irrelevancy model. Are you copying the graph? No? Can I? One. Next is irrelevancy model, which has two varieties. First one is net operating income approach, and second one is approach, Miller and Modigliani approach. Again, this has two components. Original was without tax. Later, they had with tax model. This was 1958 to 1963, 5 years late. Now, net operating income approach. Tell me, last two graphs that we discussed, the focus was on KO. Bring down KO, value will go up. But now they believe that bringing down KO is not going to happen. Now, if KO can't come down, how to improve the value? EBIT has to go up. I repeat, what was the original formula? Value of the firm is EBIT by KO. Last two graphs said you can bring down KO. But these two graphs or these two theories believe that KO can't come down. Now, if KO can't come down, how to improve the value? EBIT should go up. Following, if KO can't come down, then EBIT has to go up. Sir, how are they saying that KO can't come down? For that, here is the graph. See this. Again, level of debt, and this is percentages. They believe KD is a straight line. What is the meaning of KD is a straight line? Level of debt. How much ever loan you take, rate of interest will remain same. Yeah. Now tell me, because of this being straight line, your KO should actually come down like this. This is what we studied in first graph. But no doubt, rate of interest on debt will remain same. But equity shareholder, every time you take more and more and more loan, they increase their expectation. Now you observe the average effect. KD is trying to bring down KO. Understand the sentence? Slightly confusing. KD is trying to bring down KO. But here, equity shareholders are increasing their expectation. They are increasing KO, where one side debt is bringing down average, on the other side, equity is increasing the average. Now, if one is going up and one is coming down, the net effect is it will remain there only. It is like 6 feet guy, 5 feet guy. Now, to bring down the average, we added one more guy here, they added one guy there. Are you understanding? We brought this down, they added this. Now, if you keep adding both sides one number, then the average will go nowhere. Nowhere means it will stay wherever it was. That means KO will remain same. Okay, I quickly repeat. Because of that, the overall cost of capital is trying to come down. Because of that, overall cost is trying to come down. But it is offset by increase in equity. When one is coming down, the other one is increasing, one is offset by the other, the net effect is zero. The meaning of net effect being zero, it will remain where it was. If it was 10%, it will be 10% only. Able to follow? This was the example I discussed in class also, if you remember. One bucket, 1 liter of cold water. Remember this, 20 degree. And one more liter of hot water, 40 degree. Now we have 2 liters of water. What is the average temperature of water in the bucket? 30 degree or 60 degree? Sorry. I'm asking what is the average temperature? 30 degree. 1 liter of cold water and 1 liter of hot water. Total 2 liters. That means the average temperature is 30 degree. Now, if you add 1 more liter here, what will happen? Average will come down, correct? But meanwhile, if somebody adds 1 more liter here, what will happen? It will remain at 30 only. That is what is happening here. One is trying to bring it down, the cold water. One is trying to bring it up. The net effect is it will remain at same point. And if KO remains same, tell me what was the formula for value of the firm? EBIT by KO. And if KO remains same, how to improve value? Only way to improve value is by increasing EBIT. That is why method name itself is net operating income. Now, when they say net operating, what is operating income? Day to day income. What is the meaning of day to day income? EBIT. They clearly said focus on day to day business if you want to improve the value of your business. You can't decrease KO. You can only increase value by increasing EBIT. Able to follow? Now, the last approach is MM approach. Now, MM approach, they first categorize companies into two varieties. One, levered firm. Another one is unlevered firm. Do you recall what is the meaning of levered firm and unlevered firm? Anybody? Sorry. Unlevered firm has no debt. So can I call it as fully funded by equity? Levered firm is the one having equity and debt. Correct? Now they believe that whether you have debt or not, that means whether you have equity debt mix or you are fully funded by equity, it will not make any difference. Now, what is the meaning of it will not make any difference? Value of the firm will remain same. They believe value of levered firm is equal to value of unlevered firm. Understand? Value of levered firm is equal to value of unlevered firm. That means a company having debt or company not having debt will have same value. They have given two formulas also. Value of unlevered firm is equal to earning available to equity shareholder divided by cost of equity. Tell me now, this is not a new formula. What is the meaning of value of unlevered firm? Fully funded by equity. That means they're indirectly talking about what? Value of equity. I have discussed already this 20 minutes back. What is the meaning of value of equity? Okay, what is the formula for value of equity? Whatever belongs to equity divided by applicable rate. Correct? Now, this is value of unlevered firm. What should happen to value of levered firm? They say take value of unlevered firm plus you do debt into tax rate. But if you take tax rate as 0%, then any number you multiply with 0%, it will not make any difference. Debt may be 20 lakh, debt may be 200 lakh. When you multiply with 0%, what happens? It will come down to 0. That means this is as good as nothing. That means value of levered firm is equal to value of unlevered firm. Okay. Hmm. One thing students get confused, that's because of too many terms in this question. What do you mean by value of unlevered firm? A company fully funded by equity. Unlevered firm is the one fully funded by equity. Therefore, can I write this as value of equity? Correct. Remember the original formula of this chapter. Value of the firm is equal to EBIT by KO. That time, what did I tell you? If you are calculating for full firm, you should take EBIT and applicable rate is KO. Then value of equity, what should happen? Not EBIT. What is available to equity shareholder divided by cost of equity. Correct? And now don't get confused. If my firm is unlevered firm, I am fully funded by equity. So can I say for me KE itself is KO? Value of unlevered firm is a company fully funded by equity. So can I say KE itself is KO. Therefore, if I write it as KO also, it's not wrong because KO and KE in this company will remain same. It's like calculating average of a person having 6 feet height only. Only one guy. His height itself is his average height. For one person, you don't even calculate average. How to calculate average height of a single guy? 6 feet by one because there is only one guy. But if you have two people, it is 6 plus 5 by 2. 6 plus 5 by 3. For individual, you don't work out the average. So when your company fully funded by equity, cost of equity itself is cost of overall capital. KE is equal to KO. Done. But later, 5 years later, 1963, they changed their model and that was named as MM with tax. Now, please tell me, what was the formula? Value of unlevered firm. Just now I discussed. Value of unlevered firm is earning available to equity shareholders divided by K. Correct? How to work out earning available to equity shareholder? Can you tell me how to reach there? From EBIT, I have to take out interest minus now I have to take out tax also because this model had tax in question. If they give 20%, 30%, 40%, you have to take that number. Correct? Now, value of levered firm is equal to, we have already studied, value of unlevered firm plus, now observe, debt into tax rate. Now I cannot say, sir, this will be zero. This will be something. Why something? Because tax rate is given in the question because the model is with tax. Okay. Now, summary of this is when they say no tax model, they believed value of unlevered firm is equal to value of levered firm because the debt into tax rate had no effect. But then when they said with some tax, value of unlevered firm was less and value of levered firm was more. Can you answer? What is the meaning of levered? The one with debt. Correct? Now, can you read the second sentence again? When there is tax, value of the company having debt will be more than the company not having any debt. That means having debt is good. It will improve your value because you save taxes. Originally, they believed no taxes, but later they changed it to 30%, 40% tax, and that will be given in the question. If you're making a note, I will wait. Okay. If you have copied, the next discussion in this topic is EBIT, EPS, indifference point. This is the easy part of the chapter. What is the meaning of indifference point? Two things should be same, correct? That means EPS of one option should be equal to EPS of another option. There are a lot of questions. Plan A, Plan B. Plan A is they want to get 100% equity. Plan B, they want 50% equity, 50% debt. There are these combinations given in the question. Okay. Now understand. Suppose company wants 10 lakh. They have made two plans. First plan is 80% debt, 20% equity. Plan B, 50% debt, 50% equity. Okay. Debt is available at 8% interest. Tax rate is 30%. Face value of one share is 10 rupees. Now they want you to calculate indifference point, EBIT, EPS indifference point. Just now I told you what is the meaning of EBIT, EPS indifference point. They want EPS to be same. Do you remember how to do this? EPS of plan A should be equal to EPS of plan B. This is the, as I told you, easy segment of the topic. You have to revise this without fail. Okay, because the part that I discussed in last 30-40 minutes had a lot of formulas and slightly difficult compared to this part. This is easy. Tell me how to do. Give a try. EPS of A should be equal to EPS of B. Now EPS comes when you do EBIT minus interest minus tax divided by number of equity shares in option 1. Now plan A, correct? And here also EBIT minus interest minus tax divided by number of equity shares in plan B. Give a try. How to do? We don't know EBIT. Minus. Can I find out interest? Yes. My total fund requirement is 10 lakh. Do in Calci. Plan A. How much of debt am I thinking of? 80% of 10 lakh. That will be 8 lakh into what is the rate of interest? 8%. That will be 64,000. I'll write full answer thousands. Minus. How to calculate tax? It is 30% on x minus 64. Many students do this mistake. They do zero point 0.3 on x only. You are not paying tax on EBIT. You are paying tax on EBT. You have to do EBIT minus I and then only apply this. Correct? To be divided by. How to get number of equity shares? Use Calci. 10 lakh funds, 20% equity. That will be what? 2 lakh rupee. Correct? And that is divided by 10 rupee. How many shares? 20,000. Since I'm doing everything in thousands, I'll keep it as 20 is equal to. Give a try. This should be x minus. Here my plan is 50% debt. 50% debt will be 5 lakh. 5 lakh into 80% interest will be what? 40 minus zero point 0.3 x minus 40. All okay? To be divided by number of shares in plan B. Now this will be 50,000. Correct? From here, simplification. X minus 64 minus 0.3x. Use Calci plus 19.2 divided by 20 is equal to x minus 40 minus 0.3x plus 12 by 50. Happening? Yes. Minus into minus is plus. I hope you. We are good in this. I know. This will be 0.7x minus this number 44 by 20. This will be zero point 0.7 minus 28 by 50. Okay. I'll wait for 1 more minute. What is the next thing to be done? Cross multiplication. Those who are watching on YouTube, pause the video and solve it. And those who are here, work out. I'll wait. When you solve the equation, you get value of x as 80. Since we have written it in thousands, 80 means 80,000. What is the meaning? If I earn 80,000 EBIT, then whether I go for plan A or plan B, my EPS will be same. EPS will not be 0. EPS will be same because we started with equal to. Okay. What if in exam they give you 3 options, plan A, plan B, plan C? Then you can't work out one more here. You have to do A and B, B and C, and A and C, 3 separate answers. Okay. Make a note. If in exam, indifference point is to be worked out, if in exam indifference point is to be worked out for 3 plans, indifference point is to be worked out for 3 plans. Example, plan A, plan B, plan C. Then we should work out for plan A and B, comma B and C, comma A and C separately. Clear? I have a question. Is it possible that we don't get the answer. Here, when I asked you to solve, you did a cross multiplication, correct? 50 into 0.7x minus something something, and then you got the value of x. Is there a chance that we don't get the answer? Yes, it may happen something like this. 3x minus 40 is equal to 3x plus 10. Okay, and then when you shift 3x here, 40 plus 10, this will be a number, but this will get cancelled. It can't be 0 is equal to 40, 50, correct? Therefore, keep in mind in exam, if x and x gets cancelled, or what may happen, x will not get cancelled, numbers will get cancelled. This will be 4x minus 40. And then what happens? This will be 4x minus 3x. This will be minus 40. This becomes plus 40. Then these two will get cancelled. You will have 1x, nothing this side. 1x means x. You will not have anything to fill. So if this happens, you are not wrong. Tell me what is the meaning? If x gets cancelled or number gets cancelled, then we can't solve the equation. What is the meaning of saying I can't solve the equation? There is no indifference point. What is the meaning of no indifference point? EPS will never be equal. In exam, this will happen. You will be stuck in between and you will doubt your algebra knowledge anyway. You think you have done a mistake. Normally correct. But here, if that happens, your algebra knowledge is correct. Answer is not there. Okay, please make a note. If in exam, if in exam, x and x gets cancelled. If in exam x and x gets cancelled, or only x remains and values get cancelled, only x remains and values get cancelled, comma, it means there is no indifference point. There is no indifference point. There is no indifference point. That is, EPS will never be same. EPS will never be same. Done. One last small concept in this chapter is financial break-even point. You know the normal break-even point, a point where profit or loss is zero. Here, financial BEP is a point where EPS is zero. Now, what is the meaning EPS is zero? Whatever EBIT you are earning, see what I'm writing on screen, that should be equal to interest, tax, and preference dividend. Read slowly. Whatever EBIT we are earning, say 10 lakh rupee, that is equal to 3 lakh interest, 2 lakh tax, and 5 lakh preference dividend. What does this mean? How much will equity shareholder get in this deal? Nothing. That's why it is called break even point. He will get zero. Make a note. Financial BEP is a level of EBIT. Financial BEP is a level of EBIT at which EPS is equal to zero. EPS is equal to 0. Or next line, you can copy this. EBIT is equal to interest plus tax plus preference dividend. Interest plus tax plus preference dividend. Okay. One more line, make a note. During revision, separate line. During revision, make a note. Solve one question on indifference point. Solve one question on indifference point and one question on financial BP. Okay, or if there is one question which has both, that's the best question to practice. Okay, in fact, in class material, if I'm correct, the last question has both indifference point, BEP, and I think they have even EPS calculation. Yeah, this one, page 128, question 12. There are three plans. They want EPS, they want BEP, they want indifference point. Make a note of this itself. Page 128, question 12. Practice this. Those who have not attended regular class, you can practice 14th question from page number 132. You have the answers also. But this is a good question. Okay. So these are all the important things of capital structure topic. With this, we are done with this topic. Okay. Next topic is dividend decision. This theory part in dividend decision, please mark it important or make a note. Four types of dividend policy. They can ask this as theory question for 4 marks. First one is regular dividend policy. Regular doesn't mean same amount. Regular means every year dividend will be paid. Simple. Regular means every year dividend will be paid. Okay. Then comes stable dividend policy, in which first one is constant dividend per share. That means every year same amount, 3 rupee, 3 rupee, 3 rupee, 3 rupee, forever 3 rupee. This is the same formula we used in cost of capital. Constant dividend, D0, D1, D2, D3, D is same. Next, constant payout ratio. What is the meaning of this? Whatever is the earning per share, whatever is that amount, 80% of that is paid. If you earn 10 rupee EPS, 80% of 10. If you earn 2 rupee EPS, 80% of 2. If you earn 9 rupee, 80% of 9. So it is going to be 80% fixed. On what? That may change. To understand the difference, in constant dividend, amount is same. Constant dividend, amount is same. Constant payout ratio, percentage is same. 80% of EPS. What if EPS goes very high? You will get 80% of high number. EPS goes very low, then you get 80% of low number. Next one is stable rupee dividend plus extra dividend. What companies do to be on a safer side, they say you will get 2 rupee every year. Plus how much more? That depends. It can be 2 plus 0.1, it can be 2 plus 1, it can be 2 plus 3.5 also. But 2 is same, constant. Plus extra. This is where your interim dividend will come into picture. End of the year they pay 2 rupee, but in between whenever they can, they will pay. Not that this year they paid interim dividend, every year they'll pay. Some companies 1 year, there are cases where single year one company paid interim dividend 4 times. Interim dividend 4 times plus you add to end of the year. So the one who is sitting with that share for 14 months, 14, 15 months would have got 5, 6 rounds of dividend. But next year they did not pay so many times of interim dividend, they paid only once. Correct? So fixed amount is promised. Promised means assured. Again, there is no legal obligation. Plus little extra can be paid. Next is irregular dividend. Here there is no pattern. Sometimes 3 rupees, sometimes 2 rupees, sometimes maybe 0.5, sometimes maybe 41 rupees. Dividend keeps changing. Last one is no dividend. Easy one to understand. Dividend is not paid at all. Then why should you be a shareholder in such company? Share price may be improving, company may be growing, sales is going up, EPS is growing up, company may issue bonus shares, etc., etc. That is the reason why people stay in such companies. Every year will they get something? Answer is no. Yeah. Now these theory parts are easy. I'm going to the formula segment. Mark both Walter and Gordon model as important. These are the two most common and repeatedly asked questions in this chapter. Walter model, Gordon model. By the way, you see the formula P0 is equal to D by K. This is We'll leave this part for a minute. What is this D by K? K means cost of equity. This full chapter is about equity shareholders. So obviously this is not KO. Now see the formula. P0 is equal to D by KE. Can you cross multiply? P0 into KE is equal to D. Then if you keep KE is equal to D by P0. This is the same formula that we studied in cost of capital. First one, constant dividend mod. See what I'm writing? P0 into K means KE is equal to D, simple cross multiplication. And then if I keep KE here, then this will be D by P0. That means till this we already know the formula. But only thing extra they do is E minus D. Observe here, E is EPS, D is dividend. Can you tell me what is the correct meaning of E minus D? EPS minus DPS is reserve per share. Correct? Why do companies keep reserve? What is the purpose of keeping reserve? To reinvest for expansion, future expansion. It is also called as flowing back of profit. Correct? You have money, but you did not give dividend. You kept that profit. What do you do with the profit? Reinvest. Now that reinvestment also will earn some return. Earlier, say 10 lakh was invested. This year EPS is 1 lakh, but you did not give dividend. Now that entire 1 lakh you can reinvest. Now whatever 10 lakh was earning, this 1 lakh can also earn same R. That is mentioned as R here. This is also called as reinvestment rate of return. Understand? Reinvestment rate of return. What is the meaning of this? Company earned some EPS but did not give DPS. Company earned some EPS, did not give DPS. That means they kept it as reserve. What do they do with the reserve? Reinvest. And when they reinvest, they will make some extra money from the reinvestment. That rate is R divided by K. That K is nothing but cost of equity. So when you do R by K, here R divided by K, you see what is happening. Company will keep some reserve and reinvest that can earn say 12% return. And shareholders expected rate is 11% KE or K. Now what happens when you do 12 by 11? It is proportionately more. Observe, what is the meaning of proportionately more? 12 by 11 will be surely greater than 1. Correct? That means company's ability to earn rate of return is more than shareholders rate of return. Shareholders were expecting 11%, whereas company can earn 12%. That means whatever is E minus D kept as reserve, that will earn proportionately more money. Why am I saying proportionately more money? Because 12 by 11 will be greater than 1. You answer now. What is the meaning of 12? When company keeps the reserve, using reserve, they can generate 12% return. What is K? Shareholders were expecting 11%. Now compare this. 12 is greater than 11. That means what company can generate is more than what shareholder is expecting. What company can generate is more than what shareholder is expecting. That means isn't it a good idea to keep reserve? Yes. Because if you keep reserve, that can earn 12%, whereas shareholder was expecting only 11%. So what is the best thing to do? Don't give dividend. Keep everything as reserve. That means dividend payout should be 0%, reserve should be 100%. That is what they said here. If R is greater than K, less dividend is good, more reserve is good. Less dividend. Less dividend can be as less as 0%. More reserve can be as high as 100%. Correct? Imagine this is reverse. Company can generate only, okay, I'll change the numbers fully. Company can generate 13%, whereas shareholders are expecting 15%. Now, when company can earn only 13%, whereas shareholders want 15%, should company keep shareholders' money? No, because they want 15%. If I'm keeping, I should go beyond 15. If I can earn only 13, good idea is not to keep their money. What is the meaning of not keeping their money? Give dividend. Don't keep reserve. Because if you keep reserve, they expect 15%, whereas you can earn only 13%. Are you following? Assume for a minute I am the company's director. You are the shareholder. You are expecting 15% return. But I know I have the projects from which I can earn only 13%. Now, if I still keep some reserve, then I know what is going to happen next year. You will come hoping 15% on the reserve, but I would have earned only 13%. Therefore, better I should not keep that reserve only. I say, boss, I can't meet your 15% expectation. Take dividend now only. Because if I keep, I should deliver 15. If I give, then I have no pressure to deliver 15%. Now tell me what is this? R is less than K. R is 13, K is 15. If R is less than K, high dividend is good, low reserve is good. High dividend can be as high as 100%. And how much reserve to be kept? Zero. And why did they call this as declining firm, by the way? First one they called it as growth firm. And now they're calling this as declining firm. Why do you think they have used these terms? Simple logic. When you can't meet your shareholders' expectation, that means your company is not good enough. If your shareholders are expecting 15%, they have so much of hopes on you. And you know you can't do even 13% from the projects. That means you're not meeting their expectation. When it was reverse, say this is 18% and 15%. Shareholders want only 15%, but you have ideas which can generate 18%. That means you're better than what shareholders want you to be. That's why you call it as growth. Correct? Company should be more than what shareholders want the company to be. Can both be same, sir? 15%, 15%. Yes. Then what happens? Whether you keep reserve or you give dividend, it will not make any difference. Observe now this is R equal to K. Did you observe? Sorry. R equal to K. What's the meaning of R equal to K? Shareholders want 15%, and what you can generate is also 15%. And you see what is the story given? R is equal to K. Last line of the screen. Normal firm. What do you mean by normal firm? How much ever dividend you want to give, you give. It will make, what did they say? No impact. You want to give dividend, give. You don't want to give, don't give. Because shareholders want 15%, you can earn 15%. It is neither a growth firm nor a declining firm. But practically speaking, equal won't happen. Either company will be better than shareholders' expectation or company will be poorer than shareholders' expectation. Most of your question will be R greater than K or R less than K. Yeah. And then you see these questions. Question number one, just for discussion. K is 12%. Did you notice? Whereas R is 15%. That means R is greater than K. You answer now. What is the meaning of R greater than K? Shareholders' expectation is less, whereas company can earn more. That means keeping more reserve is a good decision. Keeping less reserve is a bad decision. Now, what are they talking about? They want to pay 30% earnings. That means 70% reserve. 90% of earnings. That means only 10% reserve. No dividend. That means 100% reserve. When R is greater than K, 100% reserve is the best choice. They may ask this as a 1 mark MCQ also. They'll give you these and ask you which of the following is the best payout ratio: 0%, 25%, 50%, 100%. If R is greater than K, you should pay no dividend. What if it is reverse? Say K is 12 and R is 9%. Then what we should do? Shareholders' expectation is 12%. You can earn only 9%. Should you keep their money? No. You should give maximum dividend. That means the best answer will come if you pay 100% dividend. If you just understand R equal to K, R greater than K, R less than K, this Walter and even Gordon model is over there itself. Because this has nothing more than R greater than K, R less than K. Equal to K is only theoretical. You don't have practical problems on. Okay. Now you see what is the other way in which they can ask question. Observe question number 2. EPS 30 rupee. Dividend payout ratio is 25%. So I can understand this as 75% reserve ratio. Correct? K 13% or 10%. Can you tell me what did you notice? R is less than K. Hmm. Calculate price of the share. Now, originally they were planning to pay 25%. They want you to work out. Then they came with two other plans, 40% and 10% payment. Please answer. When R is less than K, how much should you pay? What is the best answer? 100%. That's why they created next question. Do you recommend any other alternative? For these kind of questions, you should mention that we recommend 100% payout ratio. And when you recommend that, they say you work out the number also. Then what happens? D itself will be full 30 rupee because you have recommended 100% payout ratio. That means any question, if you want to make, please make a note. Any question on Walter model and even the next one, Gordon model, the primary thing to check is R greater than K or less than K or equal to K. Make a note. Any question on Walter and Gordon model, basic thing to check is basic thing to check is R and K. R is greater than K, R less than K. Theoretically, R equal to K also. But I have not seen any question in Inter so far where R is equal to K. Then there is nothing to ask only. Sub question A, B, C, D, they can't. Maximum they can do is MCQ and say 0%, 20%, 30%. Option D, it makes no impact. Then you tick that when R is equal to K. Okay. Same thing even in Gordon model. And this I discussed in cost of capital how they got this E into 1 minus B. E into 1 minus B is nothing but D. D by K minus G. And here also, remember, R and K, that will decide how much to be paid. But this Gordon model has one extra assumption that some dividend has to be paid. That is 0% dividend is not a good idea. That means at least 1 paise dividend you have to pay. You can't write 100% reserve, 0% dividend payout. Okay, make a note. Gordon model believes that some dividend has to be paid. Some dividend has to be paid. That is, that is, no dividend policy is not possible. No dividend policy is not possible. Done. And R and K comparison is the common thing in both. So this is Walter and Gordon. The last model in this is approach, and believes in irrelevancy theory. What is the meaning of irrelevancy theory? Walter and Gordon said pay more, pay less, pay zero, pay 100%, etc. Model believes how much ever you pay, it will not make any difference. In fact, they said you pay or you don't pay, it won't make any difference. It is not even more amount, less amount. The only formula you have in this is P1, sorry, P0 is equal to P1 plus P1 divided by 1 plus KE. Yeah, this will tell you price of the share today. D1 is dividend at the end of year 1. P1 is price at the end of year 1 divided by 1 plus KE. K is cost of equity to the power 1. But if you don't write to the power 1 also, it's okay because you have taken end of year 1 and to the power 1 is same number anyway. It is 1 plus R to the power 1. Yeah. Priority, Walter and Gordon model you do first one day before exam. And then next priority is approach. Okay. After that, sorry, in this chapter, there is this dividend discount model, no growth model, constant growth model, and variable growth model. Yeah. If you remember, in your notebook, I had dictated 8 to 10 additional case study type questions. I dictated question and we did in class. D0, D1, D2, it remains same, it changes. Can you please check? Yeah. Make a note in your present book wherever you're writing. Solve all 10 cases discussed in class. Is it about 10 cases? I dictated small one line questions. Make a note in your ongoing book. Practice all 10 cases done in class. For the benefit of those who are watching it on YouTube, I will upload those 10 cases as a separate video, and that link will also be there in the description. Okay, don't worry. I can't solve 10 cases now in this video, but that has all the three: no growth, constant growth, growth changing. Those who have the notebook to remember this, first 2 years it will grow at 2%, then 3 years 3%, then 4% forever. We have done 10 different cases: D0, D1, D2, D5, up to D infinity. Yeah. Mm. Those 10 cases video will be separately uploaded. Others, don't worry. You will find it in the description. Yes. Other than this, in this chapter, there is only one, not one actually, two formulas, which if you remember in class also, I told you they have never asked questions on this. But one day before exam, I don't want you to take any chance. This Gram and Dodd model and Linter model. Okay. This Gram and Dodd model has price of the share is equal to M into D plus E by 3, and Linter model has D0 plus EPS into target ratio, etc. One day before exam, or maybe on the day of exam morning, 2 minutes go through both. They've never asked a question. You don't have to worry much. You don't have to learn the logic and the concept behind this. I don't know why they have even kept in the book. This I told you in the regular batch also. But if it is there in the book, you never know. They may ask question. Okay. Before this, I think I missed one possible theory question. Remember in this Gordon model when we discussed, there was this small theory concept called bird in hand theory. Okay. Which says having one bird now is better than trying to catch two birds in the bush. Basically saying getting dividend now is better than hoping for earning more money in future. That is why he believes that some dividend today is better than too much dividend in future, because in future what you're going to get is uncertain. What is there right now currently, that's a certain income. So shareholders prefer certain income over uncertain income. This can be a 2 marks simple theory question. Don't neglect this. And those who have not gone through even one question paper, please do it today or tomorrow. They ask theory question in addition to MCQ portion. Inside MCQ 15 marks, there is no theory. That means out of balance 35, they're asking 6 to 8 marks theory. That means if there is one practical question which is tough, instead of writing that, you can write this theory answer. And that will be all these 2 marks, 3 marks theory questions. Okay. Another easy theory question. This actually came in September 2025 attempt, stock split. If you remember, one stock of 100 rupee is split into 10 shares of 10 rupee. Correct? We had written the examples also in class. Tata Steel, IEX, Canara Bank, Eicher Motors, Reliance also did 1:2 stock split, all of this. In September 2025 attempt, they asked advantages and limitations of stock split for 4 marks. Two advantages, two limitations. Easy question, but do not ignore. Dividend is one chapter where I feel theory is as important as practicals. So don't neglect other topics. I did not say this. Here I am saying this because there are a lot of theory questions that they can comfortably ask. First priority, Walter and Gordon model. Next priority, those 10 case studies, small examples we did in class. And then approach, then balance theory. At the end, those two formulas which never came in exam, but they may be waiting for you, as I always say. Okay, don't take chance. Linter model, Graham and Dodd model. Okay, this chapter and risk and leverage. These are the two topics that you should revise first, one day before exam. Both are small topics. Both have got only 3 4 formulas each. Make a note somewhere or maybe in the index page itself. Risk and leverage and what dividend decision. Two topics to be revised first. And working capital management should be revised last. In between, any order is okay. And you should do cost of capital, then only capital structure. Done. With this, we have completed dividend decision. Okay. So the next topic is working capital management, which is chapter number 7, which has 5 small components. 7.1 is treasury and cash management. Then you have 7.2 and 7.3, which is about inventory management and receivables management. And then you have 7.4, which is payables or creditors management. And last one is overall working capital management. Please make a note. This should be your last chapter during your revision because it's a very lengthy topic and you can expect only one or maximum 2 questions from this. But the time that you need to revise this topic is too much. So we can keep this as the last priority topic. And this topic is not connected to rest of the syllabus also. So even during your regular revision, you can do it at the end. There is no problem. And chapter 7.1 specifically, make a note, treasury and cash management, theory and practical, both are equally important. There are enough theory concepts. They can easily ask 2 or 3 marks theory question as well, especially from treasury and cash management. Okay. Normally, the questions that you get in this topic is cash budget preparation. Most of the questions in study material is also on cash budget preparation. Okay. If you want, as I'm explaining, you can just make a note, running note. How do we prepare cash budget? There are 2 formats. First format, either you start with opening balance of cash and add all the receipts and then pay, that is minus all the payments, and then you get closing balance. I repeat, start with opening balance, add all the receipts, deduct all the payments, and you get closing balance. That closing balance of a particular month will become opening balance of the next month, and this will continue. This is one format in which you can present. Or make a note, the second format in which you can present a budget answer is first list out all the receipts, then list out all the payments, I repeat, first all the inflows, receipts, then outflows, payments. Now the difference will be net cash flow. Net cash flow. Or some books even write it as net increase or decrease in cash. Net increase or decrease in cash. Yes. So once you start with receipt, then take out payments, you get net increase or decrease in cash. For that, you add opening balance, you get closing balance. You can make a note. For this, you add opening balance, you get closing balance. Any format is okay. I quickly repeat both the formats. Either you start with opening balance plus receipt minus payment, you get closing balance, or start with receipt minus payment, you get net cash flow or net increase or decrease in cash. For that, you add opening balance, you get closing balance. Any format is fine. This is one. Second, most of these cash budget questions will have some common adjustment. I'm listing out. One is collection, that is collection from debtors. Make sure you do at least one practice sum where you have collection from debtors in the adjustment. What do I mean by collection from debtors adjustment? They'll have a sentence like this: 80% of customers will pay 1 month after the sale, balance 20% will pay 2 months after the sale. So this is where you have cash receipt. Now remember, you're preparing cash budget. Understand what I'm saying? You're preparing cash budget. That means you have to see it from cash inflow, cash outflow perspective. Example, you have sold 5 lakh rupee worth goods in January, 100% credit sale. Now, if it is in January month credit sale, that is not going to be the cash receipt in the month of January. That will be received in February or March or even maybe April. What if it is never recovered? You call it bad debts, correct? So what you have to do when you are preparing February receipt, you have to take January sales. Then when you go to March, you have to take January sale and even February sale, correct? And so on. There are a lot of questions like this in study material and also in class material. Questions will be something like this: 80% of credit sale is collected 1 month after the sale. Balance 20% is collected 2 months after the sale. Such one working note you practice. Okay, make a note. Do one or one working note where there is collection from debtors. What is the other possibility? They may say 80% is collected 1 month after sale. Another 15%, 1 5, is collected 2 months after sale. Last 5% is never collected. Now, what do you mean by never collected? It is bad debt. Now, bad debt is not a cash inflow. Therefore, understand you're preparing cash budget here. Should not be, you shouldn't get confused with P&L account. It is not bad debt entry, correct? If there is a bonus issue of share, you will not make an entry because what you're preparing is cash budget. So if there is a provision created, provision reversed, depreciation, appreciation, amortization, none of this will be considered while preparing cash budget because it is only cash inflow and cash outflow that I have to consider. Therefore, if they say you have sold goods worth 100, 80% is collected after 1 month. That means 80 rupee will be cash receipt next month. Another 15% is collected 1 month after that. Then you will count even this as your receipt. And then they say 5% is never collected. What do you mean by never collected? This is your bad debt. And what is the entry to be done for bad debt? No entry because you're not preparing P&L account. A lot of students miss this. In question, they say 2% is not recovered. Not recovered means bad debt. Sometimes they use the word default. That means your customer is not going to pay. And if they are not paying, there is no cash inflow. And if there is no cash inflow, this should not come in cash budget. Okay. So collection. Second adjustment to be kept in mind is bad debt. Third, all non-cash items must be ignored. What do I mean by non-cash item? Just now I told you: appreciation, depreciation, amortization of some intangible assets if they give in the question. And then you have things like provision created for bad and doubtful debts. Then you may have bonus issue, stock split. Because of all of this, there will be no impact of cash. Long ago, if this as one transaction, company purchased a land worth 10 lakh, but instead of paying money, company issued 1 lakh shares of 10 each to the seller of the land. Now, what is the journal entry from accounting angle? You have land account debit to equity share capital. Understand, I repeat. Company purchased 10 lakh rupee worth land. They should have paid money to the seller of the land. They did not pay him cash. They issued him equity shares, 1 lakh shares of 10 each. Now there is no cash inflow, there is no cash outflow. That means this should be ignored while preparing cash budget. From accounting angle, journal entries: land account debit to equity share capital account. No cash, no bank. No debit, no credit of cash and cash equivalent. Therefore, this should not come. Be very careful. Don't take every item that is printed in the question. I'll just show you one sample example. Say if there is depreciation, I'll just take this. See here, depreciation amount 60,000 rupee is included in the expenditure for every month. When you are preparing cash budget, why should you worry about depreciation? It's a non-cash item. Amortization, loss on sale of asset. These are the things that you should not worry about. So keep in mind, when you prepare cash budget, only cash inflow, cash outflow should be considered. Non-cash item should not be considered. Okay. Sometimes they don't give you debtors adjustment the manner in which I told you in last 5 minutes, 80%, 20%, etc. Sometimes they give you this opening debtors balance, and then you add current period sales, say January month, opening debtors, and then you add sales, then you minus closing debtor, then also you can get cash receipts. Cash means cash and bank here. So sometimes they won't give you fatter 60%, 40%, 80%, 20%. Then this is the way to work out cash collection. I repeat, how much was there when we started the month? Opening debtor plus whatever credit sale we did. Again, sale doesn't mean total sale, only credit sale. Why will cash sale come when you're doing debtor calculation? Opening debtor plus credit sale minus closing debtor. That will give you cash receipt or cash collection. Exactly repetition. Reverse if it is creditor. Opening creditor, this will not be sales, this will be purchase. This will be closing creditor. This will be cash not collected now, cash paid. These are the two working notes that you will see in some questions. If you want to quickly make a note, opening debtors plus credit sales, opening debtors plus credit sales minus closing debtor is equal to cash collected. Cash collected. Same way. Next line, opening creditor plus credit purchases, opening creditor plus credit purchases minus closing creditors is equal to cash paid, is equal to cash paid. These are two important things. Yeah. Sometimes they may ask you to find out how much is the cash outflow because of asset purchase, say furniture. Again, this is more of your accounting discussion. You may have to prepare a small ledger account, say furniture account. Furniture account will have an opening balance, furniture account will have a closing balance. And if there is a depreciation, entry will be depreciation account debit to furniture, that depreciation will come here. Imagine 100 rupee was opening balance, 180 rupees closing balance, and 20 rupee was depreciation during the year. That means 180 plus 20 here, this is 200. Now 200 minus this will be 100 rupee. And what should this be now? Purchase. And when you purchase, you should have paid money. This becomes cash or bank, and this is cash outflow. Keep in mind when you're doing this particular chapter, any question, this is as good as solving cash flow statement chapter questions from accounts class. There also you don't do it from P&L angle. You will do it from cash inflow, cash outflow angle. Even if you start from P&L, what do you do there? Profit as per P&L account, first thing you do is add back depreciation so that you'll get to know cash profit. Keep in mind, if there is furniture, depreciation is not to be taken in cash budget, but how much is the cash outflow because of furniture purchase, that is relevant. Same way, reverse is also possible. You might have sold something. Now, when you sell, that sale value or scrap value becomes your cash inflow. So, two things are to be understood. If there is an asset purchase, if you want, make a note. Whenever we purchase an asset, there is a cash outflow. Whenever we purchase an asset, there is cash outflow. Next line, whenever we sell an asset, whenever we sell an asset, there is cash inflow. Same way answer. What happens when you take bank loan? Is it a cash inflow or cash outflow? Cash inflow when you take loan, and when you repay loan, it is cash outflow. So repayment of loan and interest should be counted as cash outflows. If you want, you can make a quick note. When we take loan, it's a cash inflow, and when we repay the loan, it is cash outflow. Same way, what happens when you issue equity shares? When you issue shares, it is cash inflow, and then when you do buyback of share, it will be cash outflow. Correct? What happens when you do bonus issue? Is there any cash inflow, cash outflow? If they say company during the year did a bonus issue of 5 lakh shares, what to do? Will there be any impact in cash or bank? No. What is the meaning of bonus issue? Free. Correct? Share capital will go up, reserve balance will come down. General reserve balance will come down. There is no cash movement. Make a note if you want. When there is a bonus issue, there is no cash inflow, there is no cash outflow. Next common adjustment they give in this cash budget is minimum balance condition. Now, what happens when you have minimum balance condition? Suppose question says company wants to maintain 1 lakh rupees of minimum balance every month. You started the answer with January month. 1 lakh is the minimum balance, but you came down to 80,000 by the time you did receipt minus payments. Now, 80,000 is where you are, but you want to maintain a minimum balance of 1 lakh. That means you will have to take a loan of 20,000. Then you'll come back to 1 lakh, and then you start that as your next month opening balance. Some students, they reach 80,000. They say add loan taken 20,000. They do a plus. They reach 1 lakh, but next month when they start with 80,000 again. When you take loan, just now you have written, when you take loan, what happens? Your cash in hand balance will go up. Cash in hand means cash and bank balance will go up. So your opening balance will not be 80,000. Opening balance will be 1 lakh rupee. What if next month you have 1 lakh 35,000? You had taken a loan of 20,000, you repay. Now out of 1 lakh 35,000, if you repay 20,000, you'll still be 115,000. That is above minimum balance, no problem. What if second month itself, your balance is 105,000? Now you can't repay full 20,000 loan. If you repay the loan, then you'll have a shortage. Okay, I repeat. January you had 80,000, you took 20,000 loan. February you have 105,000. Now more than 1 lakh, but you should repay only 5,000 loan, because if you want to repay full 20,000, again you'll go down to 85,000, again you need 15,000 loan. Instead, you repay only 5,000. So whenever there is a minimum balance condition, keep in mind, do I have shortage of money? Yes, then take loan. If I have excess money, repay the loan. When I have shortage, take the loan. When I have excess, repay the loan. But when question says minimum balance 1 lakh, and what if I am always above 1 lakh? No need to worry. Every month you have 1.2 lakh, 1.8 lakh, 1.7 lakh, then this minimum balance adjustment is of no relevance at all. Okay. Sometimes they come with maximum balance. Now we have to think exactly in reverse order. What if they say maximum balance company wants to keep is 1.5 lakh? January month you started, you have 1.4 lakh as closing balance. Should you worry? Definitely no, because maximum balance is 1.5. Below that is okay. Second month, you have 1.6 lakh. Now you should worry, because question says they have to maintain maximum of 1.5 only. What if now you are standing at 1.6 lakh, that extra zero point 0.1 lakh or 10,000 rupee, what to do now? Invest. Correct? And when you make investment, what happens? Making investment means you have to buy some bonds or shares, etc. That will result in cash outflow. Make a note if you want. Whenever we have excess cash and we decide to make investment, I repeat, whenever you have excess cash and you decide to make investment, comma, there will be cash outflow. There will be cash outflow. Same way, when we sell those investments, there will be cash inflow. When we sell those investments, there will be cash inflow. Okay. I repeat, your answer will be something like this. Opening balance of January plus receipt minus payment, you will come to closing balance. And question says maximum should be 1.5. That means if you are at 1.3, 1.4, there is no problem. But if you're at 1.8, but maximum is only 1.5, that means you have crossed zero point 0.3 lakh, you have excess cash. What to do? Invest. Now, once you reach closing balance, then you have to put one more line minus investment made. Minus because when you make an investment, there is a cash outflow. Later, when you sell those investment, it will be plus investment sold. When you sell a share, you have cash inflow. When you buy a share, you have cash outflow. Third possibility, they say company wants to maintain fixed balance. Observe the wordings. 1.2 lakh rupee. What is the meaning of fixed balance 1.2 lakh? Neither above this nor below this. Neither above nor below. Now answer. Think and answer. Those who are watching on YouTube, if it is difficult, pause the video, slowly answer, and then only continue watching the video. Okay, let me ask the questions. When they say fixed balance is 1.2, listen now. Suppose we started with January, our closing balance came to 1.1 lakhs. What to do now? Question says fixed balance, and we reached 1.1 lakh. What to be done? We have to take loan. We have reached 1.1, but we need 1.2. That means you have to take zero point 0.1 lakh of loan. We will come to 1.2. That will become opening balance of February. Suppose February closing is 1.8 lakhs. Now we can't keep more than 1.2. Out of 1.8 lakh, first thing to be done is the loan that you took in January, you have to repay. The loan that you took in January, you have to repay. But then also we will still be at 1.7 lakh. But question says fixed balance is 1.2 lakh. Now what to do? 1.7 minus 1.2. The zero point 0.5 excess you have, you should invest. That will be investment made. Now again you came down to 1.2. Next month, again you reached 1 lakh. Now you have a shortage of 0.2 lakhs. You have a shortage of 0.2 lakhs. You will not take loan because you have made investment in the previous month. Sell those investments. You made an investment of 0.5 lakh, but now you have a shortage of only 0.2 lakh. So you have to sell investment of only 0.2 lakh. So make sure you practice at least one question which has fixed balance, because minimum and maximum balance questions are easy to solve. Fixed balance is where students get confused. Neither more than that nor less than that. That's the key to remember. Okay, let me write some simple numbers. Say January, February, March. Question says fixed balance of 100 you have to keep. Okay, we started with opening balance. We did receipts, payments. Focus now, answer. Suppose closing balance came to 90. Tell me what needs to be done. It says fixed balance 100. That means what has to be done? I have to take loan of 10. Correct? So I'm writing in short form. Loan taken. Then we will reach closing balance of 100. Now this will become opening balance of February, and then you do all plus and minus, then you reach 140. Now question says fixed balance 100. That means I should not keep anything more than this. Correct? Now don't say entire 40 I will invest. You had taken loan in the past. What is the first thing to be done? Repay that loan. First make it minus 10. Now when you do that, loan balance became 0, but 140 minus 10, you still have 130 with you, that is 30 excess. That 30, what to do? You have to make investment. Why negative sign? When you make investment, there is cash outflow. I am buying Infosys shares. That means cash has to go out from my pocket. So this will be loan repaid, and this will be investment purchased or investment made. And we came back to 100. Correct? This will be March month. So every month it will be 100 only because question says fixed balance. Easy to follow. What if now we reach 60 lakh? 60. Now don't say we will have to take loan of 40. You already have your own investment of 30. First sell those investment. but 60 plus 30 will still be 90. You still have a shortage of 10. Then you have to take one more loan. Now, this will be investment sold for that. Whatever is not there, you just write it as dash, don't keep it blank. Now you again came back to 100 and next month and this will continue. So make sure you do one question during your revision which has both minimum, maximum and fixed. Obviously minimum, maximum, if it is single number, that is called fixed balance. Have you made a note? These are the questions that can be asked from cash budget perspective. There is one more question in study material also, which has something to do with float delay. It is called settled fund and unsettled fund. Simple, this is as good as your bank reconciliation statement concept. Yeah. When you are preparing cash budget, you will not rely on unsettled funds. You will always rely on settled funds. Now, what is the meaning of this? Suppose I have sold goods to him and I collected check from him on Monday. Check is with me, money is not still with me. Check has come on Monday. I have to go to bank and bank also will take time. Assume I will go to bank on Thursday and bank may take 1 day time. That means Monday I received check, but actual money will come to me only on Friday. Correct? Now from Monday till Friday morning, such money remained uncleared. Now this is the delay from Monday, Tuesday, Wednesday, this delay. Now, sir, how to avoid this delay? We can do online payments, internet banking, NEFT, RTGS. You have digital payment now, Google Pay, Phone Pay, and all of that. That theory is also there in this chapter. Float, billing float, mailing float, the delay. One of the important theories in this particular topic. Same way, reverse can also happen. I have purchased goods from her on Monday. I gave her check on Monday, but she may go to bank after 5 days. Now, Monday I gave check, it is cash outflow, but cash has not gone, only check has gone. So when you prepare the cash budget, keep in mind it is not the date on which check is given. It is the date actually money left your bank account. So you should not consider uncleared fund, you should always consider cleared fund. What is the difference between cleared fund and uncleared fund? Cleared fund is where money is under your control. You want to spend, you can spend. But if you have check, you can't spend that check. You have to first deposit that check. Money should reflect in your bank passbook. Then only you will have the freedom to spend it. So keep in mind, Monday I received check, Friday I received actual money. So I should count it as receipt on Friday and not on Monday. And this adjustment is there in one very good question in study material. And in the regular class material also, we have done one question, cleared fund and uncleared fund. Okay, so these are the common questions that you will have in cash budget. Apart from that, make a note. This topic has some important theories, as I told you just now. First theory being float, FLOAT. Float basically means delay. And there are 4 types of floats: billing float, mailing float, billing float, mailing float, check processing float, and bank processing float. This can be one theory question. Make a note. Another important theory is concentration banking and lockbox system. Concentration banking and lockbox system. Then there is one theory called Miller-Orr model. Miller-Orr model. Miller or ORR model. There was a small graph that told you that you need to set an upper limit, lower limit, and the moment you hit upper limit, you have to make investment, and once you hit the lower limit, you have to sell the investment. That graph and the explanation can also be asked. There is another theory which you can read very fast. You don't have to spend too much time on that. It's called virtual banking, and you guys don't need my explanation as to what is virtual banking. It's basically net banking, phone pay, Google Pay, all the banking transactions that you can do without going to the bank physically. in simple is called virtual banking and its advantages. According to me, more than advantages, they can ask challenges in virtual banking. Non-availability of network. People may not be willing to use. Your system may get hacked. Somebody may hack your device and do transactions in your bank account. All of that are the challenges or risks involved. Okay. There is one more small concept in cash management that I will discuss along with inventory management. Okay, there is a model called William J. Bommel's model, which is similar to EOQ formula. So when we discuss inventory management, which is the next concept itself, that time I'll cover this as well. Okay, this is one area where there are a lot of theory items are there. I think I already told you 2 3 times. Please make sure you don't neglect theory in 7.1, especially cash management. Entire 7, this chapter itself has a lot of theory. Cash theory is little more important. All right. Yeah. With this, we finish cash and treasury management, the first part of working capital. Okay. Next discussion is inventory management. Even in ICS study material, this topic is only half page, not even 1 page. Okay. This is more related to cost accounting than financial management. In cost accounting, you have the topic called material cost. In that, you have EOQ's detailed discussion with discount, without discount, accepting the offer, counter offers, and all of that. But since inventory is also a current asset item, and this chapter is all about working capital, which is current asset and current liability, they decided to include this as well. So my suggestion, make a note one day before exam, not more than 5 minutes on this. In that also only one thing you have to go through, EOQ formula. I hope most of you can recall EOQ formula, square root of 2AO by C, correct? Square root of 2AO by C. A represents annual raw material requirement. You have it on screen. O represents ordering cost. Every time you place the order, basically the transportation, loading, unloading, transit insurance, all of that, divided by C, that is carrying cost. So when you do square root of 2AO by C, you will get to know how many kgs are to be ordered. Okay, I'll not be spending too much time on this here in FM because I've never asked a question, and this is more to be discussed in costing marathon than in FM marathon. Just 2 3 minutes on this. If I know how many kgs of raw material I need for full year, say 10,000 kg, that will be my A here. Ordering cost is the amount that I have to pay every time I place the order, which is all loading, unloading, transportation cost, transit insurance, whatever amount you pay to the driver of the lorry, all of that, even toll charges that you carrying cost. This is the loss of interest because whenever you pay money and purchase raw material, keep it in the godown. That money could have been invested elsewhere. And when you invest elsewhere, you can earn some interest. Say, for example, I had 10 lakh rupee cash with me. I had an opportunity to invest that at 8% interest for 1 year. That means 10 lakh into 8%. That would be my interest income had I invested. Instead, what I did, entire 10 lakh rupee I paid to my supplier and I purchased raw material. Now that raw material is sitting in my godown for 1 full year. Now think about this. Instead of keeping that raw material in godown for 1 full year, had I invested that 10 lakh rupee in that alternate option that I had, I could have made 8% on 10 lakh, which is 80,000 rupee. That's every kg that you buy for which you have paid money. You kept that item in your godown or warehouse. Understand, you are blocking your money. Why is it called blocking your money? If you keep it in godown, money will not grow. 5 kg stock will not become 5.1 kg. But same 500 rupee, if you invest, that can become 501 rupee. That can become 502 rupee. If you invest in bond, you will earn interest. If you invest in FD, you will earn interest. If you buy shares, you may earn dividend. If share price goes up, you can make some profit on sale also. But if you pay money to the supplier, purchase the raw material, keep it in godown for 1 full year, you are blocking the money. Money will not grow when it is in godown. Correct? It should be invested in liquid form. That is when the money will grow. That is this carrying cost. Normally they give it as percentage, 8%. Suppose 1 kg is 30 rupee. That means every 1 kg raw material that you buy and keep it in the godown, You're blocking your 30 rupee and you're losing 8% on 30 rupee. What is the meaning of 8% on 30 rupee? That would be the interest if you invest. That would have been the interest if you had invested elsewhere. Instead, what you did, instead of investing, you paid it to supplier, bought it, kept it in warehouse for one full year. If you keep it in warehouse, money will not grow. So that is this carrying cost, also called as opportunity cost, also called as holding cost. And when you put all these numbers, 2 into say 10,000 kg into 250 rupee divided by 8% on 30 rupee, you get one number, say 51,000 kg. That is called economic order quantity. Okay. If you want more explanation on EvoQ and concept and logic behind EvoQ, you need to refer to costing book. And there are a lot of questions in costing class you would have solved. EvoQ without discount, with discount, accept, reject, quarterly purchase, and they give you four options and you decide which is the best option to purchase. So that is more to be done in costing. In FM, they have never ever asked, but now they can, because there is 1 mark MCQ, so they can give you some numbers, annual kgs, ordering cost, carrying cost, and 1 mark MCQ can be EOQs dash. Okay. And two more things in this discussion you should know. If annual raw material requirement is 10,000 kg, and when you work, this is A, and when you work out EOQ, sorry, if EOQ comes to 1000 kg, what does it mean? If you need 10,000 kg per annum, you have to buy 1000 kg every time. Understand the sentence? 1000 kg is not what you keep in go down. 1000 kg is what you have to purchase every time. You make a phone call to your supplier, you should say, sir, please send 1000 kg. You will not tell him, sir, I need 10,000, but today you send 1000. He will then say, you only tell me what you want today. Don't tell me your A. I don't want your annual requirement. I want your current ordering quantity. OQ, ordering quantity. Then how many times should you order? 10,000 divided by 1000. That will be 10 times. So sometimes they'll ask you number of times, number of orders. And once you do 365 days divided by 10 times, 36 and half or 37 days, this is called frequency of ordering. Frequency of ordering basically means time gap between two orders. If you place the order today, when will you be placing your next order? That will be after 36 and half days. That means January 1st, if you buy 1000 kg, after that 36 days later, maybe February 6th or 7th, you will buy another 1000 kg. From February 6th, another 36 days. That is maybe March 12th or 13th is when you will be buying another 1000 kg and so on. This is called either frequency or time gap. These are the only things. Anything more in EOQ, you better refer to your costing book and costing sums. In FM, they have never asked, but don't take chance. Please make a note, not more than 5 minutes one day before exam on this. Okay, that's all. By the way, even in study material, that's all you have. In fact, they don't even have question and answers. They're simply given material cost in FM is same as EOQ concept that you studied in cost accounting. They just gave 4 5 lines theory and closed. There are no questions also. Okay, not important from FM angle, but don't take any chance. Spend some time at least one day before exam. 5 minutes max. Okay. Yes, with this, we are done with inventory management. Next one is 7.3 receivables management. Next discussion is on receivables management. If you want, make a note of a format in which you can solve most of these questions. This receivable management topic is all about deciding whether to give credit period to our customers or not. And if we want to give, how many days or how many months it should be. I repeat, two things to be decided. One, should we give credit period or not? If you say no here itself, that means you are doing 100% cash and carry business. Correct? But if you say yes, that means you are ready to give credit. Then next question comes whether we should give 15 days credit, 30 days credit, 45 days credit, and so on. Okay. Sometimes there are questions in this format. You already have credit period of 30 days, but you are planning to change it to 60 days. That means it is one credit policy option versus another credit policy option. Okay. If you want to make a note, here is a format in which you can do most of the questions. Okay. Heading: calculation of net benefit. Calculation of net benefit. Particulars, say 30 days, 60 days, 90 days. This will be given in the question. Sometimes 0 days, which means cash and carry. Okay. Hmm. Now, what do you mean by net benefit? First, you have sales in the question. And when you sell, obviously there will be cost, variable cost, and fixed cost. All of this will be given in the question. No need to worry. Just a second. Sorry. So you have sales, you have variable cost, you have fixed cost, and then you may or may not have bad debts. Sometimes yes, sometimes no. If they don't give, you don't have to assume anything, just ignore this. One common mistake students do: bad debt, most of the questions they will give it as a percentage, say 3%, 5%. That 3%, 5% should be applied on what? Some students apply it on variable cost plus fixed cost. That is wrong. Bad debt percentage is always on sales value. Silly mistake. Please make a note. You should avoid this mistake. Bad debt, if given as percentage in question, bad debt, if given as percentage in question, then such percentage should always be applied on sale value. Sir, you said some students apply this on variable cost and fixed cost, which means total cost, basically. Why are they doing it? Isn't it common sense that bad debt should be on sales? Correct. They're doing it because the next item you minus is opportunity cost. And opportunity cost should be a percentage on total cost. They get confused. Bad debt they apply on total cost, opportunity cost they apply on sales, which is wrong. Please make a note. If opportunity cost is given in the question, if opportunity cost is given in the question, then it should be applied on total cost. It should be applied on total cost in bracket variable cost plus fixed cost. Variable cost plus fixed cost. Continue. If variable cost plus fixed cost is not given in the question, if variable cost and fixed cost is not given in the question, then we can apply opportunity cost percentage on sales value. We can apply opportunity cost percentage on sales value. Yeah, I repeat, opportunity cost, if they say 8%, 8% is always on total cost, variable plus fixed. But sometimes they don't give you variable cost and fixed. They only give you sales, bad debt, and directly opportunity cost. Now you don't have any choice. Then opportunity cost can be applied on sales. In that case, you give a note. Okay. See what I'm writing on screen. Suppose this was 30 days, 60 days, 90 days, and so on. First, they give you sales, example 10 lakh rupee, variable cost 6 lakh, fixed cost 3 lakh. Sorry, I'll keep it small. Variable cost 4 lakh, fixed cost 3 lakh, bad debt 1 lakh. Now, when you're doing opportunity cost, it should be on 4 plus 3, that is 7 lakh rupee into, if they say 12% is opportunity cost, into this is 30 days, that means it is 30 by 360. Now, this 360 or 365, you don't have to worry. They will give it in the question. If they don't give, you can take 365 and give a note, not to worry. Many students have confusion in understanding this itself. What exactly it means? Our variable cost and fixed cost. This is the money that we have spent from our pocket. 7 lakh rupee is blocked for 30 days. Why it is blocked for 30 days? Because we gave 30 days time to our customers. Understand? I purchased this pen for 9 rupee. I sold it to my customer at 10 rupee. My 10 is not blocked. Only my 9 is blocked. That 1 rupee profit is not my money. Many students, they directly apply this 12% on entire 10 lakh rupees saying, sir, my 10 lakh is blocked. Please understand. I'll repeat. I bought this pen for 9 rupee. That means my money was only 9 rupee. I sold it to my customer at 10 rupee. Then that customer is taking 30 days to pay. Now my money blocked is not 10 lakh. My money, sorry, not 10 rupee. My money blocked is only 9 rupee. I have never spent 10 from my pocket. 9 is what I have spent. 1 is the profit that I have added. Profit is the money that I added, the number I added. That is not the amount I've spent. To say I have blocked, I should have incurred that 1 rupee. I have not incurred that 1 rupee. I have incurred only 9 rupee. Therefore, when you apply this 12%, understand your 7 lakh is blocked for 30 days. What is this 12%? Instead of doing this business, that 7 lakh rupee, you could have invested. If you had invested, you could have made 12% interest. But you should not just stop here. 7 lakh into 12%, that will be full year. You are giving only 30 days time. Therefore, 30 by 360. Be careful when you do 60 days. Sales may get doubled, variable cost may get doubled, but fixed cost will not get doubled. Fixed cost will still remain same. Make a note while working out net benefit table. While working out net benefit table, make sure that fixed cost is same in all the columns. Fixed cost is same in all the columns. Correct? When sales are doubled, fixed cost will not be doubled. It's like rent. Just because you are giving 60 days time, sales are going up, variable cost is going up. Why will rent go up? It will not go up. So now when you do, it will be 8 plus 3, 11 lakh into rate of interest. But now it is not 30 days. Remember, you are giving 60 days. So this has to be 60 by 360. 360 or 365. Not to worry. Go as per the question. Okay. Sometimes question itself has everything in months, then you don't please change it to days. This is, I don't know why students want to get into this trouble. When question says 1 month, 2 month, 3 months, they want to convert it to 31 days, 30 days, then get confused with 365, 360 denominator. When they say 1 month, you simply do 1 by 12. Here, when they say 2 months, you do 2 by 12. If they give in weeks, you work out in weeks. You don't change the time period. Okay. Now, another common mistake that students do while doing this net benefit table, I repeat, first you take sales minus variable cost, minus fixed cost, minus bad debt, minus opportunity cost. Sometimes in question you have 30% income tax. What students do? They will work out this net benefit before taxes. Following net benefit before taxes, then they apply 30% tax on this. This is wrong. Why I should not do tax calculation this way? Income Tax Act doesn't allow opportunity cost. I repeat, Income Tax Act doesn't allow opportunity cost. So you cannot minus opportunity cost first and then pay taxes. What happens when you minus an opportunity cost? Your benefit will come down. And if that comes down, your tax will come down. Therefore, what should be the correct way? Once you reach here, focus on screen, you have sales, variable, fixed, bad debt. You calculate here itself. Net benefit before tax and opportunity cost. First you deduct tax and then you deduct opportunity cost. Now you see tax is done before opportunity cost adjustment. Now there will be no problem even from income tax angle because we have first calculated tax and then deducted opportunity cost. I repeat, make a note. If in any question income tax rate is given, then first calculate tax amount. First calculate tax amount and then calculate opportunity cost. And then calculate opportunity cost. Next adjustment in this. I told you they'll give you 30 days, 60 days, 90 days, and you can start working out. Instead of this, they can give you debtor turnover ratio. This is something you have in ratio analysis topic also. Instead of giving 30 days, they say in a year, company will collect money 12 times. They give it as debtor turnover ratio 12 times. Now, what is the meaning of 12 times debtor turnover ratio? 360 days divided by 12 times, once in 30 days. If in any question you see debtor turnover ratio as the starting point, I'll show you one sample such question. See here, debtor turnover ratio 4 times. What is the meaning of 4 times? In a year, you will collect money from your customers 4 times. So if you do 360 days by 4 times, you get to know once in 90 days. Then your answer will start with the heading 90 days here. If they give you debtor turnover ratio, convert it to collection period. Make a note. Debtor collection period is equal to 360 or 365 days divided by debtor turnover ratio. 360 or 365 days divided by debtor turnover ratio. Okay. Next adjustment, and another place where students do mistake. Sometimes they say presently company is selling 10,000 units. Selling price 20 rupee. Total cost 18 rupee. Variable cost 14 rupee. Now what does that mean? You should understand fixed cost is 4 rupee because 14 plus 4 has to be 18. Correct? And then they say presently company is giving 30 days time. They're planning to give 60 days, because of which sales 10,000 will become 12,000 units. Now answer. Selling price 20 per unit will remain 20. But when you do sales value, it is 10,000 into 20. In future, it is 12,000 into 20. Following? What will happen to variable cost 14? 10,000 into 14. In future, it is 12,000 into 14. But what about fixed cost? Presently, 10,000 into 4. In future, should I do 12,000 into 4? No. The common mistake many students do. 10,000 into 4. What does that mean? Total fixed cost is 40,000 rupee. In future, instead of selling 10,000, if you sell 12,000 also, 40,000 will remain same. Common mistake that many students do. Sir, but you multiplied 14 here for variable cost, correct? Variable cost will vary whenever units change, but fixed cost will not vary just because units change. It's like having more students or less students in the class. Classroom rent will not change, correct? But how many books you have to print, that will change. If you have more students in the class, you have to print more books, but rent will be same whether you have more students or less students, or even if there is zero number of students. Correct? Keep in mind, make a note if you want. Variable cost is always calculated on per unit basis. Variable cost is always calculated on per unit basis, whereas fixed cost is calculated on total basis. Fixed cost is calculated on total basis. Next line if you want. Total fixed cost will not change. Total fixed cost will not change. Total fixed cost will not change. Next variety of adjustment is cash discount adjustment. Listen to me, it's not tough. This is necessary even to understand creditor management, which is our next subtopic discussion. Sometimes in the question they say company is offering 2 by 10 net 30 as the credit period. What is the meaning of 2 by 10 net 30? You have to think from seller's point of view. We are learning debtors management. I have sold goods to a customer. I gave him 30 days time. But I gave him one more offer that if you pay on or before 10th day, on or before 10th day, you will get percent discount. Take an example. 100 rupees is the invoice value. I have sold goods to a customer worth 100 rupees. I told him you have 30 days time to pay this 100 rupee. But if you come on or before 10th day, that means 10th day also, 9th day, 8th day, anything before 10th day, then I'll give you 2% discount. You have to pay only 98 rupee. Now, why do you think a seller is doing this? There may be many customers who have money in their pocket, but because you gave them 30 days, they will not pay till 30th day evening. It's not that they don't have money. You offered this credit. Maybe you have put this as your uh, basic way of doing the business. Anytime I sell, you get 30 days. What if that customer has that money in the pocket and then you tell him, sir, we always give 30 days? Then he says, okay, why is he in a hurry to pay you early? Correct? Many people will have money, but because you gave them 30 days, they won't pay. Or second problem, some people can pay on 21st day itself. They may not need 30 days. But because you gave them 30 days, though they have money, they will delay it by 9 days. Anyway, there is no advantage of paying early. Somebody was ready to pay on 12th day itself. He had enough money. But he thought, why should I pay on 12th day? Anyway, I have 30 days time. I'll keep the money for 18 more days. But if you give this offer, just think about it. Somebody who was otherwise paying on 12th day, if you give him this offer, there is a chance he may arrange the money 2 days early and come and pay you on 10th day itself. But now he will not pay you 100 rupee, he will pay you only 98 rupee because you have to give him cash discount. Now think from seller's angle. What is the advantage of giving cash discount offer? People will pay you early. Those people who have money but still delay, they will not delay now. Those who are ready to pay, but because you offer time, they used to pay on 30th day, now they may also pay little early. This is the advantage. Now, what is the advantage in money value? When customers pay you early, opportunity cost will come down. Just now, 10 minutes back, I told you that 9 rupee was blocked for 30 days in my pen example. My 9 rupee was blocked for 30 days, but now he will come and pay on 10th day itself. That means my opportunity cost calculation will be 9 rupee into 12% into only 10 by 360. It will not be 30 days by 360. So this is the advantage. But what is the problem? The problem is instead of collecting 100 rupee, I'll be collecting only 98 rupee because I'm giving now 2 rupee discount. What if opportunity cost was 3 rupee and cash discount is only 2 rupee? Then 3 versus 2, I can take the decision. Therefore, one good thing, one bad thing. This can be even a theory question. Why should a seller offer cash discount? What are the advantages and disadvantages? Advantage of giving cash discount, customers will pay early. And when customers pay early, your opportunity cost will come. What is the disadvantage or limitation of this? They will pay early only because you have offered them discount. That means they will not pay you full 100 rupee. They'll pay you only 98 rupees. So there is loss of 2 rupee because of discount. And what was the advantage? Instead of collecting on 30th day, you may now collect on 10th day itself. So 20 days of opportunity cost you will reduce. Clear? Next adjustment. Sometimes they say this customer, you will sell goods to him, 100 rupee worth item. He will not pay in one installment, he will pay in multiple installments, something like this. After 30 days, observe, he will pay 20% of the bill. After 60 days, he will pay 40% of the bill. After 90 days, he will pay balance of the bill. Now what happens? If the invoice value is 100 rupee, and when you do opportunity cost calculation, your 20% of 100 rupee, which is 20 rupee, 20% of 100 rupee is blocked for 30 days. 40% of 100 rupee, which is 40 rupee, is blocked for 60 days. And another 40% is blocked for 90 days. What are the type of problems that I discussed in last 20-30 minutes? You sell goods today 100 rupee, he will pay on 30th day. That means it was single payment. In such case, how did we work out opportunity cost? Amount into rate into time. Easy to remember, amount into rate into time. But now what is happening? Amount into rate into time, there are three line items for time: 30 days later, 60 days later, 90 days later. And it is not that full 100 rupee will come, it is coming in installment basis. So in such questions, you have to work out opportunity cost as three separate line items. How to do? Amount is 100 into 20%, correct? Into rate into time. Next, one more line: 100 rupee into 40% into rate into time, 60 days. Say opportunity cost is 12%. Now, understand: 100 into 20% into 12% into 30 by 360. First line. Second line: 100 rupee into 40% into 12% into 60 by 360. One more line item: 100 into 40% into 12% into 90 by 360. Imagine this installment headache was not there. How did we work out so far? 100 into 12% into 30 by 360. Single line. But now, because he's paying in installment basis, you should also calculate opportunity cost on installment basis. There is one good question like this both in my class material, also in ICA study material. Please make a mark and solve that question. Make a note. Solve the question which has installment basis payment. Okay. Next. One more variety of question they ask is, they say currently company is working at 30 days credit and they want to shift to 60 days credit. Now we know how to do particulars: 30, 60, sales, variable, fixed, bad debt, opportunity cost. That's how we have been doing. But they add one extra word in the question: solve the question using incremental approach. Now, what is the meaning of incremental approach? What extra is going to happen? Now, what was our normal style? Sales. Correct? Say 100 lakh, it will become 120 lakh. Variable cost 80 lakh, it will become 88 lakh. This is how we have done. But if they say incremental approach, a small change has to be done in your answer. See what I'm writing in black. You have to do incremental net benefit calculation. So instead of writing 100 and 120, you have to take only plus 20. Instead of taking 80 and 88, you have to take only extra 8. Incremental means extra. So here you used to write sales and variable cost. Here you will have to write incremental sales and incremental variable cost. Earlier, fixed cost was 5. Now also 5. Obviously, there won't be any incremental fixed cost. Earlier, bad debt used to be 1 lakh. Now bad debt is 2 lakh. Now how much is incremental bad debt? Extra 1 lakh. Now if you see this, earlier we used to call it as net benefit. Now we will call it as incremental net benefit. Able to follow? Earlier you used to compare this number versus this number and select the higher of the two. But now positive 20 minus 8 minus 1. That means you will get positive 11. What is positive? That means changing the policy is a good idea. Changing the policy is a good idea. If the number is negative number, then we should not change the policy. That means we should go ahead with existing policy. We should go ahead with existing policy. Okay. When to do this extra presentation? Now, by the way, if the question is in incremental approach, then you should not present this table. I wrote it for your comparison purpose. Then your table will have only particular amount. And your particulars column will have incremental sales, incremental variable cost, incremental bad debt. Final answer will be incremental net benefit, positive or negative. This is similar to what we did in capital budgeting: incremental net benefit when you change the machine, existing machine versus new machine. Okay. Last concept in this chapter is factoring. Now, factoring, make a note. This is important even from theory perspective. There is one practical sum in ICS study material also. Same question we have done in the regular class also. You can refer to that question. Theory and practical sums both are important from factoring. Okay, what happens in factoring? Seller will outsource the collection job, risk and headache to a third party, and third party is called factor. Now, factor will go and collect the money on behalf of the seller from the customers. Because of that, he'll charge some commission and interest. So there are two costs related to factoring. One, he will charge commission. Second, he will charge interest. He means factor. And there are benefits also. Benefit number one, entire bad debt is now avoided because he will take the burden. It is his responsibility to collect. If customers are not paying, that is his problem, factor's problem. Seller will not have to worry. Also, the collection related expenses can be fully avoided. What do I mean by collection related expenses? If you don't go for factoring, factoring is like outsourcing the collection work to somebody for which is charging commission and interest. If you don't outsource collection work, you have to do collection by yourself, seller. Now, what is the meaning of seller collecting by himself? Seller will have to appoint employees to do phone call, send emails, go to their place, maybe appoint a lawyer, file a case if they're not paying. All of this together is called related expenses. All of this will be taken care by the factor when you outsource it to him. That means from seller's angle, this will become a benefit. So two benefits, bad debt losses avoided, collection expenses avoided. Both are like money saved. And in FM, money saved is to be counted as money earned. So two benefits, bad debt avoided, collection expenses avoided. What are the two expenses you have to incur? Commission to factor and interest. So the net effect, if it is positive, then going for factoring is a good idea. If net effect is negative, then you should not go for factoring, you should do collection in-house. Make a note if you want. Two costs, commission and interest, and two benefits, bad debt loss avoided, collection expenses avoided. If the net effect is positive, factoring is preferable. Factoring is preferable. If net effect is positive, then factoring is preferable. That's it. So these are all the important concepts from receivables management. With this, we are done with 7.3. 7.4, creditors management or payables management. Make a note even on this one day before exam, not more than 10 minutes. They have never asked a question from this, but since it is part of the syllabus, don't ignore at least 5 to 10 minutes. One or two questions you can go through. I have given question and answer both in this PDF. You can go through those questions itself. That will be more than enough. Now, payable management is reverse of receivable management. In receivable management, we were worried about bad debt. We were worried about opportunity cost. We were worried about money getting blocked, etc. Here, you are thinking of paying money to your supplier, correct? Here, you have only two options. Either you pay on time, say 30 days time given, you pay on 30th day. Or if your supplier is offering you discount, something I discussed 10 minutes back, 2 by 10, net 30, if somebody is giving you 2% discount offer, then you have a choice. You can pay on or before 10th day, right? Let me take an example. Suppose you have purchased goods from somebody. Understand, you have to think in reverse angle now. You have purchased goods from somebody and they gave you 2 by 10 net 40 as a credit term by 10. net 40 as a credit term. Now you have to pay. Suppose invoice value is 100 rupee. Now what are the two options that you have? Either pay on 10th day or ninth day, 8th day, 7th day, anything on or before 10th day. If you do that, your cash payment will be only 98 rupee. Why? Because you get 2% discount for paying early. This is your one first option, negative because it is outflow. Or you can anyway pay full 100 rupee on 40th day. I repeat, what is the meaning of 2 by 10 net 40? Either you pay on 40th day full invoice value, or if you pay on or before 10th day, you will get 2% discount. Now, when it is on or before 10th day, why will I pay on 6th day or 7th day? I can pay on 10th day itself. And if not 10, why will I pay on 11th or 12th or 13th? There is no advantage. I will directly pay on 40th day. Now, first option, you pay early, you enjoy the discount. Second option, you pay late, then you won't enjoy the discount. But there is one benefit. Instead of paying money on 10th day, if you decide to pay on 40th day, understand you are keeping that money with you for 30 extra days. I repeat, instead of paying on 10th, if you decide to pay on 40th, now you will be keeping that money with you for 30 days. What will you do when you have money with you? You will invest. When you invest, you can earn some interest for 30 days. That means one benefit of paying on 40th day is we can earn interest. For how many days? 30 days. How did I get 30 number? 10th day versus 40th day. Suppose in your exam, if it is 2 by 10 net 50, then this investment will be done for 40 days. Basically, difference between paying on 10th day or paying on the due date. Correct? And by the way, don't even mug up this as 2 by 10, 3 by 10. It can be even 1 by 15, net 40. What is the meaning now? You have 40 days to pay, but if you pay on or before 15th day, you will get 1% discount. You have to decide based on the question. Some students mug up 2 by 10, 1 by 10. It is not always 10 days, it can be even 15 days. Go by the question. Now tell me if invoice value is 100 rupee. What is my first option? Pay on 15th day. If you pay on 15th day, then you have to pay only 99 rupee because you get 1% discount. What is the other option? You pay on 40th day. But if you pay on 40th day, your cash outflow will be 100 rupee. But there is an opportunity to earn some interest income. So I have to take it as cash inflow. Now, one common mistake that many students do, how to calculate this interest? Suppose interest rate is 12%. Now, one thing we know, into 12%, into how many days? Instead of paying on 15, you are paying on 40th. That means you can make the investment for 25 days only. Is 25 correct number? Sorry, no problem. 25 by 365. What did I get? 25? 15th versus 40th, the time gap. Now the question is, should I consider 99 here or should I consider 100 here? It is always 99. Why 99? You wanted to pay on 15th day. That day, instead of paying it to the supplier, you decided to invest. That means in your pocket you had 99 that day. Instead of giving it to supplier, you went and invested. Many students take 100 rupee and calculate. Understand, on 15th day you will make investment. That day, what were the two options you had? Either pay to supplier, that will be 99 rupee, or same 99 you invest for 25 days. That means interest calculation is on 99 and not on 100. Sir, why are we not investing on day zero itself? Please understand, whether you invest, when you say I'll invest on day zero, from day zero to day 15, you can anyway earn interest here also and you can earn here also. How much extra you can earn is only 25 days extra. So I've counted only extra interest, not total interest. Think, I purchase goods, today only I invest. Even if I select this 15th day option, I can earn interest for 15 days. Even if I consider paying on 40th day, I can still earn interest for 15 days. So 15, 15 is offset. How much is the extra interest you can earn? 25 days extra interest. That is why you have to count only extra interest. Following? And then you see the net effect. Here you will pay 99. Here you will pay 100. But what if this interest itself is 3 rupee? Then net payment is only 97. Now understand, you are not going to take higher of the two. You're talking about paying. You have to go by lower of the two. That means you will select 97. What is the meaning of 97? Pay on 40th day. Do not pay on 15th day. There are two questions in study material. Both I have given and solution also. Go through. I think maximum they can do in exam is put this as one MCQ for 2 marks. How much is net cash outflow if you pay on 15th day and if you pay on 40th day? Okay, that's all. This we are done with 7.4. Also, I've given the solutions as well. From this PDF itself, you can do the revision. Okay, now the last part of this chapter 7.5, overall working capital management. This is the detailed part of the full chapter, detailed in terms of lengthy questions that you have. Okay, there are two parts again. These are the basic things: current asset and current liability. You know very well. One important segment, the first segment, is operating cycle concept. This is easier part of the chapter. Operating cycle. Please don't ignore this easy part of the chapter. What is the meaning of operating cycle? This is the time gap from cash outflow and cash inflow. The time for which a company has to arrange money from its pocket because its original amount is blocked. Now, see this. Suppose today is day zero. I have paid money and purchased raw material. That raw material is in my godown for 30 days. I'm writing it as R. I paid money today, cash outflow, and purchase raw material that will be in my warehouse or go down for 30 days. Then I start the production. It will take 10 more days. This is WIP period. Then I complete this. It becomes FG, and FG will be in my warehouse for say another 50 days. Finally, 90th day, one customer came and he took that item. Basically, I sold it to him, and he says, I need another 30 days to pay. So finally, on 120th day, you will have cash inflow. This is called debtor period. Now follow whatever I'm highlighting. For first 30 days, my money was sitting in warehouse. This is called RM period. Next 10 days, money was sitting in factory, WIP period. How did I get 10 days? 30 versus 40 in between 10 days. Then it was sitting in showroom for 50 days, 40th to 90th. Now money is blocked in the form of FG. Finally, customer came, but he said, I will require another 30 days to pay. That means you'll get your money on 120th day. Now, if you see cash outflow happened on day 0, cash inflow will happen on day 120. Your money got blocked in the business for 120 days. This 120 days is called one operating cycle period. Operating cycle is the time gap between outflow and inflow. Then for easy calculation, I'm counting 360 days. If you do 360 by 120, you will get 3 cycles or 3 times. What does that mean? In one financial year, my money will come back to me thrice. If I invest money on day 0, it will come back to me on day 120. Same money I will reinvest, it will come back on 240th day. 120 plus 120. Then 240th day I invest, again it will come back to me on 360th day. Next year, that will become day 0. Again I invest, again it will come back to me. Now you think and answer. This can be 1 mark short, 1 mark MCQ also. Is shorter operating cycle better? In my case, it is 120 days. Suppose another company has only 25 days. Is 25 days better than 120 days? Yes. You should get your cash back as early as possible. The longer the operating cycle, longer the blockage of your money. Understand, somebody is a trader, not stock market trader, goods trader. He buys goods, he sells goods. FG buying, FG selling. Now he will not have RM, he will not have WIP at all. He will have only FG. Say dealer in pen. He'll purchase pen, he will sell pen. That means he'll have only FG period. And when he sells, he's not giving any time to debtors. That means debtor is also 0. That means all that he has is only FG period. right? This is what happens in most of the FMCG stores that you know, supermarkets, D-Mart, More, and all of that. They have only FG and they don't give time to you and me. There is no debtor period. They have only FG period. Correct? If FG period is only 7 days, that means their money gets blocked for 7 days only. That means if they buy goods on Monday, 1st January, by next Monday, 8th January, the cash would have come back to them. That means they have to block their cash only for a very, very short period, very limited period. The shorter the period, faster the cycle, faster the movement of cash. Therefore, if they ask you 1 mark MCQ, shorter operating cycle is always better than longer operating cycle. Understand the worst case scenario. I took 120 days. What if some other company has 250 days? That means if they invest money today, they have to wait for 250 days for their money to come back. That many days, their cash gets blocked. Okay. Now, I wrote directly on screen, raw material will be with me for 30 days. From where did I get this 30 days? Either they give in the question or there are formulas even for this. It is called RM period. Then I said 10 days WIP. Either they give in the question or we have a formula to find out. All these formulas are there in the material that I have given to you. See this. RM period is equal to average RM by RM consumption. WIP period. Average WIP divided by RM plus labor plus factory plus opening WIP minus closing WIP. This I can even call it as cost of production. Third, average FG by cost of goods sold. Directly I'm going here. Next, average debtors by credit sale. Average creditor by credit purchase. One shortcut to remember all these formulas. See the numerator. You want RM period, average RM. You want WIP, average WIP. You want debtor, average debtor. So easy way to remember numerator, whatever I want, average of that. How to calculate average? They should give you opening balance and closing balance. What if they don't give opening balance? Take closing balance itself. You don't have to worry. Clear? So denominator, how to remember? RM, what do? You consume. Therefore, denominator for RM is consumption. WIP is related to production. That means denominator should be cost of production. Same way, debtor is for credit sale, creditor, credit purchase. Everything, why are we multiplying 365? Why not into 100? Because I want answer in days. I don't want answer in percentage. Following answer should be in days. Now this again 365, 360, don't worry. Go as per the question. If nothing is there, you take 365 and solve it. No problem. Yeah. I quickly repeat all five. RM period is average RM by RM consumption. WIP period, average WIP by cost of production. FG period, average FG by COGS, cost of goods sold. Debtor period, average debtor by credit sale. Don't take total sale. Don't take cash sale. Last one is creditor period, which is average creditor divided by credit purchases, all into 365 because you want answer in days. When you do this, you will get these numbers 30 days, 10 days, 12 days, and so on. Then how to work out operating cycle? You have to first start with RM period, WIP. This is the same thing I wrote in the timeline graph. FG period, debtor period. What if we have also taken time from creditor? Then that should be minused. When debtor is added, simple thumb rule, creditor has to be minused. When debtor is blocking my money, I am blocking creditor's money. When I cry that my money is in somebody's pocket, creditor should be crying because their money is in my pocket. So if debtor is added, creditor is deducted. Or what if I buy everything on cash? Then obviously there is no creditor, nothing to minus. So when you do all of this, say 30 days RM, 10 days WIP, just random numbers I'm writing, 40 days FG, 40 days debtor, and you get 10 days from creditor. The final answer that you get is one operating cycle period. 30 plus 10 is 40, 80, 120. This is 110 days. And then when you do 360 by 110 days, you will get number of cycles, maybe 3.5 or something. That's okay. Don't worry about the number now. This is called number of cycles. And how to calculate working capital? Easy. Working capital is equal to annual operating cost. Annual operating cost divided by, sorry, annual operating cost divided by number of cycles. Now, when you say annual operating cost, you need to consider only cash cost. That is, non-cash items such as depreciation should be ignored. Why I should ignore depreciation? Entire working capital management is about current asset and current liability. And what is the problem with current asset? Our money gets blocked. Debtor, inventory, everything. And when I say depreciation or amortization, where is the cash getting blocked? There is no cash component at all. Therefore, we don't have to worry. We should not worry about the cash, sorry, non-cash component. I need to arrange money for rent, for electricity, for supplier payment, for salary, for internet bill. But I don't have to arrange money for depreciation or amortization, preliminary expense written off, will written off. These are only book entries. There is no cash activity happening. Therefore, this has to be ignored. So in some questions, they say total cost is 25 lakh, including 2 lakh depreciation. That means you don't have to arrange 25 lakh. I'll show you one question here itself. See this. They gave you 55 days RM period, 18 days WAP period. If you want in Calci, can you quickly do it? RM 55, WAP 18, FG 22. Collection means debtor add 45 minus payment period 60 days. 80. What is the meaning of this? One cycle will take 80 days, correct? And then if you do 360, since they have given in the question, 360 by 80 will give you 4.5, I think, correct? 4.5 cycles. Now understand the meaning of this 80 days and 4.5. You invest on day 0, you will get that money on day 80. Again, you invest on day 80, same money can be reused. The money that you collected from customer, you can pay to supplier. 80th day, that will come back to you on 160th day. Now 160 to 240, 240 to 320. I'm just adding 80 days. Now 320, when you add 80, will go to 400th day, which is next year. That is why it is 4 full cycles, fifth only half. The other half will be for next year. Now, if you invest today, it will come back after 80 days. One way of understanding, whatever money I need for next 80 days, I should keep it ready. Whatever money I need for next 80 days, I should keep it ready. Now, how much money I need? Question says annual operating cost is 21 lakh, including 2 lakh 10,000 depreciation. Now, I don't have to keep 2 lakh 10,000 in pocket in calci. 21 lakh minus 2 lakh 10,000. I need 18 lakh 90,000 rupee for full year. Correct? If you divide by 360 days, you will get to know how much you need per day. What's the number? 5,250 rupee. This is the amount you need for one day. How many days you have to wait? 80 days. That means you have to keep money ready for next 80 days. Multiply that by 80. 4 lakh 20,000 rupee. This much of money is required to run your day-to-day business smoothly. Because with this 4 lakh 20,000 rupee, you can spend next 80 days. What was the amount you said per day? Every day you need that 5,000, 5,000, 5,000, and so on. How many days you can survive with 4 lakh 20,000? 80 days. 80th day, whatever you have invested on day 1 will come back to you. That money itself you can reuse. Okay. To reach this 4 lakh 20,000, there is one more way. Start again in Calci. How many days you got? 80 days, correct? Restart again. 360 days by 80 days, you get 4.5 cycles, correct? And then in Calci again start 21 lakh minus 2 lakh 10,000 was 18 lakh 90,000. This if you directly divide by 4.5, you will get 4 lakh 20,000. And this is the style in which ICI material has solved all the questions. Okay, I quickly repeat. What did we do? Plus W plus F plus D minus C. We got 80 days. Then we did 360 by 80. We got number of cycles. And then we did annual cash cost divided by number of cycles. Remember 2 lakh 10,000 you have to take out because I said including 2 lakh 10,000 is this 21 lakh. Correct? What if, sir, in exam this 2 lakh 10,000 adjustment is not there? Then entire 21 lakh should be considered as cash cost. Okay. Remember, entire working capital estimation is on the basis of cash cost. It is about how much of your cash is blocked. How much of your cash is blocked. Depreciation, you cannot say my depreciation is blocked. Correct? Rent, when you pay, money goes. Then you feel my money is with building owner. My money is with my employees. My money is with my suppliers because you paid money. But you will not say my money is with depreciation. Depreciation is a non-cash item. And you don't feel at the end of the month when you pass that entry, rent account debit to cash account, salary account debit to cash account, you know cash is going. But when you pass depreciation account debit to furniture account, you don't pay anything. It is just an expenditure. It's a non-cash expenditure. For non-cash expenditure, you don't have to arrange funds. Clear? There is another style of estimating working capital. You all know. Instead of this, you can do a list of all current assets one by one. RM, correct? WIP, FG, debtor, and so on. Here also, when you multiply, you should take only cash cost. If they say cost of one unit is 95 rupee, including 5 rupee depreciation, you should count only 90. 95 is not your money blocked. Out of 95, 5 is depreciation. Depreciation is not the money that you have blocked. I'll show you. The other style of calculating working capital is this way. They give you, see this, start doing in Calci. They gave you a small cost sheet, material, labor, overhead, total cost, profit. And then they said, first understand, many students go wrong in understanding this information. RM in stock requirement. And then at the end of the question, they said, full year, our estimation is 96,000 units in Calci. 96,000 units into 40 rupee material cost. What is the number? This is the amount of raw material you need for full year. But you don't have to keep full year stock with you. You only have to keep 4 weeks stock. That number you have in Calci, divide by 52. Now the number you have in Calci should be per week requirement. Correct? Just do into 4. This will be 4 weeks requirement. Can you read out? 2,95,000, 384 or 85, which is okay. I repeat, you also repeat along with me in Calci, 96,000 units into 40 rupee. Pause here. This will be the raw material that you need for full year. But I don't have to buy full year raw material on first day. I have to keep whatever I need for 4 weeks. That means I can simply do into 4 by 52. Into 4 by 52. Do in Calci into 4 by 52. 295,385. Okay. They have given in weeks. You also solve in weeks. If they give 30 days, you will take 30 by 360. They give 2 months, you will do 2 by 12. Don't shift this 4 weeks to 28 days or don't shift it to 1 month. Unnecessary. Okay. Say second one. WIP will take 2 weeks to complete. Start 96,000 units in Calci into. Now WIP cannot happen just with raw material. You need raw material, you need some labor, you need overhead. That means you need full 85. Do in Calci 96,000 into 85. Sir, but if I multiply with 85, that will be cost of one unit. But this is WIP, this is not fully done. Correct. They said in bracket, only 50% complete. That means you also count only half cost. 2 into 50%. Correct. And then they said, this will take 2 weeks to complete into 2 by 52. What is the number? Yes, 156,923. Yeah. Can we try FG same way? Third adjustment says FG will be in stock for 4 weeks. Start 96,000 units. 96 is here last line. Into. To make one unit, you need RM, labor and overhead. That means full 85. Correct? This into 4 by 52. This will be your FG stock. Correct? Did you notice one small difference between WIP and FG? In WIP, they gave that 50% complete. So we multiplied. In FG, nothing is given. Why? If you have to call something as FG, it can't be 50%, 80%, 70%. It has to be 100%. And if you multiply any number by 100%, you'll get same number. So there is no use of multiplying. Sir, what if in exam they give you WIP, but they don't give percentage? Then what to do? Then you have to assume 50%. Can I assume 100%? If it is 100%, why are you calling it WIP? Sir, can I assume 0%? That means you have not even started the work. Then why are you calling it as in progress? Keep in mind, make a note if you want. If in exam WIP is given, if in exam WIP is given without degree of completion, without degree of completion, then assume 100% for material, then assume 100% for material, 50% for labor, and 50% for overheads. Why 100% for material? Because most of the production process is such that at the beginning of the process itself, you put entire raw material inside the machine. What happens during the process is only labor cost and overhead cost. Material is incurred at the beginning of the process itself. Therefore, it is 150 50. Okay. Same way. Credit allowed by supplier. Do it in calci. Now, supplier, when they say they're referring to raw material supplier, 96,000 units into how much is raw material cost? 40. This will be my annual raw material purchase. Correct. And how much of delay I can do? 4 weeks into 4 by 52. 2,95,000, 385. That means this much is my payable. Now, when you list out all the items, make sure all current assets are written once and current liabilities are written later. Some students, I don't know why, they write 1 plus 1 minus 1 plus 1 minus. That's not the correct way. If you're writing all current assets, let it be in one place. That is RM, WAP, FG, debtor. If there is any advance, deposit, prepaid item, then cash, bank. All current asset, do one subtotal. Then current liability, what all can come? Just now you did. Creditor. Same way there can be outstanding wages, outstanding expenses or overheads, and all of that. Okay. Do the next one. Credit allowed to debtors. Now, when they say debtors, they're talking about current asset. Now, debtor should be shown at total cost. I told you, your 100 is not blocked, only 85 is blocked. Correct? In calci, 96,000 into 85 into how many weeks? 8 by 52. What's the number? 12,55,000. That is the amount of debtor current asset. So how will your answer be presented? In a small table form like this. First current asset in that RM number. Second comes WIP. Then you have FG. Then you have debtor. Then you have advance or deposit or prepaid. All of that. And then cash bank. Make sure that you write cash bank at the end, because even this is presented in a particular order for a reason. RM is least liquid current asset, far away from cash. WIP is one step later. FG next. Then FG is sold to customer. Then customer will give you cash. So it should be in this order. You buy RM, you do production, you make it FG, sell it to customer, then you collect cash. That's why follow this. Same way, next will be current liabilities. Here, tell me what all can come. Creditor, and then you have outstanding wages and outstanding overheads or outstanding expenses. So all positive items, current assets, then the negative items, current liability, current asset minus current liability will be your working capital. You see one small change here, overhead 98, then they said overheads include 18 rupee depreciation. Just 10 minutes back, I told you, when you're working out, you should not worry about depreciation portion. That means for all your calculation, this will be counted as only 80 rupee. 98 minus 18. Understanding? That means when you do total cost, don't take 264. You have to do 117.49 plus 80. That number. Can you do it? I think you'll get 246 rupee. That should be taken for all the calculations. I hope this is clear to you. Depreciation should not be taken. Yeah. So these are the two ways in which working capital can be estimated. Either you do it from operating cycle way, or you do it in the form of a list, all current assets and all the current liabilities. Okay, make sure that, write down, make sure that you do one sum on operating cycle concept and one sum on, I repeat, one sum on operating cycle concept and one more sum on regular estimation concept. Regular estimation is the one that I discussed just now. List out all current assets and all current liabilities. Sometimes they even give you safety margin. That is, you work out all current assets, all current liabilities, current asset minus current liabilities, working capital. On that, you have to add some safety margin. That will be the final working capital answer. Okay, this is lengthy chapter. We are in 7.5 now. If you count from 7.1 till here, it will take a lot of time during your revision. So don't sit on this topic for too long. Okay, the time that you need for this one chapter, you can finish other three topics: risk and leverage, dividend. Those are all smaller topics. You can do that first. Keep it as the last priority topic. One day before exam, also, this should be the last topic for revision. Okay, and one more small concept, just 2-3 minutes. Once we estimate working capital, all current assets minus current liabilities, we need to arrange so much money, correct? What if we don't have money? We then go to the banker for loan. How much loan can banker give? There are three formulas, and those three formulas are given by Tandon committee. You remember in the class we discussed this at the end. Their formulas are given in the textbook also here. 75% of whatever current asset minus current liability that you need. Second, 75% of current asset outside the bracket is current liability. Third, 75% of soft core current asset minus current liabilities. Go through this also. They have not asked many questions from this, but they can ask. They know that you are not reading this. Okay, don't miss. And I think I forgot, in the cash chapter, that is 7.1, I told you there is one concept similar to EOQ, William J. Bommel's model. That is same square root of 2AO by C. But A will not be annual raw material, that will be annual cash. O will not be ordering cost, it is transaction cost. That is why it is written as P. And carrying cost is written as holding cost, which is H. I think I forgot that when I was discussing inventory. I told you I will, but I forgot. So that you can understand as EOQ concept in cash. That is one. And this Tandon committee. These are the two small things, but people ignore this. So you don't do the mistake. And this can be very well asked for a 1 mark MCQ. Okay. With this, we are done with full 7.5. With this, we are even done with the entire chapter of capital management. Okay. Ratio analysis. This is one topic in which everything is important. Okay, you have to go through all the formulas one day before exam. Even if you find a particular formula is easy, don't neglect. In the latest examination, September 2025 question paper, if you see, they've asked one question where current asset is given, current liability is given, current ratio they've asked for 1 mark MCQ. Okay, this is a very simple question, but then because it is simple and easy, some students tend to ignore some of these ratios. Don't do that. Make a note somewhere. One day before exam, every single formula of ratio analysis you have to go through. Can be asked in MCQ, can be asked in descriptive format also. Okay, let's revise all the formulas once, starting with first liquidity related ratios. Liquidity is basically ability of the business to pay off its day to day commitments, salary, rentals, electricity, supplier payments, and all of that. To pay all of this, you need money, but your money will not be in the form of cash all the time. Money may be blocked in the form of debtors, advances, deposit. Sometimes it can be in the liquid form, cash in hand, cash at bank, and even marketable securities. Temporary investments are included in current asset. Make a note if you want. A lot of students do this mistake. Cash, bank, marketable security. This is the term they use, or sometimes in the question they can give it as temporary investments, either temporary investments or marketable securities. Both. You have to treat these as current assets. If they say FD, RD, Government of India bonds, investment for long term duration, then don't include that in the definition of current asset. Cash in hand, cash at bank, marketable security, or temporary investments. Sometimes in the question they give 182 days treasury bill. Now 182 days is less than a year. It should be counted as current asset, short term investment. And in accounting, your definition of short term, long term is based on less than a year, more than a year. So when they say 182 days bond, that means you will invest today and you'll get the cash within 182 days. It should be counted as a current asset. Don't include fixed deposit, recurring deposits, and long term bonds. If they say 10 years bond, 2035 bonds, 2036 bonds. Now, standing in this year, 2035, 36 is 9, 10 years away. That means it should be considered as a long term asset. Okay. Now, first ratio is current ratio. Very simple. This is one ratio where students don't do the mistake. Current assets and current liability. I told you what all to be included in current asset. Stock includes RM, WAP, FG. Such a silly mistake many students do. Stock is not only RM stock. Include WAP, include FG also. Debtor, bills receivable also. Cash and bank you anyway know. Other receivable accruals, that is prepaid expenses or income to be received. Nothing but your debtors and bills receivable, all of that can be included. Coming to current liabilities, you already know all those items that are to be paid in less than a year. You can't postpone creditor payments for years together. You can postpone for months together, but you cannot. Make a note of one more thing. In balance sheet, if there is something called term loan, don't include term loan here. Term loan means long term loan. That should be considered as long term debt, not short term debt. Make a note, inverted comma, term loan is a long term liability. But if they include bank OD, if they give short term loan, then you can take it as current liability. Like credit card, you can't delay credit card payment for years together. But if you have taken a housing loan, you have 20, 30 years to pay. So the word term loan refers to long term loan. Sometimes in balance sheet, they'll give you loan in bracket short term, next line loan in bracket long term. Then there is no confusion. Short term should be included in current liability, long term should not be included in current liability. With respect to loan, be very careful. All outstanding items are counted as short term, outstanding salary, outstanding rent, etc., which is easy for you to identify from balance sheet. Okay. Current asset by current liability. Ideally, a healthy ratio is 2 is to 1. There are questions you may remember in the regular batch where they give you industry average and you will have to work out for your company and compare your company ratio with the industry average. Or they give you 3 years data and you'll have to work out 3 years ratios and write your comments. We have done these kind of questions in regular batch also. Okay. At least industry average comparison with your company's number. Such one question you practice. Make a note. A question is such that they give you industry average, say textile industry average, and they ask you to compare that with your company, which is also in textile industry. Such one question you revise. I'll show you one such question later. We have done it in the regular batch also, but I want you to specifically revise such question. And they ask you, is your company better than the industry average, or you have to improve compared to industry average? And 2 is to 1 is considered to be healthy for all the manufacturing and trading industry. For service industry, 2 is to 1 is not the correct item because service industry will not have inventory. And that inventory segregation comes in the second formula, where in quick ratio, you exclude only stock. Okay. And one thing to be careful here, total current asset minus stock is done divided by current liabilities. Easy way to remember the formula: in both, current liability is the denominator. In first one, total current asset is numerator. Second one, out of current asset, you take out only stock. Again, I'm repeating because many students have done this mistake in the past. Stock doesn't mean only RM stock. Sometimes they give you P and L, and in that there is opening stock RM. Next line is opening stock WAP, opening stock FG. Some of these questions are there in working capital management where they give you P and L and balance sheet. All three: raw material, work in progress, finished goods, everything to be included when you say stock. Okay, stock here doesn't mean share. Stock here means inventory. Yeah. And denominator is current liability. You remember there are other names for quick ratio, asset test ratio, and also liquid ratio. To confuse you in exam, they can use these interchangeably. Liquid, easy to remember, it should be easily flowing towards cash. Inventory will not become cash so quickly. It takes longer duration. Okay. So debtor, bills receivable, everything other than inventory you can include. So easy. Current asset is the first formula. Current asset minus stock is the second formula. In both the cases, denominator is current liability. Healthy ratio for this is 1 is to 1. Anything slightly more than 1 is to 1 is not considered unhealthy. Don't worry. But if it is very high, then you are blocking too much of cash in current assets. If it is too less, that means you will not be able to pay your current liabilities on time. All of this is there in your regular batch material, also not to worry. And those who are watching on YouTube, this soft copy of the material will be uploaded on the drive and the link will be shared with all of you. Not to worry, you can download. I hope this is clear. Moving on. Cash ratio, absolute liquid ratio. Here you see denominator is same current liability again. Make it easy. First three formulas everywhere denominator is same. But in numerator you are taking only cash, bank and marketable security. Just compare first, second and third. First they took full current asset. Second they took out stock from total current asset. Now they are taking out even debtors, advances and prepaid items. Now what is left out? Only cash, bank and marketable security. I already told you marketable security you can include even those temporary investments. This is basically whatever you have in your demat account. Click of a button, you can convert it to cash. You want it on urgent basis, you can convert it to cash. That's what is included in the term marketable security. The word is marketable. That means you should be able to buy and sell easily and quickly. Yeah. Divided by current liability. Observe in first entire current asset, next current asset minus stock. That means there even debtor, advances, deposit, prepaid items are all included. Here only cash, bank and marketable security. This is pure liquid. That's why they have used the word cash ratio or absolute liquid ratio. I have cash in my pocket, pure liquid asset. I have bank balance, go to ATM, withdraw. I have marketable security, click of a button, I can convert it to bank balance, then go and withdraw. That means you can convert all of this to cash in click of a button or in less than a day. Yeah. Last one. Here they have taken cash, bank and marketable security as it is. The third formula numerator itself is here. But the denominator is daily cash operating expense. Now, any formula, if you don't understand the logic, put some numbers. Keep 10,000, 20,000 as base for all discussion, or 10,000, 1,000. Simple numbers. Say total of all of this is 10,000 rupee. Cash plus bank plus marketable security. And what is the denominator? Daily cash operating expense. How much do you need on daily basis every single day? Suppose I need 1,000 rupee on daily basis. Now when you do 10,000 rupee that you have, divide by 1,000 rupee that you need per day. That means you can run your business for next 10 days without any fresh receipt. You don't do any cash sale, no problem. You don't collect anything from debtor, no problem. You don't have to add fresh capital, no problem. What you have? Cash, bank, and marketable security. With this, how many more days you can survive? 10 more days. Imagine numerator and denominator both are 10,000 rupees each. What does that mean? With what you have in pocket, you can survive only for one day. That is today. Tomorrow, you can't run your business unless you do fresh sales or you collect from debtors or you add your own fresh capital. Now, longer the days here, that means you can run your business without any fresh cash coming in for that many days. Imagine one company has 10 days, another has 21 days, another has 45 days. That means the third company can run their business for next 45 days without any new sale. Even if nobody is coming, say lockdown, they can survive for next 45 days. They can still pay all their daily expenses. Sir, how do I get this daily cash operating expense? You get annual cash expenses divided by 365, because I won't be paying salary every day, rent every day. But I know I'll be paying 30 days rent once. I'll be paying 30 days salary once. Therefore, most of the companies will take annual data, divide that by number of days. That's the way they get this denominator number. Okay. Longer the days, longer you can survive without depending on fresh cash inflow. Less days, that means you have to arrange money very quickly. Yeah. Moving on. Next set of ratios are related to long-term solvency. Here you don't include anything of short-term. Previous page was all short-term. Here you consider shareholders fund. Please underline the word fund. or make a note somewhere. Whenever you see the word fund, it is capital plus reserve, not just capital. Many students do this mistake. Shareholders fund means share capital plus reserves and surplus. And when I say share capital, it is both equity share capital and preference share capital. But if they use the word equity shareholders fund, then it is only equity share capital plus reserves and surplus. Remember, reserves and surplus, who owns reserves and surplus? Only equity people, not preference people. So you will never see a formula where they have done preference share capital plus reserves and surplus. It will be equity share capital plus preference share capital plus reserves and surplus, or only equity share capital plus reserves and surplus. It is never preference share capital plus reserves and surplus. They will not enjoy reserves and surplus. Yeah, the wording is fund, so you include capital plus reserve divided by total capital. Wherever they use the word total capital, that means shareholders fund plus even debt is included. Now, which debt? I'm discussing long term. That means it is only long term debt. We can include bonds more than 1 year. We can include debenture. We can include bank loans. We can use, as I already told you, term loans. Any debenture is a long term fund. You can take it here. Okay. Remember, denominator is total capital, not just debt capital. Yeah. And cost of capital chapter, we have already learned this. Capital is both equity capital and debt capital. Capital doesn't mean only share capital. So when they use the word total capital, it is share capital, reserves and surplus, and long term debt. Here, total debt by total capital employed. You can see these two formulas. Denominator is same. That means numerator covers shareholders' money, denominator covers debt money. Sorry, next formula covers debt money. Next one is total debt to shareholders fund. Easy way to remember all three formulas. As I told you, let's put some numbers. Suppose shareholders fund is 10,000 and total capital is 30,000. So this will be 10 by 30. And debt has to be 20 now, and this will be 30 only. And now this will be debt which is 20, shareholders fund which is 10. Understanding? If you do into 100, you will get it in percentage. So 1 by 3, you can put it this way also. 1 by 3 is shareholders money, 2 by 3 is debt holders money. Now 2 by 1 will be debt equity ratio. Easy. So it is not three formulas. Understand this as single formula. The formula that connects long term funds, which has two components: shareholders fund, debt funds. Add both, you get total capital. So first one is shareholders by total, second one is debt by total, third one is debt by shareholders fund. Yeah. And shareholders fund, in some problems you have seen this, they use the word net worth. Yeah. Net worth means shareholders fund only, and fund includes reserves and surplus. I'm repeating this so many times because I've seen many times people say shareholders fund, and in the answer they take only share capital. It is share capital plus reserves. Be careful. Sometimes they use the word equity, not equity shareholders fund, only equity. Equity means net worth again, and net worth means equity share capital plus reserves and surplus. This is one thing that I want you to be very careful while solving the sum. Okay, equity, if they use, say for example, debt equity ratio. Now when you see debt equity ratio, that equity is shareholders fund. Now fund includes even reserves and surplus. Okay. Next, debt to total asset ratio. Total debt divided by total asset. Easy way, total assets you will get from balance sheet asset side. Suppose this is 5 lakh rupee. Total debt itself is 3 lakh rupee. If you do 3 lakh by 5 lakh, easy way to understand, out of 5 rupee asset, 3 rupees funded by debt. That means balance 2 rupees funded by owners. Okay. Or if you do this by this into 100, you will get it as percentage. Now this will be 60%. That means 60% of assets are funded by debt. Balance 40% is funded by proprietary fund or owners fund or equity or shareholders fund or net worth. One and the same. Proprietary means owner. In a company, owner means shareholders. So when I use the word proprietary fund, I'm referring to same shareholders fund. Okay. Make a note. Owners fund, proprietary fund, shareholders fund is all one and the same. You don't have to mug up this. Proprietor means owner in a company. Owner is equal to shareholder. What if this is 99%? What does that mean? Say 5 lakh is total asset, 4 lakh 99,000 is total debt. What does that mean? 99% of assets are funded by debt, balance only 1% is funded by equity. Is it considered as highly risky from equity shareholder point of view? Assume there are no preference shareholder. If you are a shareholder, is it risky if you see your company's this ratio is 99%? Yes, because tomorrow when company is closed, all assets are sold and first they have to repay debt. Then only equity people will get money. Understanding? What if it is 0%? That means company is fully funded by equity people. Owners' money, no debt money involved. Tomorrow, if company is closed, all assets are sold. Whatever is available will be paid off to equity shareholders. Okay. Moving on. Capital gearing ratio. Some people find this formula difficult to remember. Nothing complicated here. See the numerator and tell me what is one common thing. Long term debt plus preference share capital. To both these people, we have given a commitment that you will get 8%, 9%, 10%. The percentage is pre decided. But see the denominator. We haven't given any promise, neither annual promise nor repayment of principal. Correct? That means easy way to remember numerator is fund without flexibility. We have to pay that 9%, we have to pay that 8%. Denominator fund with flexibility, we may pay, we may not pay. Even if we don't pay, they can't file a case, equity shareholders. That means easy way to remember the formula is fixed commitment funds divided by flexible funds. Numerator we have given fixed commitment, denominator there is no commitment given. What is the meaning if this ratio is 2 is to 1? If we have 100 rupee shareholders money, equity shareholders, then we have 200 rupee of debt plus preference shareholders money. Okay. Capital gearing ratio is also called as gearing ratio. Sometimes they can just say gearing ratio. They're referring to the same capital gearing ratio. Moving on. Proprietary ratio. I already told you proprietor means owner. So when you see proprietor fund, again the wording used is fund. A fund includes capital plus reserve divided by total asset. Let's put some numbers. Suppose this is 5 lakh and this is 2 lakh. Now 2 by 5 into 100, you will get 40%. That means 40% of total assets are funded by owners. Owners fund. That means again capital and reserve. In exam, again I'm repeating this. If you don't understand the meaning of any formula or any ratio, put some numbers. You know in the regular batch, we have done a lot of questions where they give ratio and you have to do balance sheet. Correct? And they give you a ratio like this. A proprietary ratio 3 is to 1. Now if you don't understand what is the meaning, put 3 by 1 and change that 1 as 1 lakh, 3 as 3 lakh. Then you'll understand if 1 lakh is this, 3 lakh is this. Understanding? Moving on. Coverage ratio, debt service coverage ratio. Easy to remember. Next one is interest service coverage ratio. Okay. Now, when a bank manager is giving a loan, the first thing he will check is whether you have the ability to pay monthly commitment or not, which we call as EMI. And EMI includes some principal and interest. So the first one is entire debt service, which has principal as well as interest component. But the next one is only interest service. Here you don't include principal portion. Understand EMI has two components, principal and interest. First formula will consider full EMI. Second will consider only interest. And the wording used is coverage. Easy to remember. When a bank manager is giving loan, what is the first thing he's thinking about? Will I get my EMI or not? So he's thinking whether his EMI is fully covered or not. Right? Now, from business angle, you will pay EBIT. Sorry, you will pay interest once you earn EBIT. Imagine interest itself is 3 lakh. If EBIT is 3 lakh, entire 3 lakh will go to bank. Easy to follow. If EBIT is 3 lakh, interest is 3 lakh, entire EBIT will go to bank. Correct? That means, see the formula, EBIT divided by interest. What does that mean? 3 lakh interest and 3 lakh EBIT. That means whatever interest is to be paid, that at least you'll be able to pay. What if this is less than 3 lakh, say EB80 is only 2 lakh. That means you'll not be paying even interest on time. By the way, I haven't counted principal yet, correct? And that is why they say at least this should be more than one. Why should it be more than one? Forget the principal portion, at least interest portion should be paid without fail. Think from bank manager angle. He should get full EMI, principal and interest. But against principal, at least there is some security. You would have given land papers, building, or some security is given. Maybe gold is pledged. But against interest, there is no security given. Correct? And interest is the source of income to bank. Think how bank will get money every month. They have to liquidate the cash coming, and they have to pay interest to those who have kept bank FD and RD. From where will bank generate money? They have to get money from those people who have taken loan. Therefore, first they want to make sure that you are able to pay at least interest on time. But interest is not enough. They want entire EMI, interest as well as principal. For that, earning available for debt service. See the wording, earning available for debt service. What is the meaning of this? As an individual, I am earning 5 lakh rupee monthly income, but that doesn't mean I can pay 5 lakh EMI. Out of 5 lakh, I have to pay my house rentals. I have to take care of my family. I have my own monthly expenses. What if I have other two loans? Minus all of that, what is left is only 2 lakh rupee. That is called earning available for debt service. This is not EBIT. This is earning available for debt service. And what if my interest plus installment itself is 2.1 lakh and I have only 2 lakh? Then bank manager will never give loan. Now, how much should this be given here? A DSCR of 1.5. 2 times is considered healthy. That means if EMI itself is 2.1, then bank manager will be happy only if you have somewhere around 3.5 or 4 here. That means he knows you will have enough money to pay monthly EMI. So first one is full debt service. Second one is only interest service. Don't get confused in exam. When they say debt servicing, full EMI. When they say interest servicing, at least paying the interest on time. Yeah. Preference dividend coverage ratio. Now, if you are a preference shareholder, you are not looking at EB80 number because EB80 number is not your number. Think if you are a preference shareholder, what is your source of income? Preference dividend. If you are a preference shareholder, your income is preference dividend, and preference dividend cannot be paid from EB80. From EB80, first they have to pay interest, then EBT, then they have to pay tax, then you have EAT. Now, easy formula, EAT divided by preference dividend. You don't get the logic, put the number. Preference dividend itself is 1 lakh. Now, if EAT is 1.5 lakh, as a preference shareholder, you feel safe. Okay, my money is going to come because company has a PAT more than what they have to pay. At least this should be 1 lakh. Then you will get your 1 lakh. You don't have to worry about equity shareholders. You're only worried about your money. You are a preference shareholder. Easy. Never put EB80 in numerator because you will not get money from EB80. What if EB80 is 5 lakh and interest itself is 5 lakh? Then as a preference shareholder, your money is not covered. Again, understand the wording. Coverage. Will I get my money? First one was bank manager thinking, will I get my EMI? Second, bank manager thinking, will I get my interest? Third, preference shareholder thinking, will I get my dividend? Now, moving on. All these next set of ratios, activity, efficiency, performance, and turnover. I've seen this common mistake by many students. Wherever you see turnover, remember ratio is measured in times. Don't put it as 8%, it will be 8 times. I hope you remember debtor turnover ratio is measured in times, 3 times in a year, 5 times in a year. It is not 5%, it is not 5 is to 1. Understanding? Make a note if you want. All turnover ratios are measured in times. First one, total asset turnover, fixed asset turnover, current asset turnover, working capital turnover. I said first one and covered 4 because all these 4 are kind of connected ratios. Read turnover by total asset. Next, turnover by fixed asset. Next, turnover by current asset, turnover by working capital. We should not mug up this as 4 ratios. Tell me what is one common thing everywhere? Turnover. And easy to remember, see the name, total asset turnover. That means denominator is total asset, fixed asset turnover, current asset turnover, working capital turnover. And sir, one more common doubt. Turnover or COGS. What if both are available in the question? Which one to take? Which one is first in the formula? Turnover, take that. If both are available, take the first one. What if only one thing is printed? then take whichever is printed. Sometimes they say total asset turnover ratio in bracket based on COGS. Now, in question itself, they say based on COGS, then you should not take turnover. You have to take cost of goods sold only. Okay, easy way to remember. Check in the question, have they clarified anything? If not, see whether both numbers are available. If both are available, always take the first one. What if only one thing is available? Then no doubt, whatever is available, you take it. Only one thing you should be careful. This mistake you did in class also. Only inventory turnover ratio is cost of goods sold or turnover. First is COGS, next is turnover. All other ratios, it is turnover first and COGS next. You can see in the next page. Inventory turnover ratio only COGS or turnover. This you have even in costing in material chapter. Okay, it is COGS or turnover. All other ratios, turnover or COGS. Those are watching recordings on YouTube. If you want, you can pause the video in between and make a note of these things. All other ratios, turnover or COGS, only inventory turnover ratio. COGS first and then turnover later. Okay. And another common mistake. Students read this total asset turnover and they write the formula as total asset by turnover. First word is not numerator always. Okay. Tell me when you can do it. First word as numerator, second word as denominator. Yeah. If there is a 2 in between, something like fixed asset to current asset, there is a 2 in between, TO. 2 in between, then you can write fixed asset by current asset. There is no 2 in between. It is fixed asset turnover. It is not fixed asset to turnover. Be careful. Yeah. All these are measured in times. Okay. What is the meaning if this is 9? Is it 9 is to 1? 9%? 9 times? 9 days? 9 times. Yeah. What is the meaning of 9 times? From 1 rupee of asset, we are generating 9 rupees of turnover. 9 times of asset is my turnover. Okay. That means if I have 10 lakh asset in balance sheet, then I should be having 90 lakhs of turnover sales. All turnover ratios are measured in times. Can I move on? Next, capital turnover ratio. Again, this should be continuation of the previous segment. Same again, turnover divided by capital employed. Remember the wording is capital employed. This includes share capital, reserves and surplus, even debt. Capital employed means total capital employed. Don't take only share capital. Yes, moving on. Inventory turnover ratio, easy one, but here COGS is first divided by average inventory. For average inventory, you need opening and closing. What if opening is not there in the question? Take only closing. What if both are available? You should always do average. What if they give you 2 years data? Then you can do average. What if they give you only 1 year data? Then you have to take closing. Then in exam, when you write the formula itself, you write COGS divided by average inventory in bracket closing inventory. Then you don't have to write one more note for that. Okay. But opening balance sheet is given and you have to do closing balance sheet. Then opening, closing, both numbers are available. You have to do average. Sometimes they give you P&L. Opening stock is there on the debit side, closing is on the credit side. Then you can take the average. Wherever average is possible, do it. If it is not possible, take only closing. While writing formula itself, replace the formula. Don't write average. If you're writing average in bracket, write closing inventory. Moving on. Debtor turnover and creditor turnover. Both are about collection and payment. Sometimes they give you collection ratio. Collection ratio is related to debtor. Payment ratio is related to creditor. Easy. Now tell me, what is the meaning of this? Suppose this comes to 9. What is the meaning of 9? 9 times in a year, I collect money from my customers. 9 times in a year, I collect money from my customers. Let's put some numbers. I'll erase this 9. Suppose my credit sales are 10 lakh and average debtors are 1 lakh. So when I do 10 lakh by 1 lakh, I get 10. Any turnover ratio I told you is measured in times. That means this should be understood as what? 10 times. Correct? So what is the meaning of 10 times? I collect money from my customers 10 times in a year. Now, if you do 365 by 10 times, you will get 36.5 days. Tell me what is the meaning of 36.5 days? If I sell goods today, on an average, I'll collect in 36 days. Correct? Does that mean every customer will come and pay on 36th day? Not necessary. She may pay on 25th day, she may pay on 41st day. On an average, when I do, I get 36, 37 days. Tell me, this number, if it is high, is it a good indicator? Is of 10 times. If your company has 21 times, 31 times, 41 times, is a high number a good number? Yes. Why high number a good number? Higher the number, faster the collection. Faster the collection means from the time you sell goods to the time you collect cash. The time gap should be as less as possible. You have calci with you, quickly do it. What if it is 25 times 365 by 25? 365 by 25 is coming to, sorry, that means you're collecting money within 14 days. You sell on 1st January, you will collect by 14th January. Collecting faster is good because you will convert debtor to cash. Cash is a liquid asset, always good. Correct? What if the ratio is one time? What if the ratio is one time? That means it is 365 by 1. Answer will be 365 days. What is the meaning of 365 days? You sell goods today, you will collect next year, same day. That means in a year, you will collect goods only once. Should I include cash sale here in the numerator? No. Understand your working out debtor turnover ratio. Common mistake. Many times, if you want to make a note, if in question cash sale and credit sale both are given, for this ratio, you have to count only credit sale. First of all, if you do cash sale, why are you calling it as debtor? Where is the question of collecting faster when it is cash sale? You are collecting then and there itself. There are a lot of questions where they ask debtor turnover ratio, and in question they print both cash and credit. Don't take total sales. Sometimes they mention this 80% of sales is credit sale. Count only credit sale portion. Sir, what if they give just sales and don't give cash sale or credit sale? Then you assume all sales on credit basis. Whenever you make an assumption, give a note. Simple. There are a lot of questions like this. I hope you remember. They simply say sales, and we have to decide. Or if nothing is given, we have to assume all sales are on credit. Give a note without fail. Now, what if this is 365? What if ratio itself is 365? What is the meaning? 365 times you will collect. Now, what is the meaning of 365 times? Every day you collect. You sell today, tomorrow morning you collect. Time gap is only one day. Faster collection. Okay. Reverse is the logic for credit or turnover ratio. This will tell you how quickly you are paying to your supplier. If this comes to 20, that means in a year we pay 20 times. In calci, if you do 365 by 20, you'll get 18 days. That means if you buy something today, you are paying within 18 days. Here also you should count only credit purchases. You should not include cash purchases. Some of this may sound silly when I say. I'm saying it because I've seen people doing these mistakes in the past. Cash purchases should not be included. Only credit purchases. What if they simply say purchase? Assume everything as credit purchase. Whenever you make an assumption, please write note. Okay. And let me clarify this once for all. 365 days or 360 days, it will not make any difference. I know answer will vary, but you shouldn't worry about this in exam. Okay. If question is silent, always take 365 and work out. But in some solutions, if they have done 360, it is not wrong. Please don't worry. Okay. Nothing is mentioned. You can take anything. Normally, I take 365 and solve. But in question, sometimes they print consider 360. Then don't change the question. And if something is already given in months, then you take 12 months only. You don't convert month data to day data and then worry about 365. If they say collection period 1 month, why do you want to convert it to 30 days? 1 month you already have. 12 months by 1 month, you get 12 times. If something is in week, you work out in weeks. Something is in months, you work out in months. Something is in days only, get confused. 52 weeks, nobody has doubt. 12 months, nobody has doubt. Only these days, 365 versus 360, I keep getting this message also. Should I take 365? Sir, I have taken 365 in study material, it is 360, so my answer is not matching. Don't worry. Please don't worry. It will not make any difference. You always take 365 and solve. Okay. But if in question, if it is printed as 360, follow the question. So one important thing. Okay. This is a common suggestion for costing FM and accounts paper. Read full question top to bottom first, then only start the answer. What if this 365 information is the last information? And first working note itself is data turnover ratio. If you don't read till the end, then you will assume something. What if they have given 360 there? Read full question, then only start the answer. Then this problem won't come. I think you don't have this worry in accounts and costing much. 365, 360. In FM, that too in this topic, you have lot of places. Take 365. If they give 360, follow the question. I hope this is clear. Okay. Having said this, there are some solutions in study material where question is silent and they have taken 360. And you also know sometimes when ratio is 90 days, they take it 360 to make it 4, and instead of doing 4.133 something. That's okay. You take 365 and solve. There'll be some minor difference and balance sheet will anyway tally. One asset will be more, the other asset will be less. This has happened in the class also. Don't waste time on this during revision. Okay, moving on. Profitability ratio. Make a note. Any profitability ratio is always in percentage. GP ratio, NP ratio, operating profit ratio, all of this. All turnover ratios are in times. All profitability ratios are in percentage. Make a note. Even rate of return related ratios are in percentage. Rate of return related ratios. Something like this. Return on capital employed, return on equity. Rate of return related ratios are also in percentage. And anything in percentage, you know, it is into 100. Easy to remember. Turnover ratios don't do into 100. Profitability ratios don't forget into 100. And some of you have this habit of doing into 100 for everything. Be careful. Okay. Mm. GP ratio, NP ratio, very simple, you know. And when you take sales, remember, if they give sales including GST, you shouldn't count GST portion. If they give sales return, you should minus. It is net sales. Okay. And GP will come from trading account. You know all of this. Easy. NP ratio. Here is one confusion. Make a note. When they say NP ratio, should I take pre-tax NP or post-tax NP? PBT or PAT? If it is a descriptive question and they have not clarified in question clearly, pre-tax, post-tax, my suggestion you do both and come. Don't take risk. If they say calculate NP ratio, in bracket if they mention pre-tax, post-tax, no problem. If they don't mention, suppose that is sub question 4, you write sub question 4 in that sub question A. They have not given, you work out both and come. Pre-tax NP ratio, PBT by sales, post-tax NP ratio, PAT by sales into 100. Make a note. If it is MCQ, they will print pre-tax NP, post-tax NP. If it is descriptive, they may not print. You should know. Safer side, do both and okay. Moving on. Operating profit ratio. One common doubt. What is the difference between NP ratio and operating profit ratio? Both are about profits. Yes. When you say NP ratio, this number is coming from P&L. And lot of non-operating items are also there in P&L account, both credit side and debit side. For example, a textile company has some excess cash. They invested in Infosys shares and earned some dividend. Now the dividend will go and sit in the P&L account credit side, because of which your net profit will increase. But when you use the word operating profit, this income should not be counted as your operating income. Correct? You did not set up the textile company to buy Infosys shares. No doubt it happened in the course of business, but it is not related to the business. Okay. So anything that is not related to business will not be counted in operating profit. But net profit will come from P&L. And in P&L credit side, you may have some interest on investment, dividend on investment, profit on sale of investment. These are not related to your day-to-day business. Suppose our academy is buying some Infosys shares and then selling it at a profit. We did not start the academy to make profit by selling shares. That happened because we had some excess cash and we bought those shares. Academy should make profit from its day-to-day business. So operating profit, when you say, it should count only what is related to day-to-day business. Easy way to remember, in accounts class, you have done this cash flow from operating activity. Correct? There you take out all this interest on investment, because that is part of investment and financing activity. Investing activity and financing activity. Correct? So you should include only what is related to day-to-day business. Yeah. GP is easy. All that comes from trading account. NP comes from P&L account. But OP, operating profit, is not from P&L account, because P&L account will have items that are not related to day-to-day business also. I hope this is clear. Return on investment. Now, return on investment is a general term, whatever you have invested and whatever you have earned. But this can again be pre-tax, post-tax. Now tell me, if I keep money in bank FD, 1 lakh rupee FD, 8,000 interest. Easy to calculate. I made 8,000 by investing 1 lakh. Now on this 8,000, I may have to pay tax. Now should I take it pre-tax, post-tax? That depends on the question. You will have a lot of questions like this: post-tax cost of debt, post-tax return on investment. Whenever they say post-tax, you minus T. If they say pre-tax, you don't minus T. What if this is chargeable at 30% tax? Then I have to minus that and then take. What if this is tax-free income? Then I have to count only this. Correct? It depends on the question. This return on investment is further segregated into return on asset, return on capital employed, and return on equity. Especially this return on capital employed, market important, because this is required even in risk and leverage topic. Mark this important. Yeah, first one is return on asset. Read PAT, add back interest. First of all, how do you reach PAT? After deducting interest only, correct? But now we are adding it back, because as I told you, interest is not your operating expense. That interest came because you took loan. If you had not taken loan, this interest would not be there, correct? You tell me, how do I get this? EBIT minus interest, EBT minus tax, EAT. EAT means PAT. For that, you add back interest, correct? Why did I deduct interest first? To pay taxes. Now, why am I adding it back? Because interest is a financial item not related to your day to day activity. So it is PAT, add back interest, divided by average total asset. Again, the wording used is average total asset. So they should give you two balance sheets, or opening balance of asset and closing balance. What if average is not available? Then you take the closing total asset. Again, the wording is total asset. You have to count total of the asset side, not just FA, not just CA, both FA plus CA, fixed asset plus current asset, into 100, because it is rate of return. Next, return on capital employed. Now, what do you mean by capital employed? Debt and owner's money, correct? That means the wording is total capital here. And when you say total capital, numerator should be EBIT. This and next, I've seen one common mistake. Observe the wording: return on capital employed, return on equity. When you think from equity point of view, EBIT should not be the numerator, because equity shareholder will never enjoy EBIT. Correct? Many students do this mistake. For return on capital employed, they take only earning available to equity shareholder. Those people who have never attended my class and watching this on YouTube, ETASH means earning available to equity shareholder. That will come after you minus everything. Correct? Interest, tax, even preference dividend you should minus. Then what you get is earning available to equity shareholder. You see the numerator of return on equity. Return on equity, what belongs to equity is ETISH, divided by equity shareholders fund only. Equity shareholders fund only. But here, return on capital employed. Now, capital employed includes equity money as well as debt money. That means this is total business, total capital. And total business will not earn ETISH, total business will earn EBIT. Simple logic. If you are taking return on total capital, then numerator should be for total business EBIT. If you are doing return on equity, then what belongs to equity? Only ETISH. Now, if ETISH is the numerator, denominator should be equity money only. Tell me, what is the mistake if I do ETISH by capital employed? Now, capital employed includes debt also. Correct? If numerator belongs to equity, denominator should belong to equity. Sounds very simple, but many will do mistake. Even you have done these mistakes. When the word is written on capital employed, take full business. Full business is earning EBIT. When you're taking return on equity, don't count full business, count only what is available to equity shareholder. Obviously into 100, because you want it in percentage. This return on equity can be worked out in a slightly longer descriptive way. I want this to be marked as important even for theory purpose. They can ask a 3 marks short note question. Explain return on equity using DuPont model. Now, this is a model that has three formulas, and the end result of three formulas will be return on equity. Now, first, NP margin, net profit, which is like NP ratio, asset turnover, and equity multiplier. You see all the three formulas. NP by sales, revenue means sales, sales by assets, and then assets by shareholders' equity. And here you saw everything is multiplied. Okay. Now, if you see revenue is the denominator here, revenue is the numerator here, and asset is the denominator here, asset is the numerator here. So, when you multiply, one will get cancelled with the other. Correct? You just see this net profit by revenue, and this is revenue by asset, and this is asset by shareholders equity, and there is a multiplication symbol in between. Revenue gets cancelled, asset and asset gets cancelled. Then what is left out? Net profit by shareholders fund. What they have invested, denominator, what they are going to get is the numerator. But DuPont model believes that you should not count only what is invested and what is the return. You have to see all three things. Now, I'll discuss this in reverse order. First of all, asset by shareholders equity. Suppose shareholders equity is 100 rupee. Okay. And asset is 80 rupee. So that's what you're doing in this formula, 80 by 100. What is the meaning? Out of whatever money company has collected from shareholders, 80 rupee is in asset. Now then where is the balance 20 rupee? Day-to-day expenses, rent, salary, electricity. Now why is this important? Suppose another company has 95 here. That means only 5 rupees used for day-to-day expenses. Another company has only 25 here. That means 75 is used for day-to-day expenses. Why is this important? Think as an equity investor in a company. If this number is high number, what does that mean? Majority of your money is sitting in asset. Tomorrow, not fixed asset, total asset. Tomorrow, if company is closed, all assets can be sold and you can get back at least this much. Imagine you spend a lot of money in day-to-day expense and 3 years later you close your company. What happens? What is incurred as expense will never come back. But what is sitting in asset can come back. May not be exact money when you sell, what you get may be slightly less than what is there in the books. But at least you will get back more money. What if another company has only 9 rupee here? That means 91 rupees going for day-to-day expenses. And this is what happens in a lot of startups. They spend a lot of money in day-to-day expenses and they don't create assets. 3 years later, if that company is closed, what will you get back? For your 100 rupee investment, only 9 rupee will come back. Where is 91? Spent already. Rent paid will never come back to you. Furniture rent will not come back to you. But if you purchase the furniture, the day you decide to close the business, furniture can be sold. May not be exact value, but at least some value will come back to you. So first, the third ratio I'm discussing, how much of shareholders' money is sitting in asset. Higher the money, safer your investment. Now, using that asset, how much of turnover they're creating. That is revenue by asset. Now, this revenue by asset is nothing but turnover by total asset. Now, this will tell you how efficiently companies running their day-to-day business. They have 80 rupees sitting in asset and they're generating 240 rupee revenue. That means from each rupee of asset, they're creating 3 rupee of turnover. Higher the number, better the efficiency. Understand, I'm still not talking about profit. First one was about how much of money is in safe place, asset. Second one is efficiency. Using those assets, how much of how much of sales is getting generated. Third one is the first one that I'm discussing in reverse order. Using the 240 rupee of revenue, how much of profit are they earning? Say 12 rupee. Now, when you do 12 by 240, you will get to know profit margin. That's why it is net profit margin. Okay. Reverse all the three, you will get to know. I gave them 100 rupee. They kept 80 rupee in asset. Using 80 rupee asset, they made 240 rupee turnover. Out of 240 rupee turnover, 228 rupees expenditure, only 12 rupees the profit. So it is 12 rupee profit by my 100 rupee. But it should not be 12 by 100. It should be 12 by 240, 240 by 80, 80 by 100. And when you multiply, these will anyway get cancelled. I'm expecting a theory question from this more than practical question. Because in practical question, if they ask this, you will cancel all the unnecessary repetitive things. Then only first and third will be left out. Numerator and denominator. So higher possibility they'll ask you theory 3 4 marks question. DuPont model has three components. Repeat with me. First, net profit margin. Second, asset turnover. Third, equity multiplier. Easy to remember from reverse order. How much of money is sitting in asset? Using those assets, how much of profit, sorry, how much of sales they are generating? From those sales, how much of profit they are making? Third formula tells you how safe is your money. Second formula will tell you how efficiently they're using your money. Third will tell you how much of profit they're making from the turnover. Is it okay? Market important from theory perspective. Next, profitability ratios related to owners. Owner as in equity shareholder. EPS, easy formula, earning available to equity shareholder divided by number of equity shares. DPS is total dividend to equity shareholder divided by number of equity shares. Suppose 5 lakh is earning available to equity shareholders and 1 lakh shares you have. That means 5 rupee is the EPS. Now out of 5 lakh, they decided to pay 4 lakh as dividend. That means balance 1 lakh will sit in reserves and surplus. This divided by same denominator, 4 rupee will be dividend. Now tell me the next ratio becomes easy. 4 by 5 into 100. 4 out of 5 into 100 will be what in calci? 80%. What is the meaning? 80% dividend payout ratio. That means 20% is reserve ratio. And for reserve ratio, the correct name is retention ratio. 80% is paid. That means 20% is kept as reserve. Can dividend payout ratio be 100%? Can dividend payout ratio be 100%? Yes. What does that mean? Entire 5 rupee. In my example, entire 5 rupee is paid as dividend. Is there any reserve? No. So in some questions they mention dividend payout ratio is 100%. That means you should understand there is no reserve. What is the meaning? Dividend payout ratio is 0%. No dividend is paid. What is the meaning of no dividend is paid? Entire money is kept as reserves. Sometimes they say 80% paid. That means 20% is kept as reserve. Okay. Now, if you want to create a formula, according to me, you should not. If you still want to create, what is the formula for retention ratio? 1 minus dividend payout ratio. Because if this is 80%, 80% can be understood as 0.8. Now, if you do 1 minus 0.8, you get 0.2. 0.2 means 20%. So, easy way to remember retention ratio is equal to 1 minus dividend payout ratio. If you're not getting confused, then can I write dividend payout ratio as 1 minus retention ratio? Yeah, if 20% is retention, 80% is payment. Easy. Moving on. Profitability ratios related to share market. DPS by MPS. In my example, it was 4 rupee DPS. So let me start from there. 4 rupee is dividend. Market price of the share. This will be available in Demat account. Suppose today the share is trading at 40 rupee. That means if you buy the share today, you have to buy it at market price 40 rupee you pay. 1 year later, 4 rupee you're going to get. So 4 by 40 into 100. This will be what now? 10%. Remember, this is market price, not book value. But dividend is based on value or face value. So you will be buying at market rate, but you will be getting the dividend as a percentage on paid up capital or face value. Sometimes they say dividend is 8%. 8% is not on market price. 8% is on par value, face value, or book value. If face value is 10 rupee, 8% on 10 rupee, 0.8. But you will not be buying that share at 10 rupee. You can buy it in primary market, IPO stage. But once it is after IPO, today if I have to buy Infosys, I can't buy it at book value. I have to buy it at ongoing market price. Earning yield, easy to remember these two formulas, DPS by MPS, EPS by MPS. 4 rupee by 40 rupee. In my example, it was 5 rupee. Correct? So 5 rupee by 40 rupee. This will be slightly higher. I think this is 12.5%. Earning yield, dividend yield. Remember, yield is the ability of any asset to generate some income. Normally, we use this in terms of land, crop. Correct? 1 acre land is yielding so many tons of crop. Land is an asset, crop is your result. Same way, Infosys share is like land. Dividend is what you earn from that share. If not dividend, you can take earning. Sometimes they'll give you earning yield, sometimes they give you dividend yield. For both, denominator is MPS. Price earning ratio, MPS by EPS. Just reverse this. 40 by 5, 40 rupee by 5 euro. Okay, in Calci, can you do 40 by 5? 8 exact. This PE ratio, please make a note, is also called as PE multiple. PE ratio is also called as PE multiple. This is measured in times, 8 times, 10 times, 12 times. Can you give a try? In this case, you said 40 by 5 is coming to 8. What is the meaning of 8 times? Investors are ready to pay 8 times of what they're expecting from the company. They're expecting EPS to be only 5, but still they're buying the share at 40. That means they're paying 8 times of their return. Correct? What is the meaning if this number is very high? Say another company has 27, this company has only 8. That means to earn 1 rupee, in your company, people are paying 8 rupee. In other company, to earn 1 rupee, people are paying 27 rupee. Right? If it is very high, either the company should be so good or the share is very costly, overvalued, or hype. And many people avoid buying shares when the PE ratio is very, very high. Okay. What if PE ratio is very low? The EPS is 5 rupee. People are buying the share maximum for 10 rupee only. That means people are not interested much in your share. Correct? Reverse this. What will happen? 5 rupee by 10 rupee into 100. That means they are expecting 50% to be earning yield. Reverse correct. EPS by MBS. Now, last one. Market value, book value. Make a note. This ratio is also called as price to book value. Price to book value. If you search on internet, you will get it as PB ratio. Price to book value. And price, when we say, obviously market price. Book value, when we say, it is from balance sheet. MPS by book value per share. MPS keeps changing. Now, if this is 40 and this is say 10, that means this is 4 times. What if this is very high? That means share in the market has gone too far away from its book value. Maybe it is too costly or the company is so good. What if this is say 12 rupee by 10 rupee? It is very near to book value. Some people find it as a good opportunity to buy when the price to book value is very less. That means it is representing what is there in balance sheet. It is not representing any extra hype, because market price can be influenced by hype also. Too many people want to buy the share, may go up, but too many people are buying the share doesn't mean something will change in balance sheet. Balance sheet is still balance sheet only. Some prices unnecessarily go up over a period for no reason also. Sometimes you will notice share price keeps going up 5% up, 5% up continuously 3 days. What happened in the balance sheet? Nothing has changed. Book value will remain same, but market value goes up. What if this number is coming to 1? That means it is representing only what is there in the balance sheet. Understanding? These are all the ratios that are important in this chapter. The kind of problems that I want you to work out, make a note. 1 or 2 questions of reverse working type where they have given ratios and you should do balance sheet. One day before exam, I want you to go through at least 1 or 2 questions having reverse working. And do 1 or 2 questions where they have given industry average and they want you to compare your company performance with industry average. Write it as industry average comparison. Okay. And there are some questions we have done in the class also, and you have it in study material also. They will give you ratios and ask you to write only comments. Say last 2 years, ratios are given, not just balance sheet. You don't have to solve, and you have to write the comments only. Such one question you go through. only comment writing type question, at least one such question you go through. I'll show you such questions on screen. You have here are some questions where you have balance sheet, P&L given, and industry average is given. You have to work out for your company and then write your comments. What is good, what is bad in the company. And then there are some questions I'll show you here, where in the question itself, they have given all the ratios. Okay, your job is only to write comments, and you have the answers also printed here, so you can practice this. See only comments, four ratios, and the comment section. And don't neglect comment writing type of questions. You think you can easily write these comments? It's not easy. I always say this in class. Not as easy as writing a comment in YouTube videos live chat section. That is easier. This is difficult. Write at least one comment by yourself, and then one you can go through. We have done some in class. Those questions you go through. Some questions where the answer is available, you write one, at least you write. It is difficult. It is easy to solve the problem, difficult to write the comments. Unless you write, you will not realize this. Okay, such one question at least you should work out. There is one more question from which they can ask MCQ. This, you have it with you, the book. Those are not from my class. I told you already. I'll be sharing the soft copy. Don't worry. You have the answer also. You can download the PDF. This, assuming current ratios 2 is to 1, what will happen when these events take place? When you pay to a current liability, will ratio come down, or will it go up, or will it remain same? These questions are good for MCQ. 1 mark MCQ can be asked. Okay, and understand why I'm talking about 1 mark MCQ. FM and SM together is 100 marks. FM is only 50 marks. In that 15, 1 5 is MCQ. So what they do, 7 questions of 2 marks and 1 question will be of 1 mark MCQ. And that one can be any of these kind of questions. So there are 1 mark questions also. Accounts and costing is all 30 marks MCQ. So they will ask 15 MCQs of 2 marks. Okay, but in FM and one question in SM also, because it has to be 15 here, 15 there. So they have to ask one question at least of 1 mark. They can do it more. There is no prescribed format that it has to be 2 mark MCQ, but the trend in last 3 question papers is 7 questions of 2 mark MCQ and 1 question of 1 mark MCQ. And they can ask any of this in 1 mark MCQ there. Okay, all right. So these are the important things that I wanted you to revise from ratio analysis topic. Okay, I hope you have made note of all the important things that we discussed. With this, we complete ratio analysis revision. Okay, with that, we come to the end of this marathon revision video. Before I wind up, there are 2 theory chapters in financial management syllabus. One is the introduction, scope and objective of financial management, which is a very easy and simple topic. Second, there is another topic, a detailed one by name types of financing. Okay, please go to the description of this video. Entire chapter in detail, not just the revision, entire chapter in detail. I have uploaded the video on YouTube, and the link to that video is also available in the description section. If you are already good in that particular topic, then you may not have to watch that video. But if you need some clarity in certain concepts in that topic, you can watch it. The link is available in the description. All right. Thank you so much for watching. Please share this with all your friends, whoever is writing CA Inter examination in 2026. Once again, thank you and bye bye.